among the Democratic Party that have been, dare I say, I'll put it politely, reluctant to go there?
Well, I don't think they're going to have a choice. I think that right now, if you are serious about helping Ukraine and securing the future of Western Europe as our democratic allies, you better face up to the fact that we cannot convert on renewables alone. We have to, especially as the ambassador said, we have to do something with natural gas. We have to expedite those terminals. The problem is not our source of minerals, it's the infrastructure that's been shut down, the investment in infrastructure. We have to ramp that up. And I think smart Democrats are going to face the music and say it's time to build infrastructure and look at long-range planning, not simply slogans about what we're going to do on climate.
Ambassador, what do you think about that? Because obviously the Green New Deal proposals by AOC and others on the sort of very progressive side of the Democratic Party have pushed very hard on these issues.
I agree with what Heidi is saying, but I also believe it's important that we talk about America being the country that does produce energy in the most climate sensitive way. We have a great record on the clean production, the best in the world. So when we're doing natural gas terminals, which is exactly what Heidi just said, we need to do more of, expedite those regulatory processes. We can do this cleanly. We have been energy independent. We have excess, especially natural gas, which is what Europe needs the most right now. So yes, we can do it. And I hope the Democrats will work in a bipartisan way to come up with a plan to work with the administration that says, this is an emergency. We now know what Russia can do. We never thought they would be so brutal, but they are. And we've got to face that with strength. Putin will understand. Putin will get the message.
Ambassador, before I let you go, just on a different topic, oligarchs. What pressure can we really be brought to bear on them? And do they have any real influence, do you think, over Putin?
To be honest, I think the sanctions are the right thing to do, but are they going to be effective? I don't think Putin or the oligarchs care about sanctions, and I think the oligarchs have as much as they need or want right now. The other point that I think is important here now, though, and especially because President Biden is at NATO, is to get our European allies to talk to China like we're talking to China. Tell them that we will have a united front on sanctions against China if they help Russia with the military help that Russia is asking now. I think that may be the most important thing that comes out of this NATO meeting that is so very important. And the Europeans can get together. And if we can be solid on that, that could make a big difference.
Hey, Senator, what do you think of going hard at China? Does China come back hard at us? And who's got the leverage in that?
I mean, this is the $1,000 question, $10,000 question, right? So we have got to engage in a way that brings China into the rest of the world order, that what Russia did is completely unacceptable. They cannot continue to fund this war by buying Russian products and continuing to do commerce with Russia. We've got to reestablish the order. And I think it's the biggest challenge that the Biden administration will have. I think we're going to see NATO pull together. We've got challenges in energy. Let's meet those challenges. But right now we have a huge problem with the suspected and maybe ongoing alliance between China and Russia, and then China long term.
But don't they have the leverage over us?
Well, we've got to absolutely. I mean, we found out the leverage during the pandemic when our supply chains were completely disrupted. we've got to learn from that. We've got to build what we need to build here in this country, whether it's in the pharmaceutical industry, whether it's in the aluminum industry. We've got to isolate China globally. You know, most of you know that I was a big fan of the Trans-Pacific Partnership. I think that was a big mistake on both parties to walk away from that. We could have formed an alliance that would have put more commercial pressure on China. We didn't do it. It's time to talk regionally about what we can do to realign to work with our allies to realign the power base, especially in Asia.
Ambassador Hutchinson, Senator Heitkamp, great to see you both. Appreciate your perspectives on all of this. Thanks.
All right, coming up, we'll get Jim Cramer's first take on the trading day ahead. Squawk Box coming right back.
Let's get down to the New York Stock Exchange. Jim Cramer joins us right now. And Jim, a couple of things I've kind of been waiting all morning to ask you about. First up, interest rates. Yields rising so quickly, especially if you're thinking of trying to lock in a mortgage these days. It's a little scary. But watching that and then watching tech take off at the same time, does that mean it's an all clear here? It's okay to come back into the water with technology?
I'm kind of tempted to say yes to that. I mean, we heard Diana talk about the higher rates, and I think that one of the things that J-PAL has to do is cool housing, because the price of houses has just gone way up. So maybe this does that. Then when I'm looking at we have to watch Adobe, because Adobe's quarter was just okay. If Adobe can reverse, then I think it's an all clear. But historically, when you've gone down this much, and then you've had a 50% retracement, thank you, Larry Williams, to give this to me, it usually isn't all clear. And we have had a lot of stocks that are down very, very badly, and I think I thought yesterday was a very convincing bounce. And I would be tempted to buy the stocks that are coming off, even like a Meta platform. So I think it's kind of interesting here. There's a lot of stocks that are very, very interesting, particularly FANG stocks that have come down a lot that I kind of really like here.
All right, that's a big endorsement, and I'm going to listen to it when you're talking about it.
Yeah,
I hear what you're saying.
Diamond has a Marshall Plan. I mean, are you kidding me?
Yeah.
He doesn't. I love Jamie, but skate in your lane, partner. Woo.
What do you not like about it? I have to admit, I'm kind of confused because I don't know what the purpose is, and we didn't get a ton of details.
No, I mean, like, what we need, obviously, is
like
more
the idea of
pipelines, and
having-
FERC's
having-
against it.
No, I like the idea of having a plan, like a long-term plan that is laid out that crosses over administrations where we kind of say, this is what we need from a national security perspective. That makes a lot of sense to me. I don't know that I understand all the other facets.
No, I mean, you know, he's calling for more liquefied natural gas facilities in Europe. Well, how about United States?
Which they're going to do.
I mean,
Yeah.
He's kind of a one world Wendell Willkie figure here. I don't know. I'm not buying it. But anyway, it's interesting.
I wasn't sure we got all the details we needed from that, at least from the Axios story. It was
I
really
agree with
thin,
that.
and I couldn't even figure out what they were talking about in terms of the Marshall Plan, which aspect of
No,
the
I
Marshall
thought it was
Plan they
funny.
were trying to copy.
Yeah, I thought it was funny.
Jim,
But then
one thing
Zelensky was a comedian. Turned out to be a pretty serious guy.
That's true. One thing on the mortgage rates, I hear your point about needing to slow down housing prices, but it's not going to make housing more affordable if mortgage rates go up. It just means that, you know, the money that I'm paying as a home buyer is going to be going more to the bank and maybe less to the seller. It's a crazy situation, and there's not enough supply out there. And I don't know how quickly we can tackle that or fix that to the point where, you know, not only does housing come down, but rent prices too.
Well, the problem is we need more rental. I mean, you know, Stuart Miller talked. The Lunar conference call was really eye-opening because he said, look, because rental rates are going up, there's more people buying houses. But the gross margins for all the home builders are all up, and that's because they keep raising price. If they can stop raising price, then that could break a cycle. And we got to break that cycle. We just have to. Housing's out of control, and the home builders are making a lot of money. But you're absolutely right. I mean, there's 1 month. We have 1 month's inventory, so we just need to see it slow. We need that.
I mean, I feel really bad. I feel really bad for the people who aren't already homeowners. If you're selling one
totally
house
right.
and buying another, you're in a great position. If you're renting right now and looking for a house, man, you've got problems.
You're
Anyway.
dead right. But, you know, Powell needs a victory here. He needs something to slow down. And he's not getting it anywhere. Even pet food today with General Mills. He's got to get a win. I don't know. I'm pulling for him.
Me too.
He's winless.
Jim, thank you. We will
Okay.
see you very soon. Okay, see you. Squawk Box will be right back after a quick break.
Treasuries this morning, we did see the 10-year as high as 2.42375 right now. Komal Shri Kumar is president of Shri Kumar Global Strategies. Shri predicted last year the 10-year would hit 2%. His new target is 2.75%. Shri, you make note of Jay Powell's comments from earlier this week, which I don't know, roiled the markets to some extent. I don't know why, but you think he should have done 50 already, and it shouldn't be a surprise that 50 might be what's needed a couple of times from here on out, but it's already too late?
It's very late, Joe. I've been saying that they should have started tightening a year ago and started paring back the balance sheet by mid-2021 when there were signs the economy was recovering. Instead, the chairman kept insisting that inflation was transitory. And if you recall, from last Wednesday, he claimed that because his inflation forecast was wrong, it justifies his pivot. It's like two wrongs make a right. No, Mr. Chairman, it does not. So they are backed into a corner. They are heading toward a stagflation. I wrote that first in a report which I put out in public last October, and I feel even more likely that we are headed toward a phase with a recession combined with high inflation rates. The fact that 2 to 10 US Treasury yield curve is moving toward inversion, Joe, tells me that that is clearly the signal it is giving. Don't believe the stock market. Look at the bond market. If you go back to October of 2007, the S&P 500 hit a record high. The equity investors thought that that meant the economy was very strong indeed. I wrote a report saying we are headed toward a recession. Because in November, December of 2006, the yield curve had inverted. I was called a fearmonger. How could I be saying that when equities were so high? Sure enough, 2 months later, the Great Recession began and the equity market did not catch it. We are in a very similar situation in terms of market signals. At the same time, go back to 1978, 79 in terms of looking for a period with recession combined with high inflation rates. That is pernicious. It's very difficult to control, Joe.
I think Elvis was alive. I mean, that's a ways, I think, Shri. So, it's not going to be long, and you're going to be at 1% again because there's going to be, if what you say comes true, there's going to be a slowdown, and rates are going to come back down. Or are they going to have to stay high in the face of a recession because of inflation? That's even worse. And we don't have much time, Shri. The latter?
Yeah,
okay.
Let me go quickly. It's the latter. I've been saying that the whole yield curve will shift upward. That is what has been happening in the last few weeks. And what I expect is, despite a recession, and even if the yield curve inverts, we are going to see higher interest rates, higher yields, both on the 2-year and the 10-year.
Okay. All right, Shri. We're going to have to end it there. Oh, my word. I've got barely enough time to say goodbye. Futures are down. Bitcoin's down. Andrew's back. Make sure you join us tomorrow. Becky, good to see you. Squawk on the Street's next.
Good Wednesday morning. Welcome to Squawk on the Street. I'm Carl Quintanilla with Jim Cramer. David Faber has the morning off. Futures backing off just a touch from Tuesday's 5-week high as the president heads to Brussels this morning with potentially some new sanctions and energy aid to the EU on day 28 now of the Russian invasion of Ukraine. Our roadmap begins with the CEOs of Intel and Micron among the chip industry leaders set to testify today before a Senate panel pushing for some manufacturing subsidies. And GameStop surging again as Chairman Ryan Cohen boosts his stake in that company. We're going to start, though, with the Russia-Ukraine conflict. The president will soon depart for Brussels to meet with allies and NATO leaders, urging them to join the U.S. in imposing more aggressive sanctions against Russia. Jim, we think they might be targeting members of the Duma this time. Journal says there could be up to 300 people targeted there. And then maybe helping them out with some LNG, some hydrogen.
Right. I do think that there's nothing we can do to give more LNG. It's fully booked. We can't even get them Canadian LNG. I think that there's a lot of false talk, including Jamie Dimon, if it's true, about what the energy situation is. They're completely dependent on Russia. they shut down everything. They shut down coal. They shut down nuclear. I mean, they had a really fabulous relationship with Russia. That backfired. Only Poland seems to have enough terminals to be able to take ours in. We are doing 12 million BCF. There's like nothing left in our country. Thank you, Rusty Brazil, for saying that there's 2 million BCF that could come from Canada, but it would take a year. So the thing that most needs to happen is we keep thinking if Russia will default, Russia, it's costing too much to have a war. None of those things are panning out. Nothing. It's not costing too much. I mean, now, maybe they default, but so far, I'm not saying Russia's winning by any means. I am saying that his same plan that he did with Syria, with East Aleppo, same plan that he did with Grozny, which is that win at all costs, because the West will never stop us. And here's the edge, because he's a madman. Our guys are all kind of sane.
Yeah. Certainly, though, Lavrov today saying we didn't expect some of the reserve restrictions to come into place the way they did. A kind of interesting admission of how severe the sanctions have been. And there's been some reporting in the Times about the blame game beginning in Moscow. At least one high-profile exit of their climate envoy resigning and leaving the country. Well, and then signs even that Ukrainian military officials are taking back a little ground from Russian forces.
Well, yes, it does seem, but again, the pattern in Russia is to sack generals. I mean, this is a long-standing, I mean, Stalin sacked almost his entire generals in 38, 39, which is clearly a mistake. And then he beheaded a lot of them, he executed a lot of them, which was ill-advised strategy. But the same thing happened with every one of Putin's wars. Whoever is the general that doesn't do well, they sack them. They cashier generals there. We did cashier some generals in Italy in World War II, but that was never our style. In North Africa, we cashiered some. But in Russia, they just get rid of anybody who's just not delivering. That's, remember Stalin used to Photoshop people out in the Adobe. I just think that we just are not used to the way the Russians fight a war. And the Russians are, I'm not saying they don't value human life. I am saying that they'll try whatever strategy is necessary. And you don't want to, if Putin wants to win, he's won. And I think Putin is crazy enough to, I don't even know if he believes in mutually assured destruction. I mean, I think that I think if I were in the government, I'd be very deeply worried that he's just, that he's an insane man right now, and he will not lose. And this is what happened when he came into Grozny in 2000. He let the men and women out, and then he leveled it. There were 30,000 people killed almost instantly, but they were viewed as terrorists, and nobody cared. I mean, I'm just afraid that people don't understand who this man is.
Right. But you will admit, though, that he's having to settle maybe for a plan B, some kind of war of attrition.
Oh, absolutely.
Yeah.
And it's not working out the way that he wants it, but I'm not, they have a very big army, and they haven't really engaged their reserves. We have not given Ukraine what I thought we would give them. We didn't let them have the MiGs from Poland. Every city is shelled constantly with reckless abandon, and we're not able to even have the long-range drones to get the artillery. Now, I mean, I have a lot of sources that are Pentagon, and I think that this is really being run by the National Security Council and not being run by our Army. Yeah. And certainly not being run by the Marines. But remember, there are 36,000 buildings in Fallujah, and the Marines took every single one of them in 3 weeks. There's 300,000 buildings in Kyiv. That's going to be very tough to take. So I don't know what Putin's plan is once he gets there. But I do think that the refugee crisis is what we have to follow now.
Would you argue that let's say the discipline the president has had in not committing U.S. troops, right, not getting involved in some kind of no-fly zone, essentially not getting provoked by Russia directly, has been market-friendly?
Yes, but I do think that his decision to not let Ukraine have, and it really was him, to have the fighter planes that they need was ill-fated, because they need to be able to, they need to stop the artillery. I mean, they need to stop the missiles. I mean, all Russia does is fire missiles at hospitals, and I'm waiting for like playgrounds. I mean, what the hell are they targeting?
Well, I mean, Pentagon has said the scenario of the MiGs was high risk and low reward, that they essentially have a lot of the anti-aircraft power they need,
but
rather than play Top Gun in the sky.
Right, but I mean, if you can send missiles at hospitals with impunity, I mean, that does not seem like the Ukraine's winning. I mean, that's just not right. It's just they're not being stopped, and I think it's Ukraine is doing a terrific job, but you have to take out Russian artillery. They call it hail there. The Russians have historically used artillery far more aggressively than every other country, and they do it to level buildings, and they don't care who's in them. And I think we have to recognize that it's both a humanitarian crisis, but it's also, while Ukraine is certainly putting up a good fight, nothing's stopping the artillery. There's nothing. I mean, like, would it surprise you today to hear that they took out 5 old age homes, 3 nursing homes, 2 hospitals, and playgrounds?
Sure.
I mean, this stuff is just war criminal. Now, I know he was branded a war criminal, so maybe he feels like that gives him the license. And again, someone could say, Jim, you're a stock guy. We'll stop that already. I was going to be a professor of military history. Like, just forget it. What bothers me endlessly is that that no one in, like, Germany, it should be standing up just saying, right now, you cannot target children and seniors. You can't do that without the MiGs coming.
Well, even this morning, the German chancellor says, look, we are not going to ban, we can't afford to ban Russian energy. So their hands are tied in ways maybe even more than ours
How did
are.
they do that? I mean, when you speak to energy people off the desk, all of them are the same thing. How did that country even think that it could get out of this? It's possible to get it down to 35% Russia if we went full tilt with every single LNG facility that we have, but that's still going to take a year.
Yeah,
you can't recommission a nuclear power plant. You might be able to, like if Larry Culp were to go over there, I swear, they could actually get some plants going that they don't have going right now, but it is, that's a nod to Larry. Hey, Larry, he loves the show. He needs to win. Pal needs to win. A lot of guys need wins, but right now, I know, look, Zelensky is a brave man, but believe me, I remember when the Russians targeted the leader of Chechnya with a missile when he used a cell phone. They killed him. Nobody cared.
Well, a big part of this trip for the president will be perhaps leaning on the EU, as we said yesterday, to keep China from giving them any further assurances. Interesting discussion now about whether or not they belong in the G20, Russia, and then China, of course, as defending basically their right to remain. We'll see.
G20, they target elementary schools.
Yep.
I mean, look. I mean, there's two quick people who target elementary schools: the cartels, like when they targeted the St. Louis Potosi, and the Russians. You don't target elementary schools and think that you're going to be able to get away with it. Like, why don't we have the names of every general, and let them recognize that we know who they are, and they should turn on Putin. I mean, we're not more fired up about the fact that they are targeting hospitals.
Yeah, I mean, you clearly want to see this as get escalated.
I want to see us to give them planes and something that stops artillery. Look, we gave them drones that are the drones that you put in a backpack. But I had the drones, I had AeroVironment on. They have drones that can take out tanks, artillery, but we gave them the handheld stuff. I mean, that stuff's like Tinker Toys. Give them the real stuff. I mean, when I had AeroVironment, they brought all the stuff that they had. They had the 600. That thing is just lethal.
If you get your way, Jim, where does the S&P go? Certainly back to 42 and maybe below.
Well, I think for a little bit, I think the S&P is in pretty good shape here. But I think that, look, here's what I fear: that the Russians keep escalating, and we're acting as if they're not escalating, and Putin seems more and more desperate. And I just think that somehow someone has to say, you've got to stop targeting civilian children and hospitals. You've got to.
Yeah, I mean, the president's been very clear that perhaps chemical weapons are next.
I know.
And he's been good about telegraphing what has come to pass from the beginning of the invasion itself.
I'm waiting for Putin to say, well, the United States bombed Bakhmut Hospital under Nixon, so we can do whatever we want. I just think that it just seems like that when we hear about these, you said it to me earlier this week. Are we inured to the idea that he's got missiles pointed at playgrounds and hospitals? I'm not inured to that. I just think that we have to do whatever we can. We have to, short of a no-fly zone and sort of our own soldiers, there has to be a way to be able to at least get in there with the AeroVironment drones and try to stop that artillery.
Yeah.
But we're not giving them the whole arsenal.
No, not yet anyway, and we'll see whether or not this trip to Brussels unlocks any pieces of that puzzle.
Could do that. It could be important. This would be a very
no
important
doubt.
thing.
No
because
doubt.
I think if everybody turned, if India and China turned on Russia, Russia defaults, Putin says, look, I'll tell you what, I'll take southeast Ukraine, then the S&P goes up 7 to 8%, which is really what the bears are worried about. Not the Russian bears, the real bears.
That's right. We're going to watch that. Obviously, there's other developments back in this country. In about an hour, the CEOs of Intel, Micron, Lam Research, and PACCAR set to testify before Senate Commerce. The leaders will make the case for a bill providing subsidies for chip manufacturing in this country. Earlier this morning on Squawk, Intel's Pat Gelsinger outlined his message to lawmakers.
The world needs more geographically balanced and more resilient supply chains. And while the Russia-Ukraine situation isn't central to any of the supply chains for semiconductors, it just reinforces the geopolitical instability that we have and the urgency around building supply chains that are geographically balanced, U.S., Europe, and Asia, and far more resilient for, the digital future. Everything digital runs on semiconductors, and it is just essential that we build these fabs where we want them.
We're getting awfully used now to the data, the figures, the percentage of chips that we used to make more of ourselves.
Well, and Intel was the leader. Lam is the key company that's speaking because you can't make the kinds of chips we need without Lam. And not to be too monetary, but Lam is the one to buy of those. I like Qualcomm too because Qualcomm is asset light, but Qualcomm uses it. If we don't protect Taiwan, I mean, look, the discussion should be first, we protect Taiwan while we build our own, because we're talking 2-3 years to build our own. And Pat Gelsinger talks a very positive game, but our country's shown no. I had Secretary Raimondo on the week that she got in, and she talked about the $55 billion, and nothing's happened. It just seems like the Senate, they're just not focused on this like they should. Maybe this will change, but we have to build them here, and we don't have the labor to do it. We just don't. I mean, the reason why they need the subsidies is because it's so uneconomic to do what we have to do, that without it, it's worthless. When I went to the Intel plant that was built in Ireland, when I went to see the opening, we went to the Abbey Tavern. Remember, my wife is an excellent river dancer. And one of the things that happened, what they explained to me was, look, it takes a lot of people to build a plant, but once the plant's done, we can run the plant with 30 people. So it's a difficult thing to subsidize. Recognize that the building of it takes a lot, but then see you later.
Yeah, certainly the takeaway from NVIDIA's meeting and some of the technology they're working on, the processing power of some of these chips are like a big chunk of the daily global internet use.
You have to watch it. I mean, people don't understand. I mean, I know the stock went up. You have to watch it. First of all, it's all rendered. Everything's rendered. Everything in the actual video is AI. And at one point, he's got these little monsters that they learn how to crawl, then they learn how to walk, then they learn how to run and stand up. And then he's got basically a restaurant that's built via AI. Then he shows you cancer cells, actually for the first time, splitting. And he's got the metaverse. I mean, if I were Mark Zuckerberg right now, I would say, okay, listen, I got to work on Reels, but I got to call Jensen. I mean, you have to call Jensen. It was all metaverse. At one point, there's a woman who's talking, and she's talking in German, and then you press a button, she's talking in France, and she press a button, she can talk in 27 languages. This thing was so space age that this was so far ahead of where anybody thought we could be. Just watch it.
It is actually worth going back to.
Just watch it. It's the most. Jensen's the smartest man in the world. I mean, he's rendered. It's not even Jensen. They wrote music, artificial intelligence music.
Yep.
I thought it was every bit as good as
Pretty
Schubert.
good. It could be
not as good as Beethoven, but it's certainly better than anything Shostakovich ever written.
No, one day there will be a hit song that was not written by a human being.
No, and
it'll be coded.
And Jensen, it's just like when he had Me Be Me, and he said it was really hard to get the lilt at the up, but me was better than me, and Jensen was better than Jensen.
Certainly, the innovation is one thing we can take solace in, even despite all the production pressures right now.
I felt so great. It's an American company. I want people to watch it to be proud.
Yeah.
Be proud.
Yeah. When we come back, the return of the meme stock. GameStop extending its rally after Chairman Ryan Cohen does boost his stake. AMC and Robinhood also getting a recent spike. Take a look at futures here. A lot more to get to, including that call out of Adobe, General Mills, and a lot more. We're back in a minute. GameStop shares building on yesterday's big rally. This SEC filing shows that Chairman Ryan Cohen had bought 100,000 additional shares, raising his stake in the video game retailer to almost 12%. Last night he tweets, "I put my money where my mouth is,"
well,
Jim.
Good for him.
Yep.
I mean, I think that the memes, they're back. I mean, they took up AMC, so somehow that's related. I think what we've lacked, of course, is a plan. The numbers weren't that great for GameStop. We still don't understand what he intends to do. Once he lays that out, then I think we can make a judgment. Like Bed Bath & Beyond, by the way, is in that one. That one, there's some technology that's needed. I'm just trying to figure out whether we combine the two. Who knows? He's a man of great mystery. And but he comes in just when I think that the apes are like kind of desperate. It's kind of like the Jane Goodall of the apes. Right, he's the Jane Goodall of the stock.
What, they need some cheering up, and
they did. They were down.
Yeah,
they were down. They're a cohort. They care about two stocks. I mean, like, why didn't they care about, like, say, like Amazon and Tesla? But they've got. I would love to see what he's got. I don't understand yet. Matt Furlong is the CEO. That conference call was one of the biggest jokes I've ever seen. No questions taken. Whether they think they're Warren Buffett doesn't take questions. At least they invite Andrew Becky out there. I want a plan, other than just buying stock. But you know, these guys, the apes, just love that. They'll take it up. Bed Bath, they just want a plan.
Yeah.
Now, the letter to Bed Bath was actually pretty sophisticated, and I know that they've been in contact with me since then. I welcome dialogue as always.
Well,
dialogue, welcomer.
Ownership disclosures are a lot easier to get on the tape than strategic initiatives, wouldn't you say?
Yeah, but I think that yes, I do think that he did fix the balance sheet on the backs of the apes. You know, they issued a lot of stock. They needed the balance sheet to be perfect. They have a chance to do something. Bed Bath has a great balance sheet. Now, if they spun off Bye Bye Baby at Bed Bath, and if GameStop were to have some sort of strategy that involved being a crypto bank, which was my plan,
You've been calling for that for almost a year.
well, he'll do it, and then he'll claim it himself, and he'll just take it and run with it.
Sure.
He doesn't care that it's my idea.
But, I mean, is there urgency on any of these things?
No, because the balance sheets are good.
Right, exactly.
Balance sheets are good.
So they have the time to string this out.
Yes, they do. They can go on forever and have a lot of fun. It does seem like they're having fun. I mean, like he buys 100,000 shares is nothing for the man. But there's a lot of chaos in the marketplace, and there's a couple of forces. I mean, GameStop is a nothing company, a $10 billion nothing company that has gotten. I tried to get the apes to focus on other stocks besides GameStop and AMC.
Who else would you include? I mean, what other names could they potentially?
I got 500 of them. The S&P. I mean, if they just looked at any other stock, I mean, you know, if they looked at, I don't know, Brunswick, Sherwin-Williams, I mean, Fortune Brands. I mean, the fact is that they're stuck on these two stocks. They don't even look at Chewy anymore. They could do General Mills a good quarter.
Yeah.
But I'm stunned that they just can't get beyond those two. Now, look, it's true, obviously, that Adam Aaron cultivated. Now, I want to be sure when I mentioned that on NVIDIA that was rendered, it was Toy Jensen that was rendered. You've got to see Toy Jensen. Yes. That was rendered. And yes, Adam Aaron should call us and then say he can't come on again, because that was brilliant.
We're going to get to General Mills, as Jim points out, pretty good quarter, and they do raise the guidance, and we'll get to Adobe as well on their call. Back in a minute, we'll get Cramer's Mad Dash. Don't go away. Futures moderately negative here on this early Wednesday morning. By the way, today is the 2-year anniversary of the COVID S&P low. 2 years ago today, 2237.40.
And Dr. Gottlieb said it was the end of the pandemic today.
As we know it?
Yeah.
End of the pandemic as we know it?
Yeah.
We'll watch some of those milestones along with some news out of Moderna today. Pretty good endpoint and immune response in children under 6. The opening bell in 4 minutes. Time now for Kramer's Mad Dash as we count down to the opening bell.
Yeah, look, I'm going to do General Mills, and a lot of people are going to want to buy the stock, but let's understand that this was because pet segment up 30%, which was remarkable, and North American food service, they're back. Obviously, moved back at the office, and that was 22%. The actual food business wasn't that bad, and people are able to pass on costs. Higher the money, and when I read this, I think it's costing more to eat breakfast. It is just costing more.
Still, though, after Nike, nice to have a company raise their guide for the full year. Yeah.
Yes. So it's not. Look, there's a lot of companies that are doing better than we thought, and a lot of companies that have more pricing flexibility. But again, if you're JPAL, you don't want that. You don't want them taking advantage of it. And I know that Becky and I were talking earlier about the fact that the mortgage rates have gone up. But housing, a $450,000 house last year is now a $520,000 house. Now, as it is, people who are watching at home aren't making anywhere near that are saying big deal. But the rich cannot get richer, okay? And I think that the current inflation is making poorer at this point.
Yeah.
That's what I think changed. I think it's all very clear to us, whether it be a General Mills conference call or a home building conference call, that the poorer people are really struggling with inflation now. And that's why Powell really has to do a good job here.
Yeah, otherwise risk undoing a lot of what he's worked for, and
Exactly.
certainly the higher spending on gasoline and energy is a problem.
If he were here right now, he would say, you know what, I regret, I thought we got everybody a job, they were doing better, but prices are so out of control that the rich people have no problem. They've got wealth effect, they have stock, but people who aren't rich are saying, I can't go to the supermarket.
Yeah, well, you saw the U.S. household wealth figures yesterday, right? Up 24 trillion. But a lot of that, most of it's real estate and stocks.
Yes, and that's the rich getting richer. That's not what Powell wants. I'm not saying Powell's a Trotskyite, but I am saying that Powell is far more left-wing in terms of not taking, he doesn't want to take money away from the rich, but from the point of view of like, God, we have to help these people, the working person. That's his primary interest. Yeah. And it's never talked about. This is a Federal Reserve chairman with a big heart. And he knows that his plans are being upset by the fact that we see that number. Rich people have no problem going buying Cheerios. But, it used to be buy one, get one. You buy Cheerios now, they're a fortune.
Yeah, cereals, the cost.
Yeah,
it's huge. By the way, you mentioned Adobe earlier. They do guide below.
Yes,
they
do.
see an adjusted 330 this quarter, streets at 335. Down 7%. It's only going to take you back a couple of days here, Jim, given the rally.
But it was not. I mean, I was hoping that they would absolutely not kind of guide down. But remember, and I do feel that some things have been pulled forward. But I would point out, I think this is important. Ukraine, Belarus, and Russia turned out to be far more important than I realized. And the numbers, it's 82 million. But it turns out that. Wow, I mean, Europe's weaker for them. So let's give Shantanu the fact that they did have a European slowdown. We don't know what they would have done without that. But there also is newfound competition. He has to be very careful.
Newfound competition.
Yeah, there's an Australian outfit that a lot of the artists that I deal with are using. It's called Canva.
Yeah.
Canva. By the way, it's a $22 billion company.
Yeah, no, they've been around for a long time, but private.
But they're coming underneath a lot of what Shantanu has done to be able to design. And I think it's worth asking about because I've never thought that anyone could come underneath because their prices are very good.
Yeah, it would be fascinating if
Don't
they
you
could
think?
take a chink out of Adobe's empire.
Yes, it is an empire.
In terms of big tech research today, Webbush at least does say that Apple continues to see, what's the word they use, stellar demand for the iPhone 13.
I thought what was more important, as much as I like Webbush, but how about Apple? Rod Hall saying things are good. I mean, he's not been what I call an Apple fan. He's saying things are good. He had been negative. January, February is good. Again, I think that my friend Larry Williams, who I think is the greatest market historian right here, does say that there's 21 times out of 21 times when you go down this much and then you have 50% retracement, it takes it out, you got to buy. And I just think I'm not sanguine about a lot of the junk. I mean, if you take a look, say, at Poshmark, which, by the way, was a big company. I'm using that as a metaphor. I don't want to own that. I don't want to own any of those companies that came public. I have a bunch of them that came public last year on tonight, and I want to grow and put their feet to the fire, because I think that what you need to buy are FANG.
FANG here.
I'm a FANG buyer.
Interesting.
I'm a multiple FANG buyer.
Did you see the Sembalist note this morning? JP
Yes,
Morgan?
I did.
He says if there's no U.S. recession, the March 8 low was probably a market bottom.
I thought that was amazing, and it was great.
He says, recession's a close call, but in the end, he says, I don't believe the U.S. will make it through without a recession.
Yeah, and I think, but I like that call. And let me show you, I can't show it to everybody because it's unfortunately not large enough, but Sembalist caught a fish. He wants me to go he takes these great fishing trips.
You talked about your
This is
fishing
like the biggest
expeditions
tuna in history.
one of the
But
smartest.
I do think that that Sembalist piece is very important because he's been on the fence about being bullish. And the fact that the bottom, and then we have this bottom, the 2-year bottom, there's things coming together. Now, people say, well, wait a second, Jim, the market's down. Take a little longer view. I mean, there's a lot of things coming together here. Now, 15% of the labor force was out when Lennar had its previous quarter. And so, therefore, they're paying overtime to everybody else. Mm-hmm. What would happen if the pandemic ended, if our side gave Ukraine what they needed to have a real stalemate, and then Russia stops? Agricultural then goes, remember, unfortunately, 30 to 40, 35% of our, let's just say, bread comes from Ukraine. There are a lot of things that could go right, and the Bears have to be careful. I think the Bears have to be careful. They may have had a good run here.
Yeah, down to 42 or 41-14.
Yes.
I know our friend Tom Lee looked at Cass Freight, which he says leads CPI by 6 months, now negative year on year, Jim.
That's interesting.
Rolling over pretty hard.
Well, what do you think about the EV chatter from Morgan Stanley? Now, Adam Jonas, whom I've really come to love, he took a couple of Uber rides, and he was in California, and he asked driver B, would you consider switching to an EV? And the guy said, absolutely. I've run the numbers on this, and I think I can save $2,000. This is the kind of empirical research that I've really come to respect from. This guy's the most anecdotal guy I've ever seen. Remember when you're at school and they say, well, there's anecdotal and that's moronic, and there's empirical and that's smart? Well, he's redefining anecdotal here.
He did publish a conversation with his Uber driver.
You gotta I don't know. I mean, the research today was Toy Jensen.
A little thin.
It was Toy Jensen.
Although J.D. Power today, Jim, their forecast for new vehicle sales for Q1 down 18 from Q1 2021, which is in line with what Jonas would argue.
Can't make them.
Yeah, can't make them.
I mean, when you talk to Farley, Ford, I mean, everything they can make is sold out already. And we did have the Jonas piece the other day about the real sticker price. And look, we can't make them fast enough. And we got the 2 homes, which is, of course, the Tractor Supply issue, where people are recreating their homes somewhere else. And they need a car, truck. Yep. And they have to go to Lithia. I'm not recommending Carvana. They have to go to Lithia Motors, a great balance sheet. And I just find that we're just stuck. Look, hybrid was not something that Powell saw coming. He just didn't see it coming.
You mean hybrid work?
Hybrid work?
Yep.
Now, I mean, I'm not talking about the hybrid work of, say, a Goldman CEO DJing for Lollapalooza. That is not hybrid work, is it?
I don't know. Maybe is that the main gig, and then Goldman's a side
I don't
gig?
know. My daughter went to Lollapalooza. She said it was life defining. So if David is spinning at Lollapalooza, I mean, maybe he's doing some hybrid work, and he's one of those guys who says you got to be at the office.
This is a picture of Jim and David.
Oh, look
Where
at
was
that.
this taken?
That was at the Super Bowl. I didn't know. Do you have any more of those? Because that was some. Oh my God, David
There's
really
another
did
one.
it. Well, I always like to help Goldman CEOs. I've been doing that for 35 years. There you go.
Solomon is going to play Lollapalooza.
I mean, look, I told David I think it's absolutely fantastic that he does it on his own time, and he's doing Lollapalooza, at the end of July, and why not?
Yep.
He blows off steam. He says to me, he goes, look, you know, how do you work out? I tell him I have a 330 trainer come in. He goes, well, I think that's more insane than my spinning disc. And what am I going to do? Say no?
Well, he would argue that it provides a way for young people to approach him. And as you said the other day, sometimes that's daunting when you're a young engineer or something at Goldman.
I think it could be a way to recruit people.
Yeah.
Say, look, you know, I'm cooler than Gorman. You think Gorman's cool? Or Jamie Dimon talking about an Marshall Plan. Does he even, Marshall, you know, like,
You don't, yeah, we haven't touched on that
Marshall,
yet.
E.G.
Dimon
Marshall.
supposedly
Marshall's-
presenting this plan at a meeting at the White House on Monday.
We need more info about what he said,
Yeah.
because most of his Marshall Plan is about having LNG plants, according to the story, in Europe. That's good. I mean, we can give them all the money, but they're wealthier countries than we are. We don't have any money.
Yeah.
What are you going to? We can't even build a semiconductor plant.
By the way, it reminds me that banks went positive for the year yesterday. The only other than energy, right, that's been making it work.
They need higher rates. They need higher rates. And now I know that the software cohort's going to trade today with Adobe. And I think that's a mistake. I mean, Adobe's up to itself. They have some competition. They had the European issue. Some people say they pulled forward. Some people say that now that people are traveling, they don't need Adobe as much. I don't buy that. But the banks are great leaders. They were great leaders coming out of the 91, 92. They were fabulous leaders. That's when Greenspan decided to let them all refinance. And they can be great leaders again. So I think if you see a lot of the, you see the NVIDIAs down a lot, I mean, go watch and then go buy. Banks leading are terrific. I love it when a bank leads. Love
Finally,
it.
really quick, we haven't touched on Starbucks. Another store voting to unionize. This one in Seattle, it's a 10-minute drive
Right.
from headquarters.
Well, I mean, sometimes you wonder what went on with Kevin Johnson. Suddenly, he would say it wasn't the party. He's been signaling it. I did not get the signal. There were other people maybe got the signal, but I, who follow it more closely than anyone, didn't get the signal. That's not hubris. That's actual, I follow it really closely. But I have to tell you, if I were Howard Schultz, I'd say, this will not stand. We offer the best benefits. I'm going to go speak. I'm going to go around. We're going to talk to Green Aprons, and we're going to say, come on. But they do have a lot of unionized franchise, which is one of the reasons why when you go to an airport, it's so bad.
Yeah, that's down,
I don't know.
down 18.
I don't want to generalize too much.
Yeah. We'll keep an eye on it. I mean, we're talking about labor at Kellogg and Canadian Pacific and Starbucks and Amazon.
I feel like spinning a disc when I hear this. Hey, the black and white pictures of the spinning were the best ones. I don't know why they didn't run the black
really?
and white. Oh my God, portrait mode, Tim Cook. We don't talk about him enough.
When we come back, a lot to discuss with Adobe CEO Shantanu Narayan, including his company's guidance, the effect of Russia-Ukraine on annual revenue, and a lot more. As we go to break, let's take a look at the bond report, see how treasuries are faring this morning. Did get some comments this morning from Powell, mostly on digital currency, and we'll get daily at 11:45 as we start to tally up which of these Fed officials are more hawkish or dovish. Dow's down 270. Be right back. Laggards on the NDX this morning. Okta's going to be back in there as we continue to look for clarity about that reports of the hacking. But Adobe's going to be next, down 7% as they do guide below. We're going to talk to Shantanu Narayan in just a bit about the quarter, Russia, Ukraine, and the effect that's having on their overall business, as well as competition when we come back. Dow down 300. We mentioned earlier the new data out of Moderna that they did see a robust immune response in children under 6, and they will seek an emergency use authorization, Jim, at a time where we continue to watch this BA2 wave in Europe and a lot of expectations that it's going to hit us sometime perhaps in April.
Yeah, I just think that once again we lack good data in this country, as Dr. Walensky said, because they can compile, but they can't make anyone comply. But I still feel that we're on the other side. The Moderna news is terrific, but we haven't gotten any guidance yet about whether we should be getting the next shot.
Right.
I sure would like to just have them say, listen, from now on, every 6 months you have to get a shot. Just tell us.
Yeah. Meantime, in terms of restrictions, we did have the reports of this letter that the U.S. travel industry sent to the White House saying, please remove the mask mandate on public transportation by April 18th.
Oh, they have to. Look, we have to go back to the way it was. It's an epidemic, and as long as you get vaccinated, you're not going to go to the hospital. Now, we've had times where 150,000 people die of the flu in a year. I mean, we're now we're flu. And I think that the fact that no one seems to say that is indicative, again, of the dysfunctional nature of the government.
Specifically, public health agencies.
Yes,
the CDC.
They don't talk to each other. FDA doesn't talk to NIH. NIH doesn't talk to CDC. President doesn't speak to any of these. I mean, it's just chaotic there, which is a shame because we could really help the country right now if someone were to come out from the government and say, everyone, get vaccinated, but you're on your own.
That's kind of how it's going to work.
That's
at least
what
in
it's
the
going to
future,
be.
yeah.
So just own it. And, look, when you're on a plane, everybody knows the secret is to order a Diet Coke. And you don't have to put the mask on. Just sip the Diet Coke.
It's true.
I sipped the Diet Coke for 5 hours. It was perfect.
That's exactly what everybody does. Yes,
I'm
it's
sipping
true.
the Diet Coke.
Leave me alone.
Yeah.
I did want to get you really quickly on yields today because B of A argues that first of all they argue that the correlation has broken down between equities and fixed income.
100% correct.
They say the RSI on the 10-year above 70 shows that maybe a respite makes some sense
That's
here.
what I thought. None of my good bond guys agree with that. I thought a respite was right. Not a single one of my bond guys think that that's true.
They don't see like support at 2.5, something like that.
No, but they just see, wow, some of these semis are really getting crushed. They just see that it's just relentless. I disagree. I think that they cool off.
There's also the notion that a month-end rebalancing, maybe some pensions load up once again, could ease the path we've been on.
Well, I mean, I do find that if you can get 2.4 for a 3-year period, that's better than the vast majority of S&P stocks.
Yeah.
So let's not forget that.
The earnings yield on the S&P now the lowest spread to 10 years in about a year.
Yeah,
since summer
I mean,
21.
I think rich people who, again, are not who Powell favors are doing great. Just get these yields, go buy the yachts, go buy the Russian yachts. 12 million for a yacht, new yacht.
12 new million?
Yeah,
Not used?
130 footer,
What about
12
used?
million.
What do I get for used?
You can get them for almost half that.
Okay.
4-bedroom with office.
Yeah, but then annual operating expense, fuel, insurance, crew.
1 mil with a crew of 4, of which if you lend it out for 2 months,
Pays for
all
itself?
paid for it.
Sounds
See
like
that?
you've looked into this. No more Boston Whaler?
I looked into it for the point of view of the show.
Of course.
Not for the point of view
for
of
the
the
viewer.
buy.
You did it for the viewer.
Yeah, because that would reveal me as being an apparatchik or a
Well,
kulak.
The other thing we haven't mentioned this morning is mortgage rates. Refis down 14 on the
Yeah,
week, but
it's
down
happening.
54
It's happening.
on the year.
It's happening. And I think it's fine. Look, you got to, it's not the rate, it's the cost of the house. It's fine. Now, we've got one that I think is literally, Carl, the one that is causing the most dislocation in today's stock market is one of my favorite companies, Adobe, which is down 36 points. We got to find out it's under pressure from the quarterly results, and particularly from the outlook. And Shantanu Narayan is a straight shooter. We got to find out what's going on because this stock's now down 24% for the year. So I am so glad that Shantanu, the CEO and chairman of Adobe, joins us right now. Shantanu, set us straight. The stock is down a lot, but the fact is that Russia, Belarus, and Ukraine were the main reason why I think you did not make the projections.
Well, Jim, it's always good to be on your show. And as far as we're concerned, we had a great Q1. When you look at it, one of the things that I think your viewers also have to remember is that you have to look at the growth on an adjusted basis, because in the same quarter a year ago, we had 14 weeks, and this quarter we have 13 weeks. And so when you think about it in terms of the revenue growth, which was 17%, when you look at digital experience, which is how we help enterprises with their engaging customers, subscription revenue growth on an adjusted basis was 22%. The document cloud or PDF was 26% year-over-year growth. So the business is fundamentally extremely strong. I think people have to think about it as it relates to the seasonal cadence. And then in terms of moving forward, to your point, we wanted to be completely transparent about the impacts of what is happening in terms of externalities. And I was listening to you on the show as you talked about how your sort of call to action in terms of getting back normalcy. But as it relates specifically to Russia and Belarus, we are both saddened and shocked, frankly, at what's happening as it relates to the war in Ukraine. So we've stopped all new sales in Russia and Belarus. And in addition to that, because you have a subscription book of business, you do not have the ability to collect payments. So we've actually reduced both the ARR, or the annualized recurring revenue, as well as the revenue for the remaining 3 quarters. So there was a lot of information that I think investors need to digest, but the fundamentals of the business continue to be extremely strong.
All right, let me ask you about something I found disturbing, but it's not your company only. When you have GAAP and non-GAAP earnings, I look at what must be a talent war. where you have to give stock. And I wonder, what's the end game there, Shantanu? Because if everybody is so bid for, in the end, your company does get hurt.
Well, Jim, we're an intellectual property company, and so we recognize that the intellectual property that we really care about is our people, because at the end of the day, that's the biggest asset that we have. And while it's a war for talent, I think our ability to attract as well as retain employees is fantastic. I think what's changed, though, is that the new cohort of people, as people have been working from home, and they don't fully appreciate the culture of the company and in terms of how you grow people's career, I think that's much harder to do when you're completely remote. And so I think all companies are trying to navigate as we've been growing people. We probably have 10,000 people whom we've hired over the pandemic. And so how do these people understand what makes Adobe unique? How do they resonate with the mission of the company? So I worry a little bit more about making sure that we can build culture and have them feel part of what the mission of the company is, than the financial parts itself, because that will take care of itself as long as you can recruit and retain the best.
It's a great point, Shantanu, which reminds me, U.S. office occupancy actually fell last week. We're back to 39.5, and now a lot of that is spring vacation, but it sounds like you're going to have to find ways to unlock that puzzle in given the current dynamic, barring some complete collapse of the labor market.
Carl, we're trying. And, to your point, we really have to make it something that is attractive for people to come back rather than mandate. I think a lot of companies have mandated you need to be back in the office and frankly have seen less success. And so what we've done is we've said, we're open for business. We're trying to get people back in for collaborative sessions. I'm in the office 3 days a week, and there's nothing like, frankly, seeing the energy of people when you're in the office with them. But surprisingly, it's actually the younger generation that has been so accustomed to interfacing with companies through a video screen. And, that has to change. And again, I heard both of you, before I came on, talk about how the government also really needs to talk about, things are relatively back to normal. Science has won in terms of the vaccines and the medicines that exist. But we're all struggling a little bit with how do you provide not just one time, but constant reinforcement about why it's better to be in the office, whether it's for culture or frankly for people's career. Because if you're not in the room, so to speak, when it happens, I don't know how you get the mentorship, and I don't know how you continue to grow people's careers.
Could not agree more. Now, I hate to be mundane again, just because the stock is down, though. Keith Weiss asked a good question in the conference call, which is talking about how you're not giving full-year guidance. Can you reiterate on the show the full-year guidance that you gave 3 months ago? Because I just want to be sure that people understand they're selling the stock perhaps for no reason whatsoever.
Jim, what we said was it's early in the quarter. It's early in the year. And so we certainly gave them color as it relates to what's happening in the business. We talked about the acceleration that we expect to see. And again, as I mentioned, you have to look at the seasonal cadence and the rhythm of the numbers as it relates to what happened in the quarter a year ago, where we saw the reemergence of the small and medium business. And so, we're not in the process of constantly updating on annual targets. And so we said we're not doing that. But I think we gave a lot of color as it relates to the fundamental strength of the business. The new initiatives, we talked a bunch of the new initiatives in terms of what's happening as it relates to accelerating document productivity and what's happening with signatures and the integration within Acrobat, as I said, well north of 25% year-over-year growth and the strength associated with that. The new initiatives, the 3D work that we're doing as it relates to enabling brands as well as people to get ready for the metaverse. What's happening as it relates to Creative Cloud Express, a new offering, which I think for top of the funnel allows millions of new people to come into the franchise, and just the fundamental strength of the Document Cloud as well as Creative Cloud, because even our Q1 results were ahead of the targets that we did. So I know there's some questions associated with that, but we're not in the business of trying to update it every quarter. Our job is to give all the information that we have in these uncertain environments and continue to execute, which I believe we are.
Well, I agree with you. The stock down 25% seems pretty extreme. Shantanu and Ryan, it is so great that you come on. You never duck us. You always come on, and I agree with you. I mean, it was good. It was a good quarter. Shantanu, thank you so much for coming on to Squawk on the Street.
Thanks for having me, Jim and Carl.
Okay, Shantanu Ryan, chairman and CEO of a very good company whose stock is, you could say, is now 31 times earnings. Maybe that's too high, but I get it. I get it.
How about tonight?
Okay, we've got a couple of, I've been following some companies, newer companies, to try to get a positive story going. I got Holley, which is a very interesting swag company for auto. And then F45, Adam Gilchrist. Yes, people feel that that's a very good workout, but let's find out if the stock's a very good stock.
I still remember when we had them on the floor
Yes,
with
we
Mark
did.
Wahlberg.
Mark Wahlberg, and a lot of people confused me with Mark, and I had to straighten them out. Same people who don't like me on GME, they thought that I was like Mark. Who knows? You never know. What a show.
It was
Covered
good.
a lot of ground.
We chopped
We
some
should
wood.
be weaker ahead of a NATO meeting. Come on.
We'll see you tonight. Mad Money, 6 p.m. Eastern Time. Good Wednesday morning, everybody. Welcome to another hour of Squawk on the Street. I'm Carl Quintanilla with Morgan Brennan. David Faber has the morning off. We did get to 4,500 yesterday, but giving some back this morning. Worst open for the Dow in about 2 weeks. Got some economic data to start the hour. Rick Santelli's got it. Hey, Rick.
Yes, new home sales for the month of February, Carl, expecting a number around 810,000, a bit light here, 772,000 seasonally adjusted annualized units, follows a subtle downward revision to last month's 801,000. That becomes 788,000. Listen, it's definitely a bit of a miss, but it's not that bad of a number. Consider it comps to November when we were at 749,000. If you look at October last year, which was the low for the year, it was 667,000. So definitely well above that. And do understand, interest rates did the bulk of their big skyscraper rise in the month of March. This is a February number, so we want to make that clear. And also, we got to talk about fence jumpers. Many sitting on the fence seeing rates move higher are probably going to be making a decision rather quickly. Most likely will show up in next month's numbers. But to really dig down, nobody better to do that than Diana Olick. Diana?
Well, Rick, I'm going to disagree with you just a little bit on the mortgage rates because we did see rates start to move higher in January and then more sharply in February. These new home sales numbers are based on signed contracts. That is, people out shopping for homes in February and then signing a contract with home builders. And we did see rates move up 25 basis points in January and then even more in February, of course. So we went from 3.68 on the 30-year fixed in February to 3.9%. Now, of course, we know we're at 4.72%. So we will see these numbers really be affected in the coming months. But this, I believe, is the beginning. Also, you got to note the home price, median price, $400,600. That's up 10.6% year over year. So the builders are really piling on the costs. They are pushing through their higher costs for land, labor, materials, inflation. And that is going to hit affordability in the coming months as well. So not surprising that home sales fell 6.2%. And we're seeing the month supply move higher at 6.3 months supply for the builders. Compare that to less than a 2-month supply for existing home sales. So this is a pretty big disappointment, but you are definitely seeing those rising mortgage rates now factoring into the housing market. Morgan, back to you.
Diana Olick, thank you. We are 30 minutes into the trading session. Here are 3 big movers that we're watching this morning, starting with Adobe. Those shares sliding despite beating on earnings. The tech company cutting its forecast for a key subscription revenue measure. Also expecting a $75 million hit from existing business in Russia and Belarus. You can see those shares are down 8% right now. General Mills reporting a beat, raising its full-year outlook on strength and demand and prices. Company behind Cheerios and Betty Crocker Cake Mix saying its demand for food at home continues to be elevated. Those shares are up 5%. Plus, Poshmark plunging. The operator of a new and used clothing marketplace giving weaker than expected current quarter revenue guidance. That stock's down about 1.5% right now. It's down about 20% year to date. Turning to the broader markets where it is a lot of red, all the major averages under pressure this morning. The Nasdaq down about 1.1%. The S&P is down about 0.75%. 44.79 is the level there. And the Dow down about 250 points, all being led lower by tech and consumer discretionary. We're going to bring in our market panel, Fidelity Investments Director of Global Macro, Urian Timmer, and Truist Securities Global Head of Internet Research, Yusuf Scully. Good morning to you both. Urian, I'll start with you. I mean, we had that FOMC meeting a week ago. Chair Powell was much more hawkish. The expectations coming out of that meeting were more hawkish. And since then, the Fed speak has continued to get more hawkish. And yet, at least until today, we did see equities rally. Your take on this dynamic within stocks and the markets right now, especially as we do see the bond market signaling a very different story than equities?
Well, good morning. So the Fed certainly has continued to move the goalposts, right? So first it was going to be a terminal point at around 2%, then it moved to 2.25. Now we're at 2.75. And I've always, maintained that I don't think it matters whether the Fed went 25 or 50 in March or whether it went 4 times or 7 times in 2022. What matters is where the cycle ends. And until very recently, and just the last few weeks ago, the market always believed that the Fed would end around 2%. And, if you have, even if inflation moderates to, let's say, 4% from 7%, that would still leave the Fed very, very accommodative in real terms. And that doesn't really square with, the inflation numbers and the Fed's obviously intent to tame that inflation. So the Fed is moving the goalposts, which makes sense. But what the market is doing, it's agreeing with the Fed. You look at Fed funds or LIBOR curve or OIS swaps, they're all going to 2.75 now in the next year or two. But then you're starting to see rate cuts priced in. And at this point, we're pricing in 2 rate cuts after that 2.75. So I wonder if the market is looking through even a more hawkish Fed, maybe under the belief, whether it's correct or incorrect, that the Fed will indeed slay the inflation beast and then start to ease after that, and maybe the market finds some comfort in that.
So just to dig into that a little bit deeper, Urian, I mean, we are seeing this tug of war between bulls and bears right now in the market, and it's not necessarily clear what the narrative is. Where do you fall, and what does that mean in terms of where you'd be putting money to work? I think that early low when Russia invaded the Ukraine at 41.15 on the S&P, that was a major impulse low, and I think that low will probably hold. I think the main issue for the market is a valuation derating, right? The PE ratio, the price was down about 15% at that low. The PE ratio was down about 25%, and even like the free cash flow yield is up to 4.3% now, which is pretty good. But as often happens during these periods of Fed tightening, and we certainly saw that in 1994, just to dust off the old Greenspan playbook, is that the market, just sits in a holding pattern for, possibly 6 to 12 months. And what we're seeing right now is something very interesting, that as I look at a lot at the discounted cash flow model, which plugs in earnings growth, which continue to grow. So that's a very good piece of news there. Earnings growth is expected to be up 10% this year, and that number is holding in pretty firm. But what's happening is, of course, the risk-free rate, the 10-year yield, is soaring to 2.4%, and that should bring the discount rate up for the DCF model, bringing down the fair value for the market. And I have downside risk potentially to about 3,800 if that were to come to pass. But what's happening so far is that the equity risk premium is completely offsetting the rise in the 10-year yield. And as a result, the market is kind of staying in balance. Okay. Yusuf, I want to bring you into this conversation. I mean, you oversee internet and media research at Truist. We have seen these rising treasury yields. I realize maybe the 10 years come off a little bit in today's trading session so far, but we're still trading near multi-year highs. Tech has been under pressure. The Nasdaq's been the underperformer. It's still down something like 10.5% year to date. Do you see opportunity here, and how do you navigate this if rates are going to continue to rise?
Yeah, thanks, Morgan. We absolutely see plenty of opportunity. So if you step back and look at the group, the Internet and Digital Media Group, that is, so relative to your 10% decline in NASDAQ, we're actually down about 20% year to date and about 35% in the trailing 12 months. So my argument is, while it's true that growth stocks tend to come under a lot of pressure in a rising rates environment, I think we've already seen the bulk of it. There may be some more to go, but generally, I think we've seen the bulk of it, especially that when you look at the fundamentals of the group, fundamentals really continue to improve. Yes, we have some tough comps because of COVID. Yes, we have some tough comps in the advertising, digital advertising space around IDFA, et cetera. But channel checks so far for January, February show that utilities types of companies like Google or Alphabet continue to do really well. Amazon continues to do really well. Social may be under a little more pressure because of IDFA. And then what we're recommending is people look beyond Q1 and Q2 and start looking at the second half of the year when comps get easier, and hopefully we'll get some sort of resolution around the military conflict, which is more of a headline risk. It doesn't really impact the fundamentals because exposure of my group to that part of the world is de minimis, is 1 to 2%. Valuations are attractive. Fundamentals are still very strong.
Okay, so given your take on this, Yusuf, top names, top buys, what you'd be buying here at these levels?
So we have 3 groups. First group is what I call utilities. There we have Alphabet and Amazon. Second group is the group where you may get a lot more beta, if you will. Those are SMITs, but that have consistently beaten and raised. That's Trade Desk, DoorDash, and a small cap called Double Verify. And the last are the reopening names. And for those, we like Uber, Lyft, and a small company called Eventbrite.
All right, Yusuf and Urian, thank you for joining us today to kick off the hour.
Thank you.
Meantime, you're looking at a live shot of Senate Commerce this morning, holding a hearing with the CEOs of Intel, Micron, Lam Research, and PACCAR. The chip giants making the case for that $52 billion in U.S. subsidies for chip manufacturing. Intel's Pat Gelsinger did join Squawk Box earlier this morning ahead of the hearing.
We're either going to invest in this industry, now to see it rebuild, or we're going to decline. And today, 12% in the U.S., half of that's Intel. This is precarious. And that's part of the reason for my urgency and passion on this topic right now, because I fear if it starts dropping below 10% very far, we might never recover, and we will have a permanent dependence on Asia and other parts of the world that are just geopolitically unstable for the long term. We must act now.
Morgan, he cited Andy Grove, saying we're at an inflection point in terms of our reliance on foreign semiconductors. You just look at some of the color out of NVIDIA and that event yesterday, and just sort of the nature of the chips that will be necessary to employ LiDAR and cameras, just on autos alone, not to mention data center and gaming and crypto and everything else. Maybe we'll see whether or not the Senate can fall more in line with the House on this one.
It's incredible because we have been talking about this specific piece of legislation since last spring, and it's specifically $52 billion in chip subsidies. It's part of the CHIPS Act. Part of the issue here is the fact that you have House and Senate versions of legislation that have been passed. They're pretty much in line where the semiconductors are concerned, but there are other aspects of boosting U.S. competitiveness with China within these bills that are differing. It seems like a no-brainer. It seems like a bipartisan, effort in terms of this issue and how important it is not only to supply chains and to U.S. manufacturing, but also to national security. So we'll see what comes out of this testimony today. It's also worth noting, Carl, it's not just Intel and Micron, but it's also those manufacturers of the equipment like Lam Research, which I believe is also testifying today, that are going to be crucial to this process. And when we talk about supply chain bottlenecks and everything else, being able to get that equipment to actually be able to make these investments and make these chips is going to be just as important to that process longer term as well.
Yeah, that's true. We talk about how sometimes legislators don't act until the fire's in the living room, and we already know about the dependence, so we'll see how forward-looking they may be in the weeks to come.
All right, well, we're going to head to a quick break now, and here is a look at our roadmap for the rest of the hour, including an exclusive interview with Marguerite Vestager, talking everything from the European economy amid Russia-Ukraine conflict, as well as her latest efforts to regulate big tech.
Plus, Jamie Dimon's call for a new Marshall Plan, pushing the Biden administration to develop more domestic gas and other energy resources. We've got details on that.
And call it March meme madness. GameStop, AMC, Robinhood, all spiking again this week. We got a lot more Squawk in the Street straight ahead. Don't go anywhere.
The European Commission adopting a, quote, temporary crisis framework to mitigate the European economy from effects of the Russia-Ukraine conflict. That's on the heels of talks to bring those soaring energy and gas prices back to earth. Joining us to discuss all of that and more in a CNBC exclusive this morning is Margaret Vestager, the Executive Vice President of the European Commission. It is great to see you again. Thank you so much for the time.
It's great to be here.
I wonder if you can sort of remind our viewers what this framework is. It's something you've used in the past, really in financial crises, and what it allows companies to draw on should the need arise.
Yes, we have done this before. During the pandemic, member states asked businesses to close their doors, customers to stay at home. Obviously, there was a responsibility to make sure that these businesses could hibernate until coming back in the recovery. Now, with the energy crisis and the war in Ukraine, we see energy prices soar, producing fertilizer, producing a number of things. Things have really gone up. And here, the temporary crisis framework will allow member states to support businesses in need to give at least partly relief from high energy prices.
Is this something that you had held off on implementing until you realized that this price readjustment was going to be something that would not be short term?
No, we have been preparing this for quite some time. Of course, late autumn, no one could foresee that this would be a more permanent feature. But once we had the invasion by the Russians in Ukraine and the war starting there, obviously the high prices will remain for us for much longer.
What is the thinking then about the ability of Europe as a whole to wean themselves from Russian supply? A lot of critics in this country believe that the pendulum just swung too far for a variety of reasons, and that some of these goals of reducing reliance, say in a year, are still too aspirational.
Well, we discussed this intensively because obviously it's a vulnerability to be dependent on Russian fossil fuel. We don't have the luxury of being self-sufficient in energy. So we're accelerating with an unforeseen pace, diversifying the gas supply, but also accelerating the implementation of energy efficiency measures and the rollout of renewable energy sources in order to meet very, very ambitious targets to get out of the dependency.
It's Morgan. Do we yet know how much Europe could be impacted by these sanctions that have been implemented so far?
No, that cannot be set yet. Europe was on a track for, on average, 4% growth. Then the kick-in of the energy crisis would give or take half a percentage of those 4%. But remains to be seen how the war will impact us. It is, of course, both a risk of counter sanctions from the Russian side, but also what comes from the fact that Ukraine cannot export to us to the same degree as they did before, not only to Europe, but also to a number of other neighboring countries. And for them, there may be also risk when it comes to food security. In Europe itself, it's more a question about the affordability of food.
How great is the risk of recession here? I mean, presumably, if you're rolling out something like the temporary crisis framework, you're trying to counter some of the worst impacts of these sanctions and of this conflict. Is it enough?
Well, we will stay vigilant to see if this is enough. At the same time, we are rolling out our recovery and resilience facility, which is an unprecedented sort of common financing effort. So we do think that it is possible to get through this, but obviously we will pay very, very close attention. The important thing for us right now and right here is to stand by Ukraine and, of course, to stand by the many, many refugees who comes to Europe. I think the latest number I heard was 3.8 million people who have come within the last 4 weeks. So first things first, human conditions for the people who have to flee.
Yeah, we're trying our best to keep that front and center in our minds, even though a lot of business decisions sort of lurk in the background. I wonder, I hope this isn't a dumb question, but does any of the framework color your approach to antitrust? Does anything on that front change, given how much the world has changed in the past 28 days?
Well, that's an excellent question, actually, because some businesses, they may have to cooperate in order to serve the needs of the market in the best possible way. And here, of course, we stand absolutely ready as a priority effort to give comfort, to make sure that businesses do not fear antitrust repercussions if they cooperate on issues that will be helpful in the situation that we're in. Of course, we are still vigilant to see if someone take advantage of a horrible, horrible situation on ground. So we have this double approach to give comfort where it's needed and constructive, but also to make sure that no one takes illegal benefit from a situation that is really awful for many, many, many people.
Finally, obviously, the whole world is hoping for something positive to come out of these peace negotiations. But if there were, theoretically, how quickly could some of this temporary framework be peeled back?
Oh, it can be peeled back very fast because it is indeed temporary. But we are very cautious. Things are on ground right now. Of course, one should hope for peace and work for peace, but one should also help the Ukrainians in the fight that they're in right now with the sanctions, with the food and humanitarian assistance and other assistance coming into Ukraine.
Madam Vestager, always good to get your guidance and color on some of these new policies. Appreciate it very much. Look forward to next time. Thank you.
Thank you. Likewise.
As we head to break, a look at the biggest laggards on the Dow. Led lower by Salesforce, down 3.5%. Also Home Depot, Boeing, American Express, and Visa. We're back in 2. Welcome back to Squawk on the Street. It's now time for our ETF Spotlight. It has been quite a run for commodities in general and specifically for metals. So we're taking a look at the mining and metals ETF, ticker XME. It's up almost 1% right now, on pace for its second month in the green after gaining more than 25% in February as markets eye the conflict in Ukraine and the impact that's having on supply for many of these materials. It's now up 45% just since February 1st. Top holdings that have been on the move, some names with huge gains of 30% or more just in March: Ryerson, Piedmont Lithium, Peabody Energy, and U.S. Steel. We're going to continue to watch that story. Squawk on the Street is back in a moment.
Welcome back. I'm Rahel Solomon, and here is your CNBC News update at this hour. President Biden sees what he called a real threat that Russia will use chemical weapons in Ukraine. He made the brief comment in response to a question as he left the White House this morning. Biden is heading to Europe for talks with U.S. allies, including a meeting with NATO leaders in Brussels. Chinese investigators have found one of two black box devices in the wreckage of the passenger jet that crashed 2 days ago. The cockpit voice recorder, which is actually painted orange for visibility, is badly damaged, but an official says that the device's data storage units, they appear to be relatively complete. And in London, around 200 people have been evacuated from the London Aquatic Centre. Officials say a high quantity chlorine gas was released there due to a chemical reaction. Ambulance crews did treat several people who were having trouble breathing this morning. The swimming pool is part of the large sports complex that hosted the 2012 Olympic Games. Carl, I'll send it back to you.
Rahel, thank you very much. Dow's down about 200 this morning, about an hour into trading here as we continue to flirt a little bit below the 4,500 level, which we exceeded for the first time yesterday, first time since February 11th. Our Bob Pisani has more on what's moving today. Morning, Bob.
Good morning, Carl. Down all morning, but remember, the S&P up 5 of the last 7 days, but so still a nice win streak going on in the short term. Sectors today, well, we're back on the commodities is the big play. Oil's at 114, so energy stocks are up, a lot of new highs there. We see metal stocks doing well here, and banks, ARC Innovation to the downside, tech to the downside as well. New highs, you know, it's the same as the old highs. Every day you see the oil stocks, you see Devon, you see Occidental hitting new highs, and you see a small smattering of material names like Mosaic and Nucor on the new high list. This really hasn't changed much at all in the last few days. We had a miss on home sales. That's kind of interesting. Maybe some signs of cooling demand on higher rates and the higher prices. Homes prices up 10% year over year. The home builders are down, but they've had a not great year at all. In fact, they've dramatically underperformed. Most of these stocks are 20, 25% below where they were at the start of the year, underperforming overall. So the market's got a huge host of issues it's dealing with. The problem is it can't figure out a coherent narrative because the two things that matter most, interest rates and oil, have a potential enormous range of outcomes. That's why you're seeing all this uncertainty and this sawtooth trading patterns. So the issue for the Fed is, can it control inflation without excessive demand destruction? Half the market loves the fact that the Fed's talking tough. The other half are terrified they're going to induce a dramatic slowdown and possibly a recession. And nobody can quite agree on whether they can thread that needle. So one trader quipped yesterday, what am I doing? Am I catching a falling knife? Or am I grabbing a rocket taking off? I don't really know. And that's the heart of the confusion that the market has. So if you want to know about the Fed and the stocks and the relationship, there's a narrative floating around that it's going to be very difficult to get to new highs at this point because the Fed wants to slow inflation. Everybody agrees on that one point. But if we get rallies from here, if we move towards anywhere near a new high, that's going to create a wealth effect overall, and that's going to fuel inflation. The Fed's not going to be happy with that. So rallies will make the Fed more comfortable hiking rates in the future. That makes it really hard to keep the rallies going. So several traders have said to me in the last few days, we used to have this Fed put. The Fed would act if the market dropped too much. What if we now have sort of the opposite? Instead of a Fed put on stocks, we have a sort of a Fed ceiling, kind of like a Fed collar. Morgan, and I'm referring to an options phrase where you're protecting on the downside, but you're also protecting on the upside. So maybe there's still a Fed put. If things drop a lot, the Fed might still slow down. But if it rallies, the Fed will feel much more comfortable raising rates. So this is what I mean when this is an idea being floated around, that there's a bit of a ceiling now on how far stocks can go. If you assume the Fed is very, very pressed to fight inflation, higher stock prices implies higher inflation potentially because the wealth effect goes up. It gets complicated, Morgan, but it makes some sense. And it's one of the big trader fears out there right now. Morgan, back to you.
It is certainly some good nuance. Bob Pisani, thank you. Well, speaking of inflation, crude oil prices rallying today, helped by a disruption in supply. Russia had warned earlier in the week about disruption to the Caspian Pipeline Consortium, which has been damaged by storms. Exports from the pipeline stopped today. Officials say repairs will take about 1.5 months. Those exports represent about 1% of world oil production. The rise also comes as EU leaders remain divided on whether to ban Russian oil imports, something we're expecting more detail about as the week unfolds and as inventories drop in the U.S. Additionally, figures out just moments ago from the Energy Department here show weekly inventories are down 2.5 million barrels. Analysts had expected a drop of just 350,000 barrels. You can see WTI right now is trading around $114 a barrel. Jamie Dimon, meantime, pushing the Biden administration for an energy Marshall Plan to reduce reliance on Russian energy and to develop more domestic resources. And our Leslie Picker has more on this. Hi, Leslie.
Hey, Morgan, just a quick history reminder here. The Marshall Plan provided billions of dollars in aid to Western Europe to prevent the spread of communism in the aftermath of World War II. Dimon wants to modernize this idea in an effort to thwart Europe's reliance on Russian energy amid the invasion of Ukraine. The chairman and CEO of JP Morgan met with Biden and members of his administration in a closed-door meeting Monday with 15 other top executives. According to a source close to the matter, Dimon presented a multi-part plan that would require the government to be more aggressive on energy security. The plan includes investing in more liquefied natural gas facilities in Europe and in new technology like hydrogen and carbon capture technology. That part of the plan was reported earlier by Axios. I've also learned that Dimon wants the government to streamline investments for renewable energy. He wants, for example, a faster permitting system for things like wind farms. Throughout the years, I've heard many complaints from other infrastructure investors about how much red tape there is to obtain these permits, which of course bogged down the process of building them. Now, what's unclear is who would pay for this plan. I'm told Dimon believes the government should play a leading role here. According to Preqin estimates, the top 10 alternative and infrastructure investors are sitting on about $90 billion in dry powder. KKR just last week closed a $17 billion infrastructure fund, its largest ever. So the key question is how quickly governments or public-private partnerships can actually act here. putting money to work to effectuate the kind of change that Diamond is seeking, guys.
It's interesting because just earlier in the show, we were talking about what could be a potential public-private partnership or the emergence of public-private partnerships with funding for the semiconductor industry. And now we're having that conversation being floated by Jamie Dimon, where the energy sector is concerned. Do we know what the appetite or the response at all has been so far from this administration where a concept like this is concerned?
I think they would be supportive. Obviously, the key question here, and this is something that Diamond's been pushing, is this idea of in the short term, the focus should really be on energy security. In the long term, he is of the mindset, which of course is in alignment with the Biden administration, that the long-term focus should still be on a low carbon economy and trying to achieve that through these types of investments. Now, I think the question is going to be how exactly you square those two, because, it seems like there's an infinite amount of investment and dollars out there, especially in terms of these infrastructure funds, but it's not. It's finite. And so how you deploy that capital to achieve both the short-term and long-term goals is a really important question. And I think that's one that the administration is going to need to keep up these kind of dialogues with CEOs to achieve. Carl.
Certainly something that the street would be looking for. Leslie, thank you. Leslie Picker. Meantime, live shot of the CEOs of 4 major chip companies, including Micron and Intel, testifying before Senate Commerce on manufacturing in the U.S., trying to push support for manufacturing subsidies. Our Elon Moy is in D.C. with the latest. Morning, Elon.
Well, good morning, Carl. That hearing is really just getting underway. The CEOs starting to wrap up their opening statements. Expect them to make the argument today that their industry needs that $52 billion in funding from Congress now. Remember that the money was authorized back in 2020, and the Senate passed its version of the bill last year. Now they say the need has grown even greater. Here's a statement from Micron CEO Sanjay Mehrotra in his opening remarks. He said that COVID-19 and the ongoing conflict in Russia and Ukraine have underscored the fragility of our supply chain and the national security and economic risk of a decline in chip manufacturing in the U.S. In this environment, it is increasingly urgent that Congress move forward in efforts to reconcile and pass an innovation and competition bill. Now, formal negotiations over the House and Senate versions of that bill are just getting underway. I spoke with the chairwoman of the committee, Senator Maria Cantwell, and she told me that they hope to pass this bill in May.
We got to get on the production end of it. We're sending the signal. We're sending the signal to the market that we want to see this investment. We want to help grow this sector, but we also want the United States of America to be a leader in this type of next generation technology. And now we're falling behind.
Well, guys, this hearing is expected to last about another hour or an hour and a half. I'll hop back in the room and let you know what else they say. Back over to you.
All right, Elon, appreciate that. Elon Moy in Washington. Speaking of chips, big show coming up this morning on Tech Check. Don't miss an interview with the CEO of Global Foundries. It's coming up at the top of the hour. In the meantime, Dow trying to shave some of the early morning losses. We're down 216.
Welcome back to Squawk on the Street. Meme stocks making a big comeback this week. GameStop and AMC both rallying again today. GameStop's up about 12%, AMC up about 4%. Our Frank Holland is watching the moves. Frank.
Hey there, Maureen. As you mentioned, GameStop shares up double digits since Chairman Ryan Cohen announced he was buying 100,000 additional shares, raising his stake to 12% of the company. Cohen's famously said he would turn the the gaming retailer into an online seller, now in an NFT marketplace. This tweet where Cohen said he put his money where his mouth is, racking up the likes and the retweets. But GameStop and the two other so-called OG meme stocks, Tesla and AMC, they're on a bit of a tear before that buy. S3 partners out with research saying retail traders have seized on shorting those stocks, saying in part in a note today, the short squeezes we saw in each of these stocks today helped their stock prices trend higher. If the stocks continue to climb or at least hold these levels, we should see the squeezes continue and more short covering. In recent weeks, there's also been a rise of technical analysis on Wall Street bets, and traders there digging deeper into fundamentals of all stocks, including the meme names, according to research from Thinkum co-founder Justin Zen.
There are some individuals on there that can do due diligence as good as any bank can. And when you have a lot of these people, right, if you can take the best of a very large group of people and you can kind of put those insights in one place, that's extremely powerful. And that is the power of Wall Street bets.
And the high volume trading for GameStop and AMC also continuing today. We just checked a minute ago. GameStop's already at 300% of its 30-day volume. AMC over 100% of its 30-day volume. We'll continue to watch this all day. Back over to y'all.
Wow, just like old times, Frank. Thank you, Frank Holland. In the meantime, as we go to break, Pfizer under a bit of pressure again today as the company launches this voluntary recall of its blood pressure medicine, saying several lots of the drug had elevated levels of a carcinogen, down about 0.2%, still not below yesterday's intraday low. We'll be right back. Stay with us.
Welcome back to Squawk on the Street. Of the largest 3,000 public U.S. companies, a disproportionate few, only 20%, or 1 in 5 of board members, are female. That's according to a recent NPR report. Diving into equity, representation, and diversity in corporate America. Joining us now to continue our equity and opportunity coverage, the Wharton School Dean, Erica James, the first woman and person of color appointed as dean in the Wharton School's history. Dean James, thanks for being with us this morning. This has been an area of expertise for you for quite some time, and we just cited that stat. But I guess just lay out for us where we are in this process of moving towards gender diversity when it comes to corporate America.
Well, thank you for having me. It's a pleasure to be here. We are in the midst of an evolution, not quite revolution, although there have been significant changes and suggestions and legal mandates to ensure that women have equal access and opportunity to participate in all sectors of society, particularly the boardroom. In some states, requiring a certain percentage of boards to have percentage of women on their boards, but also just in terms of the pipeline of leadership talent that's coming into organizations. There were some studies maybe 5 or 10 years ago that said if we continue at the rate of change that we are currently experiencing, it will take another 30 or more years to have gender parity. So there's a long way to go, but I think the focus and the attention and intention that we're seeing in many companies right now are helping to make a difference that I believe will speed that up somewhat.
How do we bolster that pipeline, and how do we do it quickly and, I guess, effectively?
Well, we bolster the pipeline in large part by getting more people engaged in understanding what the barriers are and what are the impediments for young people, women in high school age experiences, women who are in college, women who are starting their careers. When we help provide them the resources and help them understand the broad swath of options they have available in their careers, that's going to facilitate the pipeline. Then we also have to look at the organizational structures themselves that make it challenging for women and young people to succeed. We spend a lot of time focusing on the D in DE&I, the diversity, which is the representation, getting people into schools, getting people into companies. But we spend less time focusing on the E and the I. How are we making our environments equitable so that everyone has equal access to participate and compete? And how are we making the environment one that is inclusive, where people feel like they belong and are actively contributing to that organization and feel like they can thrive and be their best self?
Dean James, I'm wondering if you can elaborate on some of these amazing metrics that look at basically how much females need to outperform, say, on their GPA to essentially receive the same feedback than, say, a white male for the same job. It's fascinating.
It is fascinating, it's disturbing, but it's also nothing that's new. When I was growing up, my parents and many parents of girls and people of color told them you have to be twice as good to get half as much. That hasn't changed that much, and certainly the psyche that young people have who recognize the pressure and the responsibility that they have to really demonstrate their competence is different for young women than it is for men in many cases. One of the things that we're doing at the Wharton School is really leveraging the analytics expertise that we have to understand what are the factors that move the needle in understanding who will be successful in the Wharton classroom or who will be successful in their first 5 years in a career. And we're finding some pretty interesting things, which we would not have known if we had not done the deep dive in understanding analytics. For example, we oftentimes assume that how you score on standardized testing is the primary metric that will determine success. And we have found that it's some aspects of the standardized testing, not necessarily the quantitative ones, that are most compelling. We find that interpersonal skills, the ability to communicate, is more likely to determine success in our program than some of the other factors. I think unpacking and really doing a deep dive in those areas will help us alleviate some of the barriers that many young people, women in particular, have in accessing education.
It is a crucial conversation. We appreciate you joining us to have it, Dean James.
Thank you.
Get a check on the markets on this Wednesday morning, as we are still just shy of 4,500 after crossing that level yesterday. Dow giving back some of yesterday's gains, down 238. We will be right back. Stay with us.
Welcome back. As the Russian invasion of Ukraine affects some space operations, commercial space companies have stepped in. Case in point, SpaceX rolling out internet service in Ukraine, sending shipments of Starlink satellite kits shortly after Russia's invasion began. President and COO Gwen Shotwell discussing the Starlink mega constellation's broadband service at the Satellite 2022 conference in D.C. yesterday afternoon.
We were working with Ukraine just like we're working with almost every other country to get rights to provide service to folks in country. And we were very close to having the final document signed, but we weren't quite there until they tweeted at my boss, and that was our permission to provide capability. Frankly, I'm proud that we were able to provide terminals to folks in Ukraine. It's been enormously helpful, I think, to ensure people are still communicating.
That boss, of course, being Elon Musk, who had those Starlink terminals sent to Ukraine after a Ukrainian official asked him for help as Russia's attacks disrupted some internet service in the country, or believed to have disrupted internet service in the country. Shotwell telling CNBC that SpaceX has sent, quote, thousands of the kits to Ukraine, noting that most of the funding for them has come from private sources, but that France has helped and possibly Poland. You can read more about that on CNBC.com. Meantime, the space sector has been impacted by Russia's invasion in other ways as well. OneWeb, another low Earth orbit satellite internet provider, striking a deal just earlier this week with SpaceX for future launches to complete its own constellation, replacing the Russian Soyuz rockets that OneWeb had been using. And speaking of satellite operators and Starlink rivals, Viasat weighing in on the future of the space industry and geopolitical strife as well from that conference. It's something I did discuss with Viasat chairman and co-founder Mark Dankberg on the latest episode of my podcast, Manifest Space, in which we do talk about the competitive landscape, but also the recent cyber attack on the company's services in Europe. So you can check that out anywhere you get your podcasts. In the meantime, we're just going to get a check on the markets as we wrap up here, because oil is trading higher, both WTI and crude, and that has energy stocks higher by about 2% for the S&P. Other than that, consumer discretionary hugging near the flat line, everything else in the red. All the major averages are lower right now, though, off lows of the session. The S&P is down about 0.5%. 44.88 is the level there. The Dow Industrials are down about 258 points, and the NASDAQ is down about 0.4%. Adobe down about 8%, and tech in general under pressure. That's going to do it for Squawk on the Street. Tech Check starts now.
Good Wednesday morning. Welcome to Tech Check. I'm Carl Quintanilla with Deirdre Bosa and John Fort. Today, from oversold to overbought, software and FANG have both rallied hard off of those mid-March lows, losing a little ground today. Where are we in the market correction for tech? Plus, those chip makers testifying on the Hill as the U.S. looks to boost domestic production. We'll talk to Global Foundry CEO Tom Caulfield this hour. And then Adobe shares falling after reporting results. Last year's shakiness is extending into 22. Should investors be concerned about the outlook, Dee?
Lots to get to, Carl, but we're going to start in Washington as top chip execs testify before Congress, looking to gather support for increased funding for domestic production. Elon Moy has been monitoring the hearing and has more. Elon, what are we hearing so far?
Well, Deirdre, so far this hearing has been part education and part advocacy. Intel CEO Pat Gelsinger even bought some of his latest 4-nanometer technology chips to show Congress. He said that every aspect of human life is becoming digital, and semiconductors are the foundation of that digital life. Meanwhile, Micron CEO Sanjay Mehrotra tried to argue that the U.S. is already risking falling behind on that investment in next-generation technology.
I hope to leave you with one key takeaway today. The U.S. government needs to level the playing field and create incentives to support investment in domestic semiconductor manufacturing facilities. Nearly every other country that has a significant share of semiconductor manufacturing offers major government incentives, including grants and tax breaks. Our federal government does not. Funding under the CHIPS Act and a refundable investment tax credit are both needed to ensure the development and continued visibility of a scaled-up industrial base and to guarantee the domestic supply of semiconductors.
Now, there was a somewhat testy exchange between Republican Senator Ron Johnson with Intel CEO Pat Gelsinger, in which Johnson questioned the need for industrial policy, but by and large, there is bipartisan support for this $52 billion in funding to the industry. Really, the holdup around this bill, guys, has been around all of the other pieces that are going into this broader innovation package. John.
All right. Elon, thank you. Meanwhile, I did have a chance to speak with Intel CEO Pat Gelsinger earlier this morning ahead of the hearing. A big part of his message to Congress is you got to hurry up.
We're either going to invest in this industry, now to see it rebuild, or we're going to decline. And today, 12% in the U.S., half of that's Intel. This is precarious. And that's part of the reason for my urgency and passion on this topic right now, because I fear if it starts dropping below 10% very far, we might never recover, and we will have a permanent dependence on Asia and other parts of the world that are just geopolitically unstable for the long term. We must act now.
For more on this and the domestic chip manufacturing push, Global Foundry CEO Thomas Caulfield. Thomas, good to see you. I want to start a bit broader, though, given the times that we're in. About 15% of your revenue is from Europe. How, if at all, do you expect Russia's invasion of Ukraine and the resulting inflation and sanctions to affect European demand?
Well, I don't see it affecting European demand at all. I think the bigger issue is, we have to really be methodical and watch our supply chain very closely, mostly on logistics and moving these very specialized chemicals and gases in and out of our facility. We have not seen any softening of demand in Europe because of this unfortunate crisis.
Yes, indeed. Well, that is encouraging. Now, how does this geopolitical situation, though, impact the case for more domestic chip manufacturing in the U.S.?
Look, I think it's all about awareness. Semiconductors has been insidious. It's so fundamental to the world economy, to very human existence and how we connect and engage. It wasn't until there was a shortage where there were just not enough semiconductors being manufactured that we became very aware as a society how important to the very fabric of our economy semiconductors are. And this crisis just adds to that sense of urgency and the necessity to make sure that we as an industry invest to create that capacity, but invest in the right regions of the world to get better supply chain security and balance.
Hey, Thomas, Deirdre, good morning to you. I'm curious as to how come you're not in Congress today, especially when the manufacturing, the foundry side of this is so critical, and you're in a unique position to speak to this already being there. Are you in communication with lawmakers? What kind of support do you hope for your company?
Well, for one, I'm in Washington today myself. I'll be, after this meeting, heading to the White House to meet with some of President Biden's staff on this very topic. I think you're absolutely right. As a foundry, we serve a very broad range of customers and technologies. And we are, the manufacturer for so many important U.S. companies and other companies around the world in creating capacity. It's our job, once this CHIPS bill is funded, to do our part to continue our expansion in the U.S. We have a huge facility in upstate New York, another facility in Burlington, Vermont, a smaller facility just 40 miles north of New York City, and we'll be looking to expand our footprint with the right economic model that the CHIPS bill will provide to our company.
Hey, Tom, we're looking at a map of some of the U.S. locations of manufacturing. I mean, we're obviously watching Ohio now, Arizona especially, Texas. How would you grade at least the early goings of these new announcements, these new manufacturing initiatives? Are there frictions there that we're not aware of, or is it pretty much just a seller's market in terms of putting some shovels in the ground, even though it will take a while for them to get going?
Yeah, let me give you two, I think, really important points. First is, since discussions around the supply chain security and semiconductors, let's say that's a conversation that goes back to the last administration, the rest of the world is really reactive. I would tell you a significant amount of the capacity that's either in flight, meaning a shovel in the ground to create the new facility that eventually have equipment installed to create capacity, or existing facilities that are already in the ground and tools being added. The U.S. is significantly behind in creating that capacity. That's the part of the urgency that you just spoke to Pat Gelsinger about this morning. It's time to act now, or we'll fall further behind. The other thing, for GF's strategy, we believe that for economies of scale and the ability to bring capacity online quicker, it's better to expand existing facilities. And that's where our global footprint is a real advantage to us. We're in Singapore, we're in the US, and in Germany. It's about a year to 18 months faster to bring capacity on at an existing facility, even adding additional factory space, because you could add a few tools to start getting output. When you're in a greenfield expansion, you need a complete complement of equipment to get output, and that could add 12 to 18 months to a schedule. And so our strategy to do this quickly and efficiently is to leverage our global footprint and add capacity at our existing locations. And most importantly, what we announced last summer, once the CHIPS bill is funded, our Fab 8 facility in the capital region of New York.
Tom, the way I'm hearing it, there are kind of three areas that I would point to where the semiconductor industry is looking for policy movement. One is fab incentives. Two is R&D tax credits, which were pulled back, and you're looking to get some of those back. And then three, immigration and workforce preparation. Forgive me if I'm forgetting a broad area, but of those, which would you say could be moved on and most immediately and have the biggest impact?
I think we have to create the manufacturing incentives first and foremost, or we'll fall behind and we'll never catch up. But that goes hand in hand with having the talent. And so we'll need to kind of couple those together, but let's get the funding going and then work on getting the talent. And we can't lose sight of R&D and making sure that gets funded as well. But if you force a pecking order, you have to start with getting the manufacturing, or it doesn't matter what you do in R&D because you can't deliver it to the marketplace. And then talent close behind that.
Tom, very broadly, what is the risk that the politicization of semiconductors actually backfires? Gelsinger talked this morning about the market still being very global and needing to stay that way. And what happens if we start to hear politicians tell companies to prioritize certain chips for certain regions like yours?
Well, I don't think the answer is prioritization. I think the answer is creating the capacity. This industry took 50 years to become a $500 billion business. It's going to double in the next 8 to 10 years. That's a 5x acceleration. We as an industry need to have better economic models to create that capacity, that accelerated CapEx or capital deployment. And that's why regions of the world, governments like the US, customers, manufacturers like GF have to partner together to create the dynamic to create that supply. The zero-sum game here, or the losing game, is to try to do it by allocation rather than fixing the problem and creating the capacity the world needs, society needs, and the world economy needs.
You talk about the risk, the geopolitical risk long-term on supply. Certainly that makes sense in Asia. Is there a sense that even production in, say, Europe still puts the U.S., quote, at risk on a net-net basis?
I don't think so. I think we need a global footprint, because there are other things just besides geopolitical that can happen, and any single points of failures are always risk items for an industry, for a business, for a society. And so getting a more broad-based supply of semiconductors is good. It's good for every company. It's good for society. It's good for the industry.
All right. Thank you, Tom. Tom Caulfield, CEO of Global Foundries.
Thanks for having me on.
Good discussion. Meantime, let's turn to Adobe this morning. Shares are down after reporting Q1 earnings guidance coming in lower than the street expected. CEO Shantanu Narayan did lay part of the blame on the Russia-Ukraine conflict in an interview earlier this morning on Squawk on the Street.
We've stopped all new sales in Russia and Belarus. And in addition to that, because you have a subscription book of business, you do not have the ability to collect payments. So we've actually reduced both the ARR, or the annualized recurring revenue, as well as the revenue for the remaining 3 quarters.
Still posted record revenue on the quarter, but that is back-to-back quarters where the digital media guide comes in below consensus. Long-term chart, obviously up and to the right, up until about November of 2021. And here at 425, John, still not as low as the 407 we got on March 14th. But clearly, we've exited the period where they would just blow away expectations as they were for much of last year.
Well, yes, and expectations rise when you do that. So it's a different kind of bar. But you know, this stock action, it's interesting. I see it as perhaps a warning to investors that European economic impacts from this Russian invasion of Ukraine are not all priced in, because that's so much of how Adobe's numbers in the guide differ from expectations. Not only the digital media ARR guide impacted by Russia-Ukraine, but then the overall European demand situation. A lot of CEOs still saying, I don't see much impact, but when they're actually reporting and having to put out the numbers and having to give guidance, we're starting to hear some impact in Europe, and I think investors should probably pay attention to that.
What if the worry, though, John, is more fundamental? You hear a lot more talk about competition. I mean, you don't want to bet against Shantanu Narayan. I mean, he has turned around the business before, but there's a lot of talk about Canva, which is now a $40 billion business. It's still private. Carl has a lot of room. And even there was a JMP note this morning that says there's a worry that rivals like Canva, another one is Lightricks, are making new inroads among customers. So that may be reflected in some of the weakness that we've seen over the last few months. But again, we'll see what happens. You don't want to bet against Shantanu Narayan. Still to come, Microsoft, the latest cyber attack victim. Then, does Facebook have a user problem? Plus, Ryan Cohen stops the game. Tech Check is just getting started. Time for a gut check. A bit of optimism on the regulatory front from Beijing for Chinese tech giants in recent weeks. But remember that restriction on kids playing video games? That is still having a real impact. Tencent reporting its slowest quarterly revenue growth since going public in 2004. Domestic gaming accounts for over 20% of the company's total revenue. The new regulations on minors' gameplay significantly slowing that growth to only 1%. Tencent has now lost almost $500 billion in market value from its 2021 high. China's tech crackdown continuing to create a roller coaster of volatility for investors. Carl, it feels like you get one thing and then another totally contradictory thing, which makes investors need a stomach for these stocks.
Yeah, it seems to be a function of trading in some of those names. Pretty fascinating. Meantime, cybersecurity coming into focus this week after the president warned we may see an increase in cyber attacks from Russia in retaliation for sanctions. Meantime, Microsoft and Okta both say they've faced their own security breaches from a hacking group called Lapsus. Those stocks are both in the red this morning. Joining us for more on the state of cybersecurity, CrowdStrike's co-founder, Dmitry Alperovich. Dmitry, good to have you back. Thanks for the time this morning.
Thank you.
White House has this habit now of warning us about things that in some cases end up being justified warnings. How acute would you say these concerns are right now?
They're very, very serious. I talked to senior White House officials. They think that there is a lot of probability here that the Russians will retaliate for sanctions. Of course, we've had very good intelligence on everything that Putin would do in the case of the invasion of Ukraine. So there's reason to believe that they have good information here.
We did get word that the FBI had warned that some Russian hackers scanned the networks of at least 5 U.S. energy companies. Do you think the grid is a prime target?
I think there are 2 prime targets here. Certainly, the energy sector is going to be a target given the impact on energy in Russia and the Western companies pulling out of Russia as a result of sanctions and overall pressure. But I think the financial sector is likely to be targeted as well. Most of the sanctions have been on their finance sector, their central bank, their major banks, and I think they're going to respond accordingly.
Dmitry, what's your read on this Lapsus situation and maybe specifically the impact on Okta and Microsoft? Okta seems to have now narrowed down a 300 plus accounts affected that were being touched by the one outside contractor whose laptop got hacked. But how avoidable is that kind of situation? How good a job is the industry doing at providing a detailed response and explanation?
Well, you know, one thing to remember here is that it's not all about nation states. As we talk about Russia, we have to remember there are criminal groups, there are teenagers that are doing this stuff as well. And this Lapsus group is believed to be based out of Latin America, not state-based, and they're able to infiltrate these large companies. And Okta in particular provides authentication, of course, to so many companies, so many enterprises. So it's very concerning, both Okta and Microsoft being impacted by this group. And it just shows you what a capable nation state actor like Russia would be able to do if you've got some teenagers in Latin America, they're able to do this much damage.
Yeah, speaking of sort of other geopolitical threats, of course, the focus is understandably on Russia, but I wonder, is the conflict creating an opening for China? I think there was data that you cited from Centerpoint Research that is seeing an increase in cyber attacks from the country.
Absolutely. The Chinese are still very much interested in stealing intellectual property. We have not seen destructive attacks, but they're still waging essentially economic warfare against us by breaking into companies, stealing their trade secrets, passing it on to their private sector. Huge concern that remains so for so many companies around the country.
So what do you think happens for the clients of a lot of these vendors? Is this a matter of new clients who have yet not thought about this or coming on board? Are existing clients broadening their budgets? I guess financially, what do you think it means for some of these providers?
Well, I think people are going to look very carefully at their vendors. And honestly, even though you have security vendors like Okta getting hacked, the reality is that everyone gets hacked at some point. I coined a phrase many years ago that there are 2 types of companies, those that know that they've been hacked and those that don't yet know, but everyone gets hacked. But what differentiates great companies from not so good companies is how you respond to when you're hacked. And everyone's going to be watching Okta's communications, how transparent they are about what has taken place here, what was the impact to customers. That's really going to be what a lot of their customers are going to be looking for, and how they're going to decide which vendors they go for with in the future.
Yeah, and that's what I hope you'll get a little bit deeper into. Okta, I should mention, down 8% today after recovering a bit a few days ago. What should investors look for in a response? What tends to turn clients off in responses, both in terms of whether it's minimizing something without enough evidence, whether it is trying to blame an outside party when it's not clear that you're presenting evidence that it is indeed an outside party's fault? From a security company's perspective, your view on what constitutes a good response?
It's really three things. It's transparency, transparency, and transparency. That's what customers expect. And honestly, I've been through this with many cybersecurity companies that have been hacked. As long as they're open and honest with their customers, they don't tend to lose anyone. But if you're looking like you're hiding something, if you're not sharing, if you're letting your lawyers talk instead of your CEO, that's when you're in real trouble.
Dmitry, let's hope that we don't have to have you back in an emergency situation, but it's good to get your guidance today. Thank you.
Thank you so much.
Dmitry Alperovich.
Coming up, software weaker today, but coming off a big rally in the last week. State of valuations when Tech Check returns.
Welcome back to Tech Check. I'm Carl Quintanilla with Deirdre Bosa, John Fort, and Julia Borston. Coming up this half hour.
Increased prices. Shares of General Mills are up about 3%. Moderna, meantime, says that it will seek regulatory approval for its COVID vaccine to be given to very young children. The company says that the low-dose COVID shots are safe and effective for kids as young as 6 months old. But the company also said that the shots are less effective against Omicron than previous variants. Moderna shares are down about 4% today. And Moscow Stock Exchange is set to open tomorrow for the first time in nearly a month. Only some stocks will trade, and short selling will also be banned. Deirdre, I'll send it back to you.
Rahel, thank you. We're going to turn now to software valuations. Take a look at the IGV. It's up about 9% since last Monday, but it is down this morning by about 1.5%. So We've been asking this question a lot. Is this the beginning of a snapback for tech? Our next guest says recent volatility provides opportunity for M&A. Joining us now, Index Ventures partner Nina Ashajian. Nina, it's great to have you with us this morning. Let's just start with a simple question. Do you trust the rally, especially in some of these high-growth, unprofitable tech names that are still way off their peaks? Do you think they settle in or around these levels?
Well, thank you so much for having me. It's great to be back. And it's certainly been a rough year, as we know, for tech stocks. But I think if you take a step back and look at what is happening with a lot of these names, we're seeing a lot of great tailwinds in tech. And I can tell you the demand for technology, especially from what we see on the early stage side, is really promising at the moment.
So, Nina, I know that you've talked in the past a little bit about the IPO market, which has been extremely slow so far this year, but you think that there's actually reason to think that it could open up in the next little bit.
Yeah, well, I think it's important to just take a step back and see where we are today in the market, right? A third of tech companies that IPO'd since 2018 are actually trading below their last private round valuation. Companies like UiPath, Dropbox, and up until yesterday, Uber. So if you're a late stage private growth company right now, you basically have three options. One is wait it out on the sidelines and hope for the market to get better, extend your runway. Second is explore M&A, which we talked about back in January and we're starting to see a lot of today. And then the third is brave the market, go for it, because there are some very strategic decisions and reasons to IPO even in a market like this.
And what would some of those be, other than just the need for capital to fund general corporate purposes?
Right. So first, history shows us that winners take market share in downturns. We saw it with Amazon in 2001, Visa in 2008, and Atlassian in 2015. And those were not easy decisions to either go public in those markets or double down and be aggressive in those markets. And look at where those companies are today. So that's reason number one. I think if you believe that you're operating in a huge market, this could be time to build a war chest, be aggressive, and even maybe acquire some companies in the short term. The second reason is if you're selling to very large enterprise customers, they kind of want to know you're going to be around 2 to 3 years from now, especially if they're spending tens of millions of dollars on your platform. And being public is a great stamp of approval. And then lastly, I know the narrative has shifted towards show me the money, path to profitability. But in reality, I do think investors still care about the balance between that and also growth. So if you're a private late stage company, you want to make sure to capitalize on as many years of high growth above 30% as you can as a public company. So I think actually on balance, some companies, not a lot, but a few, will look at this and say, look, it might be worth going out this year. Yes, it'll be bumpy in the short term, but I think there's reasons that strategically, when you look down the road 3 years from now, it could be a great decision. And if we sit here in December, we might be surprised by what companies decided to come out in this market.
Yeah, Nina, but if you're Stripe or Canva, Stripe, private valuation at about 100 billion, Canva at 40, why would you, right? Because payments and fintech have been hit so hard in this market. I mean, do you really think that Stripe would still have a $100 billion valuation in the public market like it has in the private market? And it hasn't had any trouble doing deals, making partnerships, and growing as a private company, raising more capital. Why go into the public market in this environment?
Well, that's the conversation that's happening real time. I can tell you in every boardroom of a lot of these very high-priced late stage privates. And just to be clear, I don't think all companies, that are in these areas or those companies that you mentioned will go public. What I'm saying is I think we'll be surprised because I think the assumption right now is who would want to go out in this market? Just too volatile. Multiples have come down. I think it'll be a very bumpy road. But when you actually look long term and try not to over optimize for today's market, I actually think there's a pretty good case for a select few companies to come out.
Yeah, so Nina, I know that you're focusing on the later stage companies, but over the last few years, we have seen so many more earlier stage companies go public via SPACs, and many of them have fallen short of their targets and really suffered in public markets. Is that era, the era of sort of the SPAC craze, over? And is that a good or bad thing for retail investors?
Well, I think there was a lot of questions around SPACs. And of course, it only happens in markets that are like it was in 2021 and even 2020. What I will tell you is, I think a lot of people right now are really questioning, can some of these tech companies eventually show profitable businesses? Can they throw off free cash flow? And what I'd like to share is that, we have the fortune of seeing all these companies very early stage. And at a high level for the best tech companies, what we're seeing is, number one, average contract values are landing higher than ever before. Second, sales cycles are shorter than ever in the past. Third, product development is faster and more agile. And lastly, I would say net dollar retention, probably the most important metric if you're caring about SaaS profitability, is at all-time record highs. 120%, sometimes even 140% for best-in-class companies. So, I think things did get a little out of control last year, but I think when you look at a lot of the fundamentals of this business, will they be able to turn profitable? I think things are not as pessimistic as people think.
Nina, it's funny, a lot of the VCs we talk to look at that exact metric, net revenue retention. But just a quick follow-up on that SPAC idea. Gotten a really bad name over the last few years from that underperformance, but this was essentially a way for a retail investor to invest a lot earlier. So is the pendulum kind of swinging back to the VC, the private markets, which retail investors will perhaps get less exposure to now?
Well, I think there's been a great effort for democratizing access to retail investors. Direct listings was also a great example of that. So I don't think the pendulum has swung. I just think that, people are going to be a little bit more cautious. I think in times of uncertainty, people flock towards certainty, and certainly going public, the more traditional ways have been something that people feel more comfortable with relative to SPACs that are relatively new. So I don't think that the pendulum is swinging necessarily just to favor, let's say, institutional investors investing in companies.
Yeah. Nina, thanks as always for your insights. We'll talk to you again soon.
Thanks for having me.
After this, does Facebook have an attention problem? Stock has actually turned positive for March, but still down more than 35% this year. Tech Check back after this. Facebook parent Meta's shares are down by more than a third this year. Ad spend on the platform now a concern, as is user engagement. Julia Borston's got more on new evidence of headwinds for Facebook. Julia.
Well, John, we're seeing a number of red flags around Facebook's user and ad challenges. And this, of course, comes after last month, Meta reported Facebook's first ever quarterly decline in daily active users. BuzzFeed yesterday told its investors that it sees audiences spending less time on the social platform. Analytics firm Sensor Tower telling us, quote, Facebook's mobile app usage is down sequentially in the first quarter, saying that's a deceleration from past quarters. And with user declines, ads come under pressure as well. Insider intelligence tells CNBC exclusively that it is lowering its forecast for Meta. It's slashing its expected revenue for the company by about $2.5 billion, both for this year and for next year. And now it's projecting that the company's share of digital ad spend will fall under 22% by 2023. That's down from 25% share in 2020. Now, one factor at play here is the economic pressure that many of Facebook's advertisers are under. Now, just today, Meta releasing a State of Small Business report, which revealed that 1 in 5 small businesses are closed, more than were closed in July, and more than a third of small and medium-sized businesses globally reported that they reduced employment as a result of the pandemic. Now, today, Lightshed's Rich Greenfield issuing a critical note on Facebook, writing that Meta's, quote, vulnerability to competition and lack of visibility around its metaverse pivot make it challenging to be excited about Meta's stock at current levels. But on the flip side, Atlantic Equities issuing a far more bullish note today, saying that they believe, quote, Meta continues to make progress restoring ad targeting measurement capabilities, and the company's reach and effectiveness for driving unplanned purchases remains unrivaled. So right now, Meta shares are down about 0.5%, but they were off about 1% or more earlier today. So guys, it's going to be interesting to see what comes out of this next quarterly earnings for Meta. Seems like it will be really a crucial one.
Julia, what's your sense of how much of this attention challenge that Facebook and Meta have might be due to reopening? People have more things to look outside than their phones. And then they're having to figure out new solutions to the attribution problem, being able to connect ads viewed to shopping done offline, given the targeting that they aren't able to do as easily.
Well, look, these are all factors, right? The question is whether this becomes a perfect storm. So yes, I think the reopening is a big factor. I mean, if you look at the fact that there was such a surge in online activity for all of these companies, whether you're talking about Netflix or Roku in the first part of the pandemic. But one thing that was interesting is that we saw that Facebook saw a decline in mobile usage, got that info from Sensor Tower. And I asked, can you get a sense of where those users are going? They said they can't tell whether those Facebook users are going elsewhere because there was no notable move in any of these other platforms. So Instagram, that usage was flat. The question is, are we going to see a big uptick in, say, TikTok usage or Snap usage, or are people just spending less time on mobile devices? And of course, as you mentioned, all of this comes as Facebook works to improve the way it's managing Apple's operating system changes that make targeting and measuring ads impact more effective. So they were really damaged by that Apple move. They have been making progress, and the question is just, are they making progress fast enough to counter all these other factors and issues that they're reckoning with as well?
And the other competitors. Julia, thank you so much. After the break, we will head back to Washington as chip executives wrap up testimony. Tech Check is back in just a moment. Stay with us.
Welcome back. We just discussed some challenges to Facebook's business model from Apple's privacy changes. One business helping companies navigate that is Intercom. Software companies backed by the likes of Mark Zuckerberg, Jack Dorsey, Kleiner Perkins, has customers like Amazon, Lyft, Microsoft, Shopify. Joining us now is Intercom CEO Karen Peacock, also on the board of Dropbox. Karen, good to see you. I want to talk about first some product changes and updates that you're making in the context of first-party data, which we're talking about more and more because of some of the privacy changes that platforms are making. What are you doing and why?
Thanks, John. We are fundamentally changing the way companies interact with their customers. And what we're announcing today is two big new launches. The first is Intercom Surveys. And this is very different from a classic survey tool, which is a standalone thing where it produces a research report. Our surveys gives you the ability to ask customers questions and gather that first-party data from them and use that to personalize their experience forevermore. So, John, if you were going to a retail furnishing store online, I could ask you a question there of, hey, do you like traditional? Are you a modern guy? And then based on that, I can coordinate and personalize my communication with you forevermore on the website, on email, etc. Powerful way of gathering more first-party data. We're also introducing Intercom Switch. This is the idea of no more waiting on hold. Now companies can give customers the option while they're sitting on hold to switch with one click to messaging to get their questions answered faster.
So with all of this, and in this environment where customers aren't able to do some Facebook spend and pull in customer volume in the same way that they were in the past, to what extent are they shifting their attention toward investing in that first-party relationship, even if it means, right, they don't have as much cash flow to do it in the near term? Are businesses able to do that and have that focus shift?
We see a huge trend in how businesses are thinking about investing in gathering first-party data, and they're looking to tools like Intercom for help. They're looking for tools to help them convert customers to come to their website, to engage with customers, and to support their customers. So we definitely see that, and it pays off. So when you use an in-context way of communicating with your customer that's personalized, like Intercom, we see on average 3 to 4 times the engagement rate of traditional tools.
Karen, it's Deirdre. Good to see you. We talked to a previous guest. I'm not sure if you heard about the IPO environment, and she was saying that the market is still open for late-stage quality companies. So I wonder how you're thinking about your path to public markets.
We are very much focused on our customers and building breakthrough solutions for them. So understanding where are their most important problems, how can we solve those well, and focusing on innovation like I've just been talking about. And we're really excited about the momentum in the business.
Karen, where's the line between being persistent and maintaining that engagement in the hopes of getting repeat sales versus pestering them to the point where they feel they never want to engage, they never want to get on any kind of list for fear that they will never be left alone again and will be drowning in junk email for the rest of their shopping lives?
I think that is a great question, John. And we are all overwhelmed with the amount of spam calls and direct mail and, of course, email. And we believe that the best time to interact with a customer is when they're already thinking about you, not days later or hours later or when they don't want to be getting that. And that's why we think in-context communication, when you're on the customers, when you're on the business's website, when you're in the product, is the right time to engage with customers versus ongoing spam everywhere else. We're also a believer in an omni-channel solution so that, not all the time people are going to be right there with you on your site. So I think it's very much a balance of the two, but in general, talk to people when they're already thinking about you.
Yeah, lots of attention to first-party data these days. Karen Peacock, CEO of Intercom. Thank you.
Thanks, John. Thanks, Deirdre.
As we go to break, check out NASDAQ briefly turning positive on the session as we are once again in a pretty tight range, at least on the S&P, a few points shy, again, of 4,500. Be right back. get a gut check on Poshmark today. Shares slid 10% pre-market after posting that weaker than expected revenue guidance, now climbing through the day with the rest of the market firmly in the green, still down 60% since the all-time high last year. It has obviously been tough sledding for online retailers. Just look at Stitch Fix, ThredUp, RealReal, all in the red, down more than 70% from some record highs. Dee.
Carl, plus Katie Hahn, former Andreessen partner and one of the most influential voices in crypto, announcing her new fund, $1.5 billion. To read more, go to CNBC.com, where we tweeted it out from the Tech Check Show account, so make sure you're following that. And if you missed part of the show, don't forget to follow and subscribe to our podcast to listen anytime, anywhere, wherever you download podcasts. Tech Check is back in just a moment.
You have a lot of people in this market, a tremendous amount, more than I've ever seen, that have no idea what they're doing. I mean, the market is not a gambling casino completely. There are people in this market that do have an edge, and you have so many people out there that really are gambling.
That's Icon yesterday with his trademark candor. And in completely unrelated news, GameStop closed up 30% yesterday on not much news. Chairman Ryan Cohen tweeted that he did purchase 100,000 more shares, raising his stake to 11.9%. Stock continues to rally today, John, as we did get a bit of a halo effect on some other meme names, and we'll see how long-lasting this wave may be.
Yeah, some people do have an edge. How is that different from a casino again? I don't know. The house always wins, they say, but I mean,
hasn't it always been that way, though, guys? Well, I mean, that's nothing new.
But what is new, looking today, look at Peloton, Affirm, Chewy, Warby, Asana, all up more than 7%, close to 8% for those. This volatility, the velocity of some of these moves, Dee, something else.
Yeah, it certainly is. Of all the things that you could pick up now at a discount, some of the memeiest ones, which is just evidence, Carl, that this snapback is happening. Whether it lasts, of course, still very much an open question.
Yeah, we did get Morgan Stanley saying that they prefer Affirm to Block. We're going to watch that. Meantime, those chip executives wrapping up their testimony on the Hill. Let's get back to Ilan Mui. Ilan?
Well, Carl, that hearing is still going on, but it's been clear that there is bipartisan support to provide the industry with that $52 billion in funding from Washington. But some lawmakers also wanted to make clear that the money isn't free. Democratic Senator Ed Markey wanted the CEOs to assure him that they would limit the impact to the environment of any ramp up in U.S. production. Here's his exchange with Micron CEO Sanjay Mehrotra.
Micron has a strong program and emphasis.
Will you make that commitment? Will you make a commitment to reduce down to zero greenhouse gas emissions?
In the long term, we absolutely will be getting
in the long term is which year?
We have a program in place regarding and investments being made.
No, but which year are you?
We will soon be announcing that. We have not yet laid out the year.
Now, Republican senators grilled the CEOs on the return on investment to taxpayers and also questioned the wisdom of industrial policy.
This is foundational to every other industry and every other aspect for it, and thus we believe it's justified to take such steps as the CHIPS Act.
When government starts attempting to allocate capital, it just screws things up.
But these were the testiest moments in the hearing so far, guys. By and large, what we heard from lawmakers was the same thing that we heard from CEOs, which is that Congress and Washington need to make this investment or the U.S. could risk falling behind. Back over to you.
Ilan, do you ever recall having that kind of testy exchange about farm subsidies?
About farm subsidies. Well, certainly there are many members of Congress who aren't in favor of farm subsidies. But look, every industry comes to Washington looking for some help, looking for potentially what some would call a handout. But the real issue here is that this is part of a bigger package, and Congress is trying to pass it as an innovation agenda that they say will really sort of leverage us into the next generation of technology. We'll see if that happens, but certainly this is the driving component of that engine.
Yeah, it's often the case, Ilan, where the government does have to lead a little bit. Certainly we looked at subsidies in the electric vehicle market for years, which now appears to be a little more self-sustaining. And just to recap, you did say maybe the timeline for this getting done happens sometime in the spring?
Yeah, that's the goal here. The chairwoman of the committee said that she would like to see this passed in May. But as you know, on the Hill, time is very fungible. Things tend to slip, but they are trying to create that urgency to get this done sooner rather than later.
We'll keep our eye on it. Obviously, a lot of news regarding the chips this week, the Hill, and of course, NVIDIA's event yesterday. Ilan Mui, thanks so much. Pretty tight range today, somewhere in the high 4900s. Let's get to the judge and the half.
Thanks, Carl. Welcome to the Halftime Report. I'm Scott Wapner, front and center this hour, rally and risk. As stocks continue to fight their way back, is there really enough to keep this rally going? Or is there simply just too much to worry about? Russia, rates, the reality of this brave new world. We take it to the investment committee, as always. Joining me for the hour today, Shannon Sakosha, Degas Wright, Joe Terranova, and John Najarian is the co-founder of MarketRebellion.com. It's just past 12 in the East. I'll show you what stocks are doing. They're a little lower today. Dow's down 250, S&P's down 16. NASDAQ's made a burst positive by about 25 points. There's the yield, 10-year note, 237. We took care of some technical stuff, Joe. The S&P's coming off its first close above the 200-day moving average since the middle of February. So we, about a month ago. Bullish sentiment, by the way, is on the rise. It's increased to 35.3 from 30.6 in the latest U.S. Investors Intelligence poll. And you, my friend, are growing more bullish yourself, at least in the near term. You think we can get to 45.50 now on the S&P 500, and you are a buyer as a result. Talk to me.
Sure. Absolutely. Solely relying on the technicals I mentioned on Monday, you had a momentum trade that was setting up with a very low risk and a high reward potential. That was a close above the 200-day moving average. Confirmed. You got that. That leads to the path of 45.50 for the S&P 500. And I think your stop on this is, as I said before, low risk, 44.60 basically on a closing basis. Where that number comes from is those are the levels of the last 3 days. You had 2 closes there on Friday and Monday. The day that we're having today, Scott, I'll take it. This is a resilient day. You're seeing oil prices rise back significantly. And let's remember, a lot of the rally that we have appreciated here in the last week has occurred with oil prices up 20%, Treasury yields rising at the same time, as this conversation now about their great reallocation out of Treasuries into equities actually unfolding. So I think we got a nice little technical setup here. As I said, low risk, high reward, 45.50, long S&P futures. That's the way I'm playing it right now, and obviously maintaining a lot of my portfolio holdings.
I'll tell you, maybe the most bullish sign yet that I've seen is Joe's whiteboard. Look at the whiteboard. It has a lot of writing on it again. For a while, we were in the midst of a correction, or right before it, the whiteboard was empty. And that was maybe the biggest tell that we got to look out. Now, it's littered with writing, numbers all over the place. You didn't even go into the stocks that you bought more of, which I was trying to prompt you to, and that is Deere and Archer Daniels Midland.
Love the agriculture trade. You know, if you think about it, and I know Mark Fisher's been on the air talking about this, there's no OPEC. There's no way to increase the supplies. It's spring plantings, and we're falling behind here. We've got a real challenge, and I think Federal Reserve Chairman Jay Powell understands that in terms of what we're putting on the breakfast table. Agriculture is a problem. So Archer Daniels, Midland, John Deere, this is the way to get that exposure. I've been talking about it over the last couple of months, and I'm just going to continue to buy it. And on your point about what's on the whiteboard, is what Tom Lee is going to talk to you about this afternoon. It's all the historical statistics suggesting that the second half of the year and the first quarter of next year line up to be strong.
Okay, yep. Tom Lee's going to be with me in overtime. He's going to be on set with me as well at the New York Stock Exchange. His first in-person interview, he says, since 2019. So I can't wait to shake his hand and welcome him to overtime, and we'll talk about the markets later. All right, John Najarian. Jim Cramer says, historically, when we have gone down this much and then you have a 50% retracement, it usually means all clear. Are we in all clear?
Well, we could be, Scott. I'm certainly not one of those who panicked on the way down and called it a bear market or whatever, or is saying that we're going to scream to the upside. What we've talked about with you over and over again has been the 3 V's. Basically volume, velocity, and when we see these kinds of moves out of the market, whether it is that volume that's heavy, velocity, which is speed, and the speed that Joe just talked about, when we had that big jump, Scott, in 2021, in 1 month, we saw the 10-year rate go from basically under 1% to 1.7%. That was a 75% move in 1 month. We've seen a much more measured pace now, even though it's higher. It's up to 237 for the 10-year. So that being measured is far more to the market's liking. So is Jim right? Jim certainly could be. Like I say, I was neither huge bear or huge bull on this move. I've just been sticking with my tech stocks, not thinking that they get broken up by a little moved higher by the bond vigilantes or anybody else. Because keep in mind, the Fed has only made a quarter-point move here, Scott. I know you know that and talk about it all the time, but a quarter-point move. And meanwhile, the market, the bond market that is, has moved all the way from basically 150 level all the way up to 237, although not just in a quick move like that. It's been stair-stepping up like that. So the bond market is doing most of the heavy lifting, not the Fed. And that's a good thing right now. That's why the Fed hasn't had to make that 50 basis point move.
You feel like, Degas, that the proverbial tide is turning a little bit. I mean, Jonathan Krinsky, BTIG, we talk about him all the time because we like his technical analysis. And he has suggested you really can't call the bottom because we didn't have that big whoosh that you normally get during periods that are uncertain like this. And now even Jonathan Krinsky now says, well, we could still go higher from here. Rotation between sectors can prolong the rally, he says, and while we thought 4,500 might provide a near-term ceiling, there isn't a ton of resistance between here and 4,600. It goes to Joe's 4,550. Maybe Krinsky says you can even go a little bit further. What do you think, Degas?
Yeah, so what I'm thinking is that if we look at the overall market, we finished fourth quarter 2021 at a GDP growth of about 7%. As we get into first quarter, we're looking at the GDP now forecast by the Atlanta Fed being 1.3% growth for the quarter. So, Scott, what's that saying to us is that the economy is slowing down. We probably had most of the interest rate movement in that fourth quarter into first quarter. So what this says, it sets up a really nice setup here for the market to continue to go up. And so that's what we're seeing. We're seeing this as an opportunity to continue to stay fully invested. We are fully invested through this period. We didn't get really scared by the downside of the market. So to your point, this sets up a good setup. Interest rates are coming down, so this could set up for the Federal Reserve not to have so many rate hikes, because we're looking at the Fed funds rate being about 1.25 by the end of the year, which means that that's going to be a Fed rate hike of about 4 rate hikes.
Rates coming down? Rates aren't coming down. Rates have been going up, Degas. Rates were up like 10% in a couple of days. Now, I'm not talking about, today, but is that really the environment that we're in?
If you look at the GDP growth, you're going to see first quarter is going to be much lower than fourth quarter 2021. We had a 7% growth rate, inflation in 2021 fourth quarter. First quarter is going to be much lower, and it may be around 2%. The GDP forecast is saying 1.3. So when that number comes out, you're going to see a much slower economy coming into first quarter. And as we get into second quarter, we're probably going to see a little bit higher rate, probably around 4%, because we're going to have the supply chain constraints loosening up, and also commodities will probably get a little bit better. So we're probably going to have a little bit higher rate in the second quarter, but we're looking for about a 2% first quarter, 4% second quarter. So we are seeing the economy slow down.
We are, a little bit. What do you think, Shannon? Where are we going from here? Let's say that Joe's right and we can get 4,550, and maybe Krinsky is right and we get all the way up to 4,600. At some point, doesn't the Fed have a ceiling over the S&P 500 because of what it's going to do on interest rates?
Well, I think there's sentiment, and then I think what the actual economic transmission of what the Fed is going to do from a rate perspective are two different things. So, if we're actually sitting here at the end of the year and we're at 225, think about the areas of growth in the economy and how restrictive that would be. We have plenty of room to move as it relates to financial conditions. Our friend Liz Young put up a great chart on Twitter earlier today showing how much further financial conditions could tighten to get us back to pre-pandemic levels. And I think what we need to think about is, where does that growth come from? We're also entering the third year of this bull market. And frankly, the range of outcomes in the third year of a bull market that we've seen historically has been a narrower range of outcomes. And so if we think about it in terms of potential volatility, if you think about it in terms of where do we go in the second half of the year, and to Joe's point, into next year, certainly seems like we're going to have higher equity prices, and that's where you're going to want to be. But I don't think we're looking for, or we aren't necessarily looking for, another blockbuster year as we had last year. So I think investors need to be realistic about the types of companies, the industries that could potentially continue to grow their earnings in the second half of the year. I think an emphasis on quality and fundamentals is going to be much more important. And to Degas's point, the economy is slowing down, but there is a big difference between an economy slowing down based on comps over a pandemic period, as we saw last year, versus an economy that is truly slowing down because we've peaked. And I think that we need to accept slower growth, but that doesn't necessarily point to a recession. So watching the yield curve, watching the the 3-month and the 10-year spread is going to be important. But I think, again, being selective about what industries you think are going to benefit, perhaps not on the input side, but on the end product side in the second half of the year, is your best bet in being properly positioned.
So, Joe Terranova, I mean, let's get real here. And I think you said something really important in your opening remarks here about technically we've erased some of the damage. And sure, the stock picture looks better today than it did a few weeks ago. But does anything else? Are we really better off today than we were 3 weeks ago in terms of what's really at stake here? You could make an argument, and I'm going to play devil's advocate here against some folks who are fairly positive. You can make the argument that things are worse. The Fed is going to be more aggressive, right? I mean, they're even throwing out 50 on the table. We know it's coming. It's just a matter of when. That's my feeling. Maybe I'm wrong. The war in Russia, that doesn't seem to be closer to an end at this point. We think that earnings are going to begin to slow, that it's just a matter of time. That's what Mike Wilson told us the other day. I want you to listen to what Carl Icahn told me yesterday in OT.
I think we do have a lot of trouble ahead. When it happens, I've told you this many times, on the short term, I don't think anybody can really predict it. I think there's just too many variables in this type of a market. I think there very well could be a recession, or even worse.
My point, Joe, is like beyond some technical tailwind that we may have at our back now because of the reversal in the market. What do we got? Well, what's the underpinning to take us even higher?
Well, I think the one aspect where markets feel a degree of comfort is that a more aggressive Fed is actually a more credible Fed, because I think markets looked at the Federal Reserve, kind of scratched their head and said, wait a minute, you're not seeing what markets are actually telling you. But beyond that, I'm going to agree with you. I completely agree with you. And I said it on Monday. All we've done is reversed a lot of negative sentiment and a lot of technical damage. We haven't improved upon the fundamentals of companies that are not profitable, who are going to be even more challenged as rates continue to rise, and I suspect that rates are going to continue to rise. You do have select stocks that have the ability to endure an inflationary environment by passing on the rising costs that they're incurring to a strong consumer. And to Shannon's point, those are the companies that I want to allocate towards. But you're 100% correct. What I'm doing here is I'm reacting to the market, and I'm accepting a very low risk, high reward scenario that suggests breaking above a 200-day moving average is going to give me another 75 handles in the S&Ps. Does it improve the fundamental picture for a lot of the companies that I defined before? Without question, it does not.
What if I say this, Doc? What if I say, okay, well, Mr. Wapner, inflation may be peaking, and maybe the economy's strong enough to withstand whatever the Fed's going to do. How about that? Why don't you take that to your bank? And that's why that the market, after having its upset and now fighting its way back, can continue to go higher. Am I right or wrong?
You're right. That is the way I'm looking at it, Scott. Again, volume, volatility, velocity. If we don't have that velocity of rates moving higher like that, then the market can deal with it. Consumers, yeah, the consumer is going to be impacted by the sort of mortgages they can get, the sort of car loans they can get. There is no doubt about that. But we're talking about two things that are in very short supply anyway, Scott, both automobiles as well as real estate. So I wouldn't think that that's a bad thing that means, oh my gosh, time to sell everything because consumers are having to cut back. They're spending more on gas. That's a fact. I saw just this morning, Scott, that LA averages over $6 a gallon. That's from a regular mainstream media. That's not like some Yahoo Post or something like that. So can consumers weather that? Yeah. Do they like it? Of course, no. But can they weather that? Yes. And so to your point, I think rates going higher is what most of us, I would believe virtually everybody on your show, expects over the next 6 to 9 months as we finish off 2022. But that's not going to be bad if it's not fast. If it's fast, then that's going to be bad. If it's not fast, then I think we can handle it. The market and demand, consumer demand, still remains very, very high. We've seen that from most of the good providers to consumers right now. How much Jill, for instance, goes up, despite the fact that shipping costs were up $60 million and things like that. We've seen this across the board, that consumers are still spending. Nike, you and I talked about it Monday, they blew out those numbers. Supply chain issues, all the good things that we looked for were there in that report.
Right, but the question is, we just don't know whether it's going to continue or not. You know, we can say the consumer is strong today. This is like the Jim Lebenthal argument. Consumer's super strong. What do you mean? You can't even get a hotel room. You can't get a seat on a plane. What do you mean earnings are going to slow? Earnings are strong today. Do you see what Nike reported the other day?
Yep.
The big question, though, Doc, is can it last? Can it last under the weight of continued inflation? Can it all last under the weight of rate hikes and just a fundamentally different environment that we're walking into?
I think it can, Scott, and here's one of the reasons. For instance, Chevron, they have a bunch of steel workers, I believe, out in California that are basically going out on strike because they were offered a 2.5% raise. They expected and wanted 5%. So the company offered them 2.5%. I bet ultimately, Scott, next week at this time, you and I are talking about them getting that increase because costs are going up. And obviously, earnings have been going up rather dramatically at most of these firms, Chevron in particular. So I think the consumer is going to be rewarded. Those that are out there working are going to find they're earning more. And I think that is one of the issues that the Fed will pay attention to. But on the other hand, they don't want to slam that. They don't want to play whack-a-mole on that one. They want to let the consumer earn more money right here because they need it to pay for the higher energy, food, and the rest. So I think that's something that, as long as it's not too fast, will be just fine, and we'll see consumers and companies continuing to do well.
That is the delicate balancing act in which the Fed finds itself right now. And it remains to be seen if it can navigate it correctly, and Jay Powell can engineer a soft landing amid a lot of doubts as to whether he in fact can. And even he admits, while confident, of course, that it's going to be tough, that it's going to be difficult. I want to know what to do with this tech trade right now, because tech is up 10.5% from its low on March 14th, a week ago. Look how far tech's come. The software, semis, cloud, overall, the XLK. You have a bunch of positive calls or reiterations on your favorite names today, whether it's Apple, Netflix, Facebook, Amazon, or NVIDIA. Jim Cramer, do we have the sound from Cramer or just this verbatim? All right. Jim Cramer said as well, and I like to quote Jim because he's always on point. Yesterday, speaking of the bounce in tech, was a very convincing bounce, he said. I'd be tempted to buy the stocks that are coming off. Even Meta is interesting here, he said. There are a lot of stocks that are very, very interesting, particularly FANG stocks that have gone down a lot. Degas, what do we think about that?
Yeah, we agree with that, because if you look at the FANG stocks, and let's just talk about Apple. Apple's business case has not changed. We still have the strong fundamentals. You still have the ecosystem for Apple products and services, and so that hasn't changed. The thesis hasn't changed around Apple. The catalysts have not changed. What we did see is that we had negative market sentiment. The market sold off names like Apple, Meta, Microsoft. They sold it off, but it was not tied to fundamentals. What we're seeing now, the market is returning to fundamentals. And as long-term investors, that's what we focus on. So we did not sell off any of our stocks as the market went down, because we knew that the business case still carries forward.
You know what, Shan? I'm looking at Apple, and maybe that's the most important story in the whole market right now. That Apple got down to like 150, right? It was like right at 150, and that wasn't that long ago. That was at March 14th. The stock closed at 150 and 62 cents. And here it is battling all the way back to 171. And remember, at that time, we had the conversation. Look, if Apple breaks down further than where it is now, we got a big problem. In fact, just the opposite happened. And now Apple's not all that far away from its all-time high. I mean, Apple's at 171, and the high is 182.
Yeah, I mean, it seems pretty incredible, right, Scott, if you think about where we were just a few weeks ago and thinking about the tail on this growth sell-off that we were experiencing. And I think it sort of speaks to some of the things we've been talking about as it relates to what is the true impact of the Fed in terms of raising interest rates. I come back to, if we are indeed moving towards a sustainably lower growth environment, back to where we were in 2018 and 2019, if we are moving into that narrower range of outcomes, if you think about the FANGs, what they offer and afford you are strong balance sheets, free cash flow, the ability to make tuck-in acquisitions, the ability to innovate, and most importantly, the ability to grow their earnings even against a backdrop where they do not have some of the secular tailwinds that we've been experiencing the last 2 years. And I would argue that Joe made a comment a long time ago, and I remember it. He said something about being able to not have a second release of pent-up demand post-pandemic. I actually think that we've seen several smaller releases of pent-up demand here and in China, and we are going to see, as it relates to Apple, continued consumer strength because we haven't had our demand met in this post-pandemic world. And so whether it's enterprise spend or whether it's consumer spend, whether it's Amazon and Apple or Google or Microsoft, I feel like there are still opportunities for us to be able to grow earnings, perhaps not receive the multiple expansion that we've been afforded the last few years, but why wouldn't you want to have these names in your portfolio? And we're seeing that true differentiation between the high-flying stocks that were work from home and real enterprises that can continue to grow against a more uncertain growth backdrop.
John Ajarian, this move in Apple, I mean, it was the debut day of overtime on March 14th, as I said. Somebody calling me now. And that's when the stock went all the way down, and I said at that point in time, watch out. If this stock breaks down, we got a bigger problem. And in fact, the opposite has happened. As I said, it's pushing $172, $10 from its high.
Yeah, and you heard what Dan Ives had to say. A number of other strategists have talked about this. And I think the issue here, Scott, is that the time to buy, Jim's being a very cautious guy, buying them after this pretty significant rebound. I don't like catching a falling knife, but I do like buying on those big sell-offs unless something fundamentally changed about the story with Apple or Microsoft. Again, two of my largest holdings, and nothing fundamentally changed. Is the war going on still? Absolutely. Is Apple still crushing it? And are they still going to see another cycle heading into this fall? That's what I believe. And that's why, with the stock at 150 or 148, whatever the low was on that day, I think that was the opportunity. Again, you have to be willing to catch the falling knife, or you can wait $20 and jump in at 170. I didn't flush it out when we hit 150. I was adding call spreads, and I'm still in it now, and I'm not taking profits. I think this one continues to work and grind its way higher, and then maybe we get some sort of innovative thing, or the fact that so many more people are using their products, including cloud, means that they're just going to be on the services side, Scott, just crushing it. So yeah, I think you have to be willing to get a little blood on your hands from catching that falling knife once in a while. But if the fundamental story did not change, that's your reason to buy on those big dips, rather than chasing it after it's made a $20 or $22 rebound.
Well, I don't know if you were in on the same trades that Pete was a day ago, but when he was with us yesterday, he said he had more options action going on than he's had in a long time, some 50 or so trades, and a bunch of those were Meta and Microsoft. And in these large names in technology that we're talking about, he was betting on some near-term upside, and lo and behold, here we go.
Yep, and the same thing was occurring, again, just 7 trading days ago. Tesla was in the mid-700s, Scott. Today it trades into the almost 1050 level. 1030 was just a little bit ago, $1,030 a share. So that's how fast it happens. Same thing with the Chinese internet stocks. They were pouring money into these stocks on that March 8th through March 14th area. That's the time to chase in I'm not saying that you have to dump them now. I'm just saying that, you know, if you're willing to make those trades, and the reason Pete was trading so many options was he can define his risk when he enters. I was doing the same thing. You trade stocks on that with that same outlook. You're not defining your risk. You could find that an after-hours trade, bang, you're down 10% in the stock. I would much rather be in those derivative trades, just like Pete was doing yesterday.
Well, of course, because as he has said in some of the more speculative areas of the market, he wouldn't, you know, touch the stock with a 10-foot pole, but he'd happily play the derivatives market because you better define your risk, as you said.
bet.
And obviously, if you know what you're doing, like you guys do, you can be successful at doing that. All right, we're going to take a quick break. Energy is leading the way today and for the year, as you know. Up next, we'll hit one bullish note out on one big oil stock. Degas owns it. The trade and the debate is next in our call of the day. We're back right after this.
Welcome back. I'm Rahel Solomon, and here is your CNBC News update at this hour. NATO now estimates between 7,000 and 15,000 Russian soldiers have been killed during a month of fighting in Ukraine. That's according to a senior NATO official who spoke to the Associated Press. Russia has not updated its official death toll in nearly 3 weeks, but at that time, Russia said 498 of its troops had died in the conflict. Ukrainian President Zelensky telling French lawmakers that French companies must leave Russia. He also said that they must stop sponsoring Russia's war machine. He called out several companies, including car maker Renault. Renault has not immediately responded to Zelensky's comments. And in New Orleans, one death has been confirmed after a tornado touched down in the city overnight. The path of destruction stretched about 2 miles, much of it near the lower 9th Ward, which of course suffered heavy damage in Hurricane Katrina and again during Hurricane Ida. And on the news tonight, a miraculous story of survival inside a tornado. That's tonight at 7 Eastern. Scott, I'll send it back to you.
Rahel, thank you very much. Rahel Solomon. All right, BP upgraded to overweight at Morgan Stanley today. They say it's undervalued. We say it's our call of the day. Degas says you should own it because he does. Am I right?
Exactly, because what we look at is that this has one of the highest distribution yields, because as you look at the company, it actually has a yield of about 4%, plus it's actually sending back more capital to shareholders. The reason why we like it also is that, one, it did have a exposure to Russia, about $20 billion. They divested there, and also it has great pipeline of properties that will be producing oil. Now, what it's also doing is that it reduced its outlook for energy production, fuel production in 2030. However, what it has a very aggressive transition plan to alternative energies, and it's actually starting to focus on that piece of the business. So it's going from fossil fuel to alternative energies with a really solid transition plan, and that's why we like it.
Joe, my question to you, has oil topped out? And I ask you that because when I was talking to Icon yesterday and we were talking about Oxy and why he sold the rest of his position, and it had made a move from like 10 to 65, you know, he went through some of the parameters of it and said, yeah, well, it's kind of a call on oil and where it's going. Oil's had a huge move. Are we topped out?
It's kind of interesting because hearing your question, I'm reminded of the October note, which we all debated, from Marko Kolanovic, where he talked about oil at 130, a 10-year at 2.5%, and that we had the ability to handle it. Well, guess what? That's basically where oil and Treasury yields went. So I do think that what we witnessed in the oil futures was a little bit of a parabolic move once the U.S. confirmed its position on Russian oil a few weeks back. That being said, I think the market ultimately is going to settle into a range. I don't think the bottom falls out of the market, even if Russia and Ukraine are to completely resolve this conflict. I think the price of oil still is going to find its bottom somewhere around $85 to $90. And that's going to work well for energy companies, because Degas's point is that the cash generation is going to go to the buying back shares and to protecting that overall dividend. So I think that's the right position to maintain, being long to energy equities. And overall, on the pricing of oil, I think it's going to be an environment like 2011 to 2014, where the average price of oil was $95. I could see us trading in that type of range below that kind of parabolic high from a couple of weeks ago.
I mean, Dr. J, you got Diamondback calls, Kinder Morgan calls, oh, John dropped out. Well, John has a lot of calls, trust me. Diamondback, Kinder Morgan, Schlumberger, XLE, Devon. It's his biggest sector exposure, even though we can't tell you about it. I'll tell you about it. So, I don't know, we'll find out what he's doing. Up next, he's going to do unusual activity. Hopefully he's back, and I'll ask him about the energy positions as well. Before we go to the break, check the S&P sector heat map. Led by the sector that John Najarian can't talk about this moment because he's not here, energy. We're back. We're going to do unusual activity, but John Najarian is back. He's on the phone. It's the best we can do right now. Doc, energy. I want to know if the trade has topped out, and you have a lot of exposure here. I said Diamondback, Kinder, Schlumberger, XLE, Devon. Energy's your biggest sector exposure. All of those that I just read or calls. What do you think?
Yeah, I still think those go higher, Scott. Schlumberger's one Pete did with you just a couple days ago as well, SLB. And I think all of them continue to work, even if the war mercifully ends. The sanctions against Russia are not going to end. And obviously, the cutback because of the Black Sea terminal that got hit by some bad weather and got knocked out, and basically another 1 million barrels just kind of randomly taken off the market. That is why we're seeing prices shoot up all the way back to 114, 115 for WTI. And I think that continues, Scott, for basically months. Are we going to be up and down in energy? Yeah, and Mark Fisher and Joe would be better about telling you about that. But I believe that we're going to see higher prices for longer. That's why I'm holding those stocks, just like Degas has done with his BP today.
So tell me unusual. What do we have today?
All right, unusual. Let's start it off with Baba. Talk just a little bit about it because of unusual activity. Again, a couple weeks ago, and right now, Baba continues to surge higher. This stock, basically below 100 to now 120, and they're buying the 125 calls that expire in 2 weeks. April 8th, not the 1st of April, but April 8th expiration. They bought a lot of those 125 calls. Second one, Iova, I-O-V-A, biotech play, biopharma, if you will, in the cancer space, seeing some nice performance today, and they're buying big upside calls that are out $10 above where the stock is right now, Scott. You know I'm not going to trade those, but I'm going to trade an at the money. The fact that they're pushing these and the fact that they're going to be at a number of conferences in the coming weeks makes me think maybe there's some good news coming for IOVA, and that's why I'm in that stock.
Okay, good stuff, Doc. Thank you very much. Coming up, Adobe shares are tumbling after a disappointing outlook. Shannon Sakosha is on the hot seat next. Why? Because she says it's her favorite stock. Yikes. We're back after this. All right, we're back. I'm not even going to read this, but I'm just going to go to Shannon. Shannon Sakosha, Adobe, your favorite stock is getting hammered today. What do we do?
Well, we take a big step back. Had a good day yesterday, and certainly we saw disappointment here. So if you think about Adobe, you want to think about digital media. And so obviously there's the perception that a lot of this was pulled forward as companies accelerated their footprint in digital media on the back of the pandemic. However, if you think about the installed base that Adobe has, the fact that they're growing 15% earnings, the fact that they're trading at 27 times, that's a pretty attractive PEG ratio versus the S&P 500. The other thing is that the embedded users of the Adobe suite are across all of the digital marketing departments at all of these companies. And so there are going to continue to be plenty of growth. The last couple of quarters, there's been some questions on execution, and I think that's what you're seeing in the stock price today. We definitely want to see that annual revenue per user increasing over the course of the second half of the year, and that should come from new products versus pricing. But overall, I think that if you talk about TAM, and we do all the time, there really is continuing to be growth in the digital marketing space that is not going to abate just because we're coming out of the pandemic.
Let me ask you more specifically. It's very easy to say something's your favorite stock when it's going up and it looks great. Is it still your favorite stock today?
Absolutely. We have a significant overweight in our portfolio in this stock. If we did not, we would be adding to it here. And I think that if you look at your kind of cloud and hybrid positioning in your portfolio, you have Adobe, you have Salesforce. I think that the combination of those two really speaks to the way business will be done in the future for both small businesses and large enterprises.
Joe, you used to own Adobe.
I did. And it's clearly a quality company, as Shannon rightly describes it. I think it was up against some tougher comps here, and there was an impact from exiting Russia and Belarus that had a impact on this quarter. So I think it's a recovery story over the coming quarters. It's growth at a reasonable price. And if you're desirous of owning a technology name that's qualitative in its nature, then you would step in and buy it here. So it's a name I would look at.
Okay. Degas, you still own Adobe, don't you?
We do, and we continue to hold it as one of our favorite stocks also. So I'm joining Shannon and also Joe, because ultimately, if you look at the Russian issue about getting out and stopping subscriptions to Russia and Belarus, it's only less than 1% of their annual revenue, about $75 million. So that's not the real big issue here. That's the driver for the price going down. What the market sentiment saw was that there was not further guidance for the full-year guidance. And because the company stepped back from doing that because we're so early in the year that they didn't want to put out new guidance. And that's what the market reacted to. Once again, it's oversold, and this is an overreaction by the market.
I mean, cloud stocks this month, Adobe, obviously the move today. DocuSign's down 17%, Zoom 11, Datadog 9, Teladoc 10, Coupa 14. Going to be closely watched in the days ahead. We're answering your questions next. You can email us, askhalftime@cnbc.com. We're back in 2 minutes. All right, time for Ask Halftime, and it is a video question for the committee.
Hi, my name's Nigel Sampson. I'm in Lyman, Maine. My question for the team is, what do they see as the prospects for AbbVie this year?
We chose that because we had a lot of ownership. Shannon, you own it. Degas, you own it. Joe, you own it. And Doc, you own calls. So what about it, Doc? Why don't you go first? What are the prospects for AbbVie this year?
Sure. I like it. It's a 3.5% dividend yielder, Scott, so you're getting paid to wait. They're presenting at several big conferences, again, with some very critical areas of healthcare that they address. So any good news could really spike the stock. It's one that is located just north of Chicago, and I drive by the headquarters a lot. A lot of people that are working there seem pretty bullish, so I like the company.
What do you stop when you're driving past there and feeling, Doc? What do you mean?
Sometimes I go skiing with some of those folks.
Okay, just checking. Shannon, you own it.
Mm-hmm.
I do. And actually, Scott, we just trimmed this stock last week because it's done very well relative to the market and to the rest of healthcare. I would look at several key, to John's point, we have several key pipeline data points that have come out this year that have been pretty positive. Really speaks to the ability of AbbVie to focus their next-gen pipeline. But healthcare in general is our second favorite sector, and AbbVie is a great way to play that, a little bit further away from some of the binary nature of biotech. And so if you're looking to increase your healthcare exposure, which I think you should in this environment, this is a great stock to own.
So let's go more broad then, Degas, rather than continue to sing the praises on a stock that I know you own and you like, or you wouldn't own it. What about what Shannon just said to end there? Healthcare, is that a good place to be right now? And if so, why?
Yeah, it's a great place to be because ultimately you're looking at more of a defensive sector as we go into rising interest rate environment, because these companies have what's called pricing power because they're going to have demand for their treatments, their drugs. Also, a lot of these companies have patent protection. And so that's going to mean that there's going to be a low ability to substitute for these treatments and drugs. And lastly, there's barriers of entry because all the research and research development they've put into finding these drugs. So healthcare is a great place to actually invest in this particular market.
So let me ask you this. We'll button it up with one more on AbbVie, Joe. Since you own it, you've owned it for a long time, and you're up 42%, and the stock has hit an all-time high or an intraday high today. Do you keep holding it, or do you take some profits?
So I'm going to shock you because you're going to say, well, this is a classic example of buy high, sell higher. I like what Shannon's doing trimming here. There's a lot of good news that's priced into the stock without question. It is a quality company. I would hold it, but I wouldn't initiate a position here, and I wouldn't add to a position here.
Okay. Want to let you know that coming up on March 30th, that's next week, CNBC's Healthy Returns is back. We feature CEOs of Walgreens, Johnson & Johnson, United Healthcare, plus actionable insights from top investors and much more. Looking forward to that big event. Go to CNBCevents.com to register. You can scan the QR code that's right there on your screen as well. We'll step away. When we come back, we'll do final trades.
Are you following the Halftime Report podcast? What are you waiting for? Real debate and actionable advice from the investment committee, plus unusual activity and more. Look for us in your favorite podcasting app. Follow the Halftime Podcast now.
Mentioned earlier, tune in today, 4 o'clock Eastern Time for Overtime. Tom Lee will join me on set at Post 9 at the New York Stock Exchange, and we will talk about these markets that we're in. All right, Dee gets right. Before we go, you have a new position in LMT, Lockheed Martin.
Exactly, Lockheed, largest defense contractor globally. And it's the drivers here for the catalyst. It produces the F-35 aircraft, and it produces 150 of those a year. The U.S. Department makes up about 71%. It has international sales of 28%. And obviously, unfortunately, with the Russia-Ukraine war, Germany is going to be increasing their military spend from 30 billion U.S. up to 100 billion U.S. That's going to be a market driver for Lockheed Martin. So we like the company, and that's why we purchased it this week.
Oh, good stuff. Give me a quick final trade if you could.
Yes, Cadence Design System. It makes the design tools to develop microchips, and it has a 20% earnings growth rate.
Thank you. All right, Joe Terranova, what you got?
Amazon. It's not a matter of if, it's a matter of when. I will get into this stock. This stock has the most potential for upside of the FANGs. Obviously, it's going to be splitting here at the end of the quarter, and it's about to retake the 200-day moving average, which it hasn't been above since the early days of January.
You let us know when, not if, you buy it.
I will.
Doc.
I will.
Yes, GES, Scott, accelerated stock buyback. I love this one.
Okay, and finally, Shannon.
Costco, thoughtful expansion of a brick and mortar, and none of these customers are going away in an inflationary environment.
Good stuff. Thank you. I'll see you in overtime. The exchange is now.
Love me some Costco. Thank you, Scott. Welcome to the exchange, everybody. I'm Kelly Evans. Here's what's ahead.
Are rising rates actually good for tech stocks? The NASDAQ 100 is up 9% from Monday's close despite today's losses. Last Monday's close, that is. It all happened while the 10-year yield has shot higher. We'll look at whether their relationship has just changed for the better. And a Marshall Plan for energy. That's the call from JP Morgan chief Jamie Dimon, who says the U.S. now needs to help wean Europe from Russian oil. This as President Biden is headed to Brussels to meet with NATO allies. We'll look at whether something like that is already in the works. And on that note, expect the number of EVs sold in the U.S. to double to nearly 1 million units this year. We'll ask the CEO of EVgo if the charging infrastructure is ready to keep up with all this demand. But first, let's get to Dom Chu with the market.
It's red, not markedly so, but still significant. But Kelly, 2 years ago on this day, do you know what it was? You do. I know you do. She's just joshing with us here. 2 days ago, today, it was the pandemic low for the stock market because back then the S&P 500 on an intraday basis, March 23rd, 2020, hit a low of 2191 or thereabouts. So let's do the quick and dirty math. We're about 105%, more than a doubling, if you will, from where we were at the pandemic lows. So 44.84 the last trade there, down 0.5%, fractional declines. 44.84, 34,045 for the Dow, off about 1%, 322 points. In the NASDAQ composite, just down about 0.2%, down 27 points. We'll see whether or not that interest rate story plays out as Kelly talks about the kind of dynamic with valuations. One other place to watch, speaking of, is those 10-year Treasury note yields. Since the beginning of the month, we were closer down to about 1.84% to start off the month. Now we are all the way up to 2.34%, and believe it or not, that's a pullback from the recent highs that we've seen just in the last couple of days. So we're talking going back to all the way May of 2019, highest yield since then. Why isn't the market declining more? I guess we'll find out later on in that discussion. And then check out what's happening with some of these stocks like General Mills, because earnings season still rolls on. Big food processor, big food manufacturing company, General Mills up about 2% off the session highs. But at one point today, we saw bigger gains because this company says that they are seeing still demand for people eating at home. Profits were better than estimates, revenues better than estimates as well. So food companies, again, certainly a focus here. And speaking of, I get to draw a lot of yellow on the screen here with this next particular graphic, because when it comes to Archer Daniels Midland, which is also another food company, ConocoPhillips, Nucor, CF Industries, Progressive, each of these guys gets big gold stars because each of these, Kelly, has hit a record intraday high at some point today. So a nice move higher, especially when it comes to commodities-related stocks and even an insurer in Progressive. Kel, back over to you.
Even as the markets are lower. Dom, thank you very much. My next guest has some good news and some bad news for investors. The bad news, his latest piece is headlined, "The Odds Don't Favor the Fed's Soft Landing." So what's the good news? Joining us now is Greg Ip. He's the chief economics commentator at the Wall Street Journal. Somewhat echoing what we heard from Carl Icahn yesterday on Closing Bell, in fact, when Icahn warned Scott Wapner that he thought we could have a pretty rough patch ahead. As we wait to check in with, there he is. Let's see if Greg is available now. Greg, welcome. It's good to see you.
Hey, Kelly, how are you?
I'm good. So tell me why you think that a soft landing is not something people should be necessarily counting on right now.
Well, if you look at the last three instances of soft landings that Chair Powell referenced in his speech this week, 1965, 1984, 1994, the circumstances are just very different today. First of all, in those instances, they were trying to keep inflation from going up. This time, we're actually trying to push it down because at 5%, it's way above where the Fed wants it to be. So that's number one. Number two, by a lot of measures, the labor market is tighter. At 3.8%, the unemployment rate is lower than it's ever been at the start of any Fed tightening, except for one, which did end in a recession. And the final point, which I think is really key, is look at real interest rates. The federal funds rate is 2 to 3 percentage points below inflation. Bond yields are negative in real terms. Monetary policy is just way more stimulative than it was at the starts of those other episodes. So the way I would put it, Kelly, is that you have an economy that is already traveling above the speed limit, and the Fed, far from applying the brakes, still has its foot on the gas. Trying to reverse that process is not one that I think bodes well for a smooth, soft landing.
You know, the market reaction, at least in the past couple weeks, has been encouraging, though, wouldn't you say? I mean, I was shocked that it wasn't more concerned about what Powell said at the press conference, and then even what he said at NABE this week. you know, when he just flat out talks about, yeah, if we need to, we'll raise 0.5 point, and, you know, we could go above neutral, and markets are taking it in stride, aren't they?
Well, they are, but I'd say a couple of things, Kelly. First of all, in their view, neutral is 2.8%, which actually isn't very high. And if inflation ends up more like 3% instead of 2%, and there's a good case that it will be, then that's still negative in real terms. So if they go a little bit above that to say 4%, 1%, which would be 1% in real terms, that's nothing to get too worried about. And the other point I'd make, Kelly, and this is really key, is that inflation is a two-way street. If it drives up interest rates, that's bad, but it also flows to the bottom line. You know, a second ago, you were talking about General Mills. One of the reasons they raised guidance today is pricing power. If you can raise prices, in other words, if inflation is going up at the same time as interest rates, you don't really worry that much. So stock valuations, in some sense, are a little bit immune to higher nominal rates as long as they're compensated by inflation. That's exactly the set of circumstances that the Fed cannot allow to persist, because if you're not getting real interest rates higher, you're not applying the brakes.
You use a phrase in your piece that Bill Lee used when we talked to him yesterday. He was skeptical that the Fed could achieve an immaculate disinflation, which is something that you are looking at as well. I mean, why is that outcome so unrealistic? And what are the trade-offs from fighting to pull down inflation?
Well, you're familiar with the Phillips curve, right, which is this age-old relationship that says when the unemployment rate is high, inflation is low, and so when inflation is low, unemployment is high. And what that tells you is that both in theory and the Fed's models and historically, that if you start out with very high inflation, getting it down requires higher unemployment. It's not pleasant, but that is more or less how the models work. The Fed doesn't see that. They seem to think you can get from 5% inflation now to a little over 2% without any rise in unemployment. That's what we mean by immaculate disinflation. The argument sort of like goes as follows. We have some supply disruptions. They'll work their way through the system. More people will flood back into the labor market as the pandemic recedes. That will hold down wages. And inflation expectations, which influences people's actual behavior, are still anchored at 2%. Look, I want to give them some credit. All those facts are true, and they all may yet work out. Moreover, it's still actually kind of the consensus on Wall Street that it will work out. I'm just saying that historically it hasn't. Historically, if you are trying to get inflation that's too high down to something lower, you've needed to put pressure on the economy, and unemployment has tended to rise. And every time unemployment has risen by at least 0.5 percentage point, you get a recession.
Yeah, and that's not a very big move. The double dip recession of the early 1980s probably being the classic case. Greg, I was going to say it's great to have you. It's sobering to talk to you today. Thank you so much. We appreciate it.
All right. Thanks,
Greg
Kelly.
Ip with the Wall Street Journal. All right, we just had an auction of 20-year bonds, which I think this week have been amongst the highest yielding part of the curve period. Let's get to Rick Santelli, see how that went down today. Rick?
Yes, highest yielding Treasury maturity on the yield curve for a bit now, actually. And this auction is a 19-year, 11-month. We're adding to an auction that was originally open last month. After all that, I will tell you the grade is A+. This was a fantabulous auction in terms of demand. Let's think about what that says. Everybody's been biting their fingernails. Think about home shoppers, about interest rates skyrocketing the last couple weeks. But yet, all these investors tried to catch that falling knife, so $16 billion of the 19-year, 11-month yield, 2.651. That is below the low of the when-issued market that I was monitoring right up to 1 Eastern. Lower yield, higher price. All the metrics except for indirect bidders, which were still above the 10 auction average, were the best they've been ever for a 20-year bond auction, keeping in mind that we brought them back in May of 2020. So stellar performance, and I really do think that gives us a bit of a reprieve on rising rates, and I think I know what they're looking at, Kelly. Everybody's talking about this giant rebalancing for the end of the first quarter, and the tail is wagging the dog with respect to they're buying treasuries and selling equities, trying to get ahead of the big pension crowd that seems to be strategically doing the same towards the end of the month. Back to you.
Great point. 265 the yield on that 20-year. Rick, thank you very much. Rick Santelli. All right, speaking of which, let's take a closer look at the NASDAQ right now, which has been surprisingly resilient to interest rates shooting higher. Remember, go back to the first few months of 2022. We saw the 10-year yield jump about 40 basis points, and during that time, the NASDAQ dropped more than 9% as high valuation names imploded. But fast forward to today, and it's a very different story. From the start of March, the 10-year has jumped about 60 basis points, and at the same time, the NASDAQ is up 6%. Let's turn to the man who called it, CNBC senior markets commentator Michael Santoli. Mike, you warned us not to make too much of this relationship, but why has it changed now?
Well, Kelly, I don't want to take any credit for having really called any short-term market move. I've just been skeptical in general of how this direct linear perception of this relationship between yields and growth stock performance was overplayed. And I think it's one factor among many, many, many. And it has had some connection to relative outperformance of big quality growth stocks relative to cyclical value stocks over the past year or so, but it's only one tiny influence. I don't really buy the argument that the market in real time is trying to figure out the value of long duration assets, such as a share of Microsoft, based on the discounted value at today's risk-free rate. It's just not the way the market operates. Now, most of the times when tech was outperforming and yields were falling, why were yields falling? People were concerned about the pace of the reopening. People were concerned about relative earnings growth of cyclical companies. And so you go to those companies that are seen to be more steady. Final point is the NASDAQ, the average NASDAQ stock fell 45% from its high to low, some point last year to the recent lows. That tells you we're not really fine-tuning these valuations based on wiggles in yields. And, you know, if you go back to 2018, the 10-year yield went from around 2% above 3%. Tech outperformed by a lot over that period. We didn't talk about it. We started talking about it when we needed explanations for why people were racing into every single software stock and paying massive valuations. And we convinced ourselves it was because yields were staying low.
I guess to me it would make sense that sort of higher yields were a proxy for liquidity coming out of the system. I mean, I don't know to what extent that's true, but it seems like that there's been this kind of giant sucking sound that's collapsed everything from IPOs to SPACs to high valuation stocks to meme stocks to some of the high-flying crypto names. So there seems to be some larger relationship, although I don't know how we would determine cause and effect.
I do buy that, Kelly, that there is an element of that there's a sense that when yields are going higher, and in theory it should be because capital is being used for real world purposes a little bit more than just for, you know, financial speculation, things like that. Again, that's on paper. It's a textbook explanation. It does make some sense. I will give you that. But to me, it's not so much that you want to put too much trust in that being the swing factor on a day-to-day basis necessarily. And you know, I just feel like there's so many things that if you were going to buy the ARC portfolio in January of 2021 and pay 12 times forward sales on unprofitable businesses, you needed to persuade yourself of many, many things, including the size of the addressable markets, how much market share they were going to get, you know, exactly how fast this transformation was going to happen, and other people were going to buy it from you at a higher price. And finally, maybe you also had to say, and rates are going to stay really low for a long time, and therefore liquidity is going to remain high.
I take your point, though. So where do we go from here? And again, a lot of the big tech names have been consistently called out for having pricing power, positioned to do well in an inflationary environment, don't have as much exposure to headcount as other parts of this. So a lot of positives for a place like now. We talked to our friend Paul Hickey at Bespoke, who said tech usually outperforms during a rate hike cycle. It's outperformed in the past week. Where do we go from here?
I think what it basically comes down to is if quality and relative earnings durability are going to come back into favor, those types of growth stocks and tech stocks that have those attributes would probably do well in this environment, right? Because we're talking about a general slowdown in earnings growth. And so if that's going to be the concern, it's going to be those stocks that probably do well and not the Goldman Sachs unprofitable tech index, right?
Yeah.
So I think we're probably going to be drawing those distinctions. Finally, if inflation stays high and it's a high nominal growth economy and somehow we stay at a recession, it doesn't necessarily mean that that top line growth is going to be scarce and maybe big tech is not going to be the leader.
Oh, it's fascinating. Michael, thank you as always. We appreciate it. Mike Santoli. Coming up, President Biden heading to Europe for meetings with the EU, the G7, and NATO. Is a Marshall Plan for energy a real possibility? We're live in Brussels next. Plus, major chipmaker CEOs are on Capitol Hill making the case for billions of dollars in subsidies for their industry. Should Congress cut them a deal? And as we head to break, let's get a quick check on markets, which are red across the board. The Dow down 336, the NASDAQ down 1/3%, so it's actually outperforming. And the 10-year yield, 233. We're back in a moment.
This is The Exchange on CNBC.
Welcome back to The Exchange. Tomorrow marks 1 month since Russia began its invasion of Ukraine. And President Biden is set to meet with NATO leaders as the world tries to gauge just how much Russia has gained in that period of time and what measures it might resort to next. Kayla Tausche is in Brussels with what we can expect from tomorrow's emergency summit. Kayla?
Well, Kelly, President Biden is currently on his way here to Brussels, where tomorrow he will be meeting with the leaders of NATO, the G7, and also the European Union as they try to discuss next steps to assist Ukraine in its fight against Russia. Tomorrow, the U.S. and its allies are expected to announce a few items to ramp up pressure on Russia, another round of sanctions, an increase in NATO troops across the eastern flank that could be longer term in nature, more humanitarian aid for Ukrainians, and a plan to offset Russian gas for Europe, with President Vladimir Putin of Russia now demanding that Europe pay Russia in rubles for its gas beginning next week. Today, NATO Secretary General Jens Stoltenberg said membership for Ukraine in the alliance is not on the agenda, but that the group will be discussing providing additional defenses for Ukraine as it tries to guard itself against chemical attacks or cyber attacks. Stoltenberg also saying that the role of China will be discussed.
China has provided Russia with political support, including by spreading blatant lies and disinformation. And allies are concerned that China could provide material support for the Russian invasion.
The White House, as of yesterday, says that so far no military or material support by China for Russia had happened, although that could change, Kelly, at any moment.
And to your point, Kayla, about Russia being asked to be paid in rubles, an advisor to Draghi has said Italy's not inclined to do so. Germany has said paying for gas in rubles would break contracts, so it's unclear that
of tomorrow, those kinds of dangerous contingencies.
Right.
But underneath it all is, does NATO, does the U.S. have to get a little bit more involved in order to save Ukraine?
Wow, well, that is very well put in terms of us understanding the tensions and the discussions here. Fred, great to have you. Thanks so much.
Thank you, Kelly.
Fred Kemp with the Atlantic Council. Still ahead, charging company EVgo just gave full-year guidance that fell shy of Wall Street estimates, even as the U.S. is expected to sell a record number of EVs this year. We'll speak exclusively with the CEO about the industry's growing pains next. Plus, new data on Moderna's COVID vaccine for kids under 6. What it is and what the next steps are. Moderna shares are actually down today. And as we head to break, the Dow is at session lows. Home Depot, one of the biggest laggards there. Only about 7 names are in the green. Apple leading the way. We're back in a moment. Welcome back to the exchange. Markets are at session lows right now. The Dow's down 382 for a more than 1% drop. The Nasdaq down 0.8%. The S&P down 41, 44.70 there. So again, we're below 4,500 by a pretty decent margin. Energy is the outperformer as oil rebounds to around $115 a barrel today. You can see that sector up 1.6%, while healthcare and financials are lagging. Clean energy is also in the green today with Enphase, Azure, SolarEdge, and Sunrun all gaining in the range of 3%. In fact, the Invesco Solar ETF is actually outperforming oil and gas over the past month, although solar is still about 23% off the highs. The housing names are getting hit again as mortgage rates spike. The XHB and the ITB, those are both down more than 20%, those ETFs this year. You can see Horton and Williams-Sonoma, for instance, down another 5% today. And you can't talk rates without mentioning the banks. The KBE, the KRE, that's the regional ETF, both down about 5% in March for their worst month since June. And let's check on some of the China tech names. iQIYI, Pinduoduo, and Bilibili. Strong gains again today. iQIYI up 13%. It's almost a $5 stock, but at its highs, it was trading at 46. Let's get to Rahel Solomon now for a CNBC News update. Rahel?
Hi, Kelly, and here's what's happening at this hour. Supreme Court nominee Ketanji Brown Jackson back on Capitol Hill for day 3 of her confirmation hearings. She responded to senators seeking to portray her as a potentially activist justice. She reminded them that the Constitution gives Congress the power to make laws and the judicial branch the power to interpret those laws. In Arkansas, the first arrest in the car show shooting that killed 1 person and injured 26 on Saturday. 22-year-old Brandon Deandra Knight has been charged with battery and first-degree assault. Police had said that the shooting was the result of a gunfight between two people. And in Brussels, NATO Chief Stoltenberg says that the alliance will double the number of battle groups on its eastern flank as part of efforts to deter Russian attacks on NATO countries. Stoltenberg also warned Russia against using nuclear weapons following its invasion of Ukraine. He says that Russia must understand it could never win a nuclear war. And on the news tonight, what are Putin's likely next moves as the invasion of Ukraine drags on? That's tonight at 7 Eastern. Kelly?
All right, Rahel, thank you very much. Coming up, when it comes to the Fed, it's a matter of would versus should, according to one money manager. Why she says the number of hikes doesn't really matter and has the names to buy as rates climb. That's next. And check out shares of Tesla, which hit over $1,000 a share earlier in the session, $1,040 to be exact. We'll speak with the CEO of charging company EVgo about the electric vehicle ramp up as oil and gas spikes. Stay with us. Welcome back to the exchange. Stocks are slipping today on concerns from oil to supply chain disruptions and, of course, inflation. My next guest says the market is overshooting what the Fed will do this year, and it doesn't matter how many times they hike rates because real rates will still remain negative. Joining me now is Nancy Tangler. She's the CEO and Chief Investment Officer at Laffer Tangler Investments. Nancy, it's great to see you.
Thanks, Kelly. It's so good to see you.
Why is it so important to focus on real rates? And I mean, you're absolutely right. By the Fed's own projections, even with as hawkish as they were last week, real rates would still be negative through the end of next year.
Well, Kelly, this has been the exception to every rule. And so, and I think you've written some really provocative pieces on this, starting with the piece you wrote last week or the week before, where you argued or pointed out that the 3-month 10-year had actually steepened on the Fed's first announcement of a 25 basis point cut. And then you quoted Esther George, who said, if the Fed wasn't in the market buying securities, we'd probably have a 10-year at 3.5%. So it may be that I'm wrong about this, but historically, the way you break the back of inflation is you raise rates above the inflation rate. And, I was managing money in the Volcker years in the second half. I want to point that out. And stocks, during his tenure, stocks were up 360%. But he raised the prime rate to 21%. That's where prime went. So, and inflation was at 14.5. It took a lot to break it. And I think what's different this time is that in normal Fed hikes, you have the reflective phase where the Fed's raising rates to reflecting a strong economy, and then we move into the restrictive phase. Well, in this case, we have PMIs that are rolling over. Usually PMIs are going up when the Fed raises rates, and we've had a year of global central banks raising rates. So I think it's going to be difficult for them to get there, though I wish they would, and I wish they'd do it quickly. I just don't think it's going to matter that much. I think the balance sheet's probably going to matter more.
Well, what you're saying reminds me of what Larry Summers was writing in the Washington Post earlier last week, where he said, they might have to go to 5% or something of that magnitude to achieve those goals. And obviously that's not in the market. So you're kind of saying a lot of this is noise until or unless we get to such a point. And you've looked back at that cycle kind of a little different, but just because it gives a recent example, the early 2000s, what outperformed then? What does it point to in terms of the parts of the market you want to focus on for this kind of difficult time we could be facing?
Yeah, it's somewhat analogous. You're right, though it's not entirely analogous. Rates went from 1% to 5%. I can't remember how many hikes there were. And there were other things going on, obviously, in the economy. But what did well counterintuitively was technology, energy, materials. Those were names that stand out to me. And, we also have rising inflation. And so, as we all well know, but many of those names benefit from that as well. So we like, things like EOG, which is a great natural gas play. Their capital allocation to shareholders has been robust, and they paid 3 special dividends in a year, and they've doubled their dividend. Wow. We like Steel Dynamics, which is, kind of an ESG-ish steel company, if you will. They're trying to find alternate ways to heat the flat roll steel other than just energy or oil. And we like other names in technology and defense.
Yeah, Palo Alto, LHX you mentioned. So let me ask you, when the debate is kind of happening where we have Greg Ip's piece warning it's going to be hard for the Fed to achieve a soft landing, and Carl Icahn warning that we could be in for a very hard landing ahead. And yet you've got some names here in a general sense of being constructive on the market. So what would you tell investors about kind of the range of outcomes we could be facing?
Yeah, I mean, I've seen one soft landing in my career, and that was in '94 with Alan Greenspan after a series of rate hikes. I don't think this is that. So I do think that the economy is going to be, well, we already know it's slowing, and it was slowing before Russia invaded Kuwait. And we also know that earnings have to come down, but nobody has begun yet to revise earnings estimates down. So in this kind of an environment, you want to have reliable growers. Dividend growers are even better because dividend growers are going to be a hedge against inflation. And so many of the names, except for Palo Alto that I mentioned, have strong dividend cultures and policies, and managements are raising dividends. So I don't think it's all bad news. They expect to see the ability to deliver decent earnings, and I think you'll get decent returns in the stock market, barring a serious recession. I don't think we're going to get that. First of all, I think we're a year away at least, and it'll be short and shallow when we do get one, because there's a lot of good things going on in this economy, not the least of which is tech CapEx spending, which drives productivity and people beginning to return to work. Now maybe because they have to with higher levels of inflation. So the participation rate is inching up.
Yeah, no, and with everything going on that you described, most people just throw their hands up and go, I can't make sense of that environment. So I really appreciate the sort of advice on look for those dividend names as dividend growers and some of the other sectors that could navigate this period. It's great as always to have you, Nancy. Thank you.
Thank you, Kelly.
Nancy Tangler with Laffer Tangler Investments. And as we head to break, let's do a little show and tell. The chip stocks getting hammered this year as both COVID-related and geopolitical supply chain headwinds persist. Intel actually faring the best of the group, only down about 5%, whereas AMD is down about 20%. Intel CEO Pat Gelsinger on Capitol Hill today to urge Congress to pass a bill to support the industry. He also appeared on Squawk Box beforehand, stressing the importance of moving manufacturing to the U.S.
We're either going to invest in this industry, now to see it rebuild, or we're going to decline. And today, 12% in the U.S., half of that's Intel. This is precarious. And that's part of the reason for my urgency and passion on this topic right now, because I fear if it starts dropping below 10% very far, we might never recover, and we will have a permanent dependence on Asia and other parts of the world that are just geopolitically unstable for the long term. We must act now.
Welcome back. Chips are mostly lower today, with Micron one of the worst performers in the NASDAQ 100. It's down 4.5%. Executives from the industry are testifying before Congress in support of the CHIPS Act. Elon Moy on Capitol Hill with the latest for us. Elon?
Well, Kelly, that bill would funnel $52 billion to the domestic semiconductor industry. And during today's hearing, lawmakers framed this funding as a national security priority.
China has also demonstrated aggressive behavior toward Taiwan and stated its intent to challenge Taiwan's sovereignty and independence. Taiwan now accounts for 92% of the world's most advanced semiconductor manufacturing capacity. Think of the consequences if China were to invade our Taiwanese partner.
But that issue cuts both ways as well. Republican Senator Rick Scott challenged Intel CEO Pat Gelsinger over the business his company does in China and his commitment to restoring American manufacturing.
Concerns that I have around the geopolitical situation drive the passion and urgency to build this industry in the U.S. This is a core reason why we are here. We have allowed this industry to shift to Asia. It is time for us to get it back onto American soil. And we are passionate about that. That's why the CHIPS Act is so critical to get it done now.
Now, earlier today, the Senate did vote to move forward with formal negotiations over the broader innovation package that includes the funding for chips. And Kelly, lawmakers say they hope to get this passed before the summer. Back to you.
Does it look likely at this point?
Yeah, there is bipartisan support for it. That vote in the Senate had 66 senators, Republicans and Democrats, voting in favor of it. So clearly, both sides of the aisle like the idea of this funding and the idea of the innovation package. The challenge here will be sort of hammering out all of the ancillary things that will ride along with this package, like research priorities, whether it'll include trade provisions. There are handouts to other types of industries as well that are included. So if they can get all those details right, this does have a good chance of passing. But again, in Congress, the details sometimes can be the whole game.
Yeah, exactly. It's a big if, but we take your point. Elon, thank you very much. Elon Moy on Capitol Hill today. Still ahead, there may be a silver lining in Europe's energy crisis for the EV companies. We'll focus on the U.S. stocks with European exposure, including this name down 30% over the past year, why it could see a boost. We'll talk to the CEO of EVgo about the company's push to get charging stations across the U.S. as demand surges here. We're back in a moment. Welcome back. The EV charging names have taken a hit over the past year. Could Europe's move away from Russian energy be an opportunity for a turnaround? Pippa Stevens is here with a look at some of the U.S. names that could benefit. Pippa?
Hey, Kelly. Europe is rethinking its dependence on Russian energy, which could mean opportunity for electric vehicle charging companies. Moving away from Russian oil means more EVs, which means more chargers. Public charging points are key, and at the moment, there's a big disparity between countries. As this chart from Raymond James shows, you can see not a lot of infrastructure in Eastern Europe. Now, part of this, no doubt, the paradox that low adoption won't incentivize infrastructure and vice versa. Now, in order to reach decarbonization goals, public chargers in the EU need to grow 15-fold by the end of the decade to 3.9 million, according to Raymond James. This translates to between 3 and 4 billion euros in capital spending per year. Now, the market is fragmented, and there are some U.S.-listed charging companies that have exposure to the region. That includes ChargePoint, Wallbox, Volta, and Tritium, which just began trading in January. Important to note, though, that these stocks are all down sharply for 2022, and none of these companies are profitable. But certainly a lot more focus these days on EV infrastructure, both in the U.S. and Europe, Kelly.
Absolutely, Pippa, thank you. And speaking of EV charging names, a chopping trading day for EVgo after they beat revenue estimates but reported a fourth quarter net income loss nearly triple that of a year ago. Stocks up about 25% in the past month as energy prices spike and the EV push ramps up. Is America's charging infrastructure equipped to meet growing demand? Let's welcome in Kathy Zoe. She is the CEO of EVgo. She was also chief of staff for energy policy under former President Bill Clinton. Kathy, it's good to see you again. What accounts for the wider loss?
But we are actually on task to grow and meet demand for the charging needs for the United States. I mean, your intro was talking about the European players. EVgo is focused on the massive market growth that's happening here in the United States. And we, as a growth stage company, we are building ahead of demand and we're investing in that growth to meet that demand. Our focus is on fast charging. And so we're deploying across the country in partnership with General Motors, Toyota, and a number of others to provide convenient, reliable, fast charging for drivers all across the country as new models of EVs become available.
Would you partner with a company like ChargePoint, or are you more competitors?
No, we have different business models. ChargePoint, what we do is we build, own, and operate charging infrastructure. ChargePoint sells equipment, and what we do is we have roaming agreements with customers that are on ChargePoint's network. We also focus on the fast chargers that will give you 150 miles of range in about 15 minutes. ChargePoint's focus has been largely level 2 chargers, where you get the same range, 150 miles in, say, 4 to 6 hours.
Right.
So different use cases, different needs, and different business models.
Right. Some people can plug in all day at work, or maybe they want to take a really long lunch, but a lot of other people need to charge on the go. We are seeing, I can certainly say anecdotally, starting to see some monthly data showing it. It's a spike in interest and sales of EVs. What's that going to do for wait times?
At the charging infrastructure, at the moment, look, EVgo's got a network that can ably handle all of the EV sales that are expected to occur in 2022. So the infrastructure that we're putting out there right now is designed to meet that growing demand that's going to be happening with the cars that come out in 23, 24, and 25. Our business model is that we build slightly ahead of demand. We do the Wayne Gretzky thing where we skate to where the puck is going to be, but not too far ahead of the puck, because we're deploying investor capital in ways that's going to pencil to double-digit returns for our shareholders. So we've got plenty of headroom right now in the market for all of those EVs. We hope that the car companies are able to meet that demand, because as you've pointed out, the consumer appetite for EVs is just growing astronomically.
It is. So if Tesla, which again, its stock back over $1,000 a share today, they just opened Giga Berlin, Giga Austin is about to come online. We're talking about a lot of Teslas on the road and a lot of demand for their superchargers. If they open those up to all EVs, and Elon Musk has talked about it, but who knows when at this point, what would that mean for your business?
We actually have a lot of Tesla drivers on our own network. So I think roughly 8% of our usage on the EVgo network is from Tesla drivers. Tesla has been so successful at getting cars out there that the Tesla supercharging network is actually pretty busy with Teslas. So Tesla drivers are coming over to EVgo because we site our chargers where drivers want to be anyway. We're a grocery store parking lot. So you can plug into an EVgo station while you're going shopping, or while you're taking your daughter to piano lessons, or wherever that might be. So we actually see that there is an overall need in the market for more fast charging, not less. And we're delighted that others are in the market to help satisfy that demand.
Final question, how do you get more EV chargers, not you guys per se, but the industry, into urban areas, inner cities, lower income areas, the places where there's certainly a need to transfer away from reliance on fossil fuels, but it's just exorbitantly expensive and unrealistic to do so?
EVgo has a commitment to electric for all, and we actually build our stations primarily, historically, in metropolitan areas, because we like to site where driving happens. We are in a variety of different areas within metropolitan areas. We're in over 30 states and 60 metropolitan areas right now today, and that's growing really, really quickly. And that's to meet the needs of all kinds of EV drivers. A substantial portion of the rideshare community, and then Uber and Lyft among them, are electrifying. And those drivers need to charge fast every day, and they're good users of EVgo's network. And they're all over cities around the country.
All right, Kathy, thanks again for your time. It's good to see you.
Pleasure. Thank you.
Kathy Zoe of EVgo. Up next, Moderna releasing new data about the efficacy of its vaccine in young children. We have the details right after this quick break. Welcome back. Shares of Moderna are lower today, but up about 20% this month. The company releasing new data about the COVID vaccine efficacy in children. Meg Terrell here with the numbers and what's next in terms of steps here, Meg.
Hey, Kelly. Well, this is data in kids, babies down to age 6 months, up to age just under 6 years old. And Moderna says the study met its primary endpoint, and it plans to file with regulators in the U.S., Europe, and elsewhere within the coming weeks. Now, the primary goal of this study was showing a similar immune response or level of antibodies in kids with this quarter dose as young adults, 18 to 25, who get the full dose. And they showed that. This was done in a time when Omicron was the predominant variant in the United States. And so similarly, they saw lower vaccine efficacy against mild disease, about 38% in the older age group, 44% in the younger age group. So of course, that's below that 50% threshold we've often heard about from the FDA. However, Moderna moving forward because this study met the primary goal of that antibody response. Now, safety is incredibly important in especially young children. This is one of the reasons Pfizer went down to such a low dose to try to avoid fevers. Moderna saying no new safety concerns or myocarditis observed in this trial. The tolerability tolerability, it says, was consistent with other commonly used pediatric vaccines. You did see a rate of fever, any fever, of about 15 to 17%. High fever above 104 was pretty rare. So the question now, Kelly, is what will the FDA do with these data? Will they move forward based on the fact that it met the primary goal? Will they focus on that 50% efficacy rate when we're in a different world with the Omicron variant? The expectation is that high antibody level should confer protection against severe disease, but they didn't see that in the trial. So it's a hypothesis at this point.
And
Kelly?
did you say no myocarditis at all was detected?
That's right. None was reported in the trial. However, the trial was about 7,000 kids, which is, not a small trial, but it is so rare you might not see it. It's not expected to turn up in such young children, though.
Oh, it's not interesting. No, it's parents are always trying to consider all of these risks in this balancing act, and should you, shouldn't you, and are they going to require it, and are they not? And as many places look to try to drop the mask mandates, it becomes more important. Meg, we should mention CNBC's Healthy Return Summit a week away. The intersection of innovation and investment, some of the sharpest minds in healthcare. And we're not just talking about Meg Terrell. Go to cnbcevents.com. You can sign up for that, and we are really looking forward to it. Meg, thank you so much. That does it for The Exchange, everybody, and Power Lunch begins right now.
Kelly, thank you, everybody. Welcome to Power Lunch. I'm Tyler Matheson. Here's what we've got for you this hour. A bear market rally, stocks pulling back today after a short-term rebound. Our market pro this hour says buyer beware, calling this recent run higher a head fake. And an energy Marshall Plan. That's what J.P. Morgan's Jamie Dimon is proposing. He's reportedly calling for additional gas production along with renewables as a way to achieve energy security. It's a plus and not an either or. Is it the answer to reduce reliance on Russian petrodollars? We'll explore that issue. Kelly?
All right, Tyler, thanks. Hi, everybody. And stocks are firmly in the red this afternoon, just off session lows with the Dow down 357 or 1%. The S&P down 39 to 44.72, so we are below the 4,500 number. And the NASDAQ down 110 points or 0.75%. Now, energy is rallying, but that's because oil prices are spiking again. Marathon, Schlumberger among the top performers in the S&P. 4% gain for WTI, just under 114 a barrel right now. Marathon on up 3 1/3%. The 10-year yield surpassed 2.41% at the session high earlier on. Wow, it's now down 10 basis points from that level, so it has continued to come back throughout the afternoon. You can see that drop there. We also had a strong 20-year auction that Rick Santelli told us about, but a lot of confusion around these recent narratives. Bob Bassani is at the New York Stock Exchange with some clarity, maybe, Bob, on what might be emerging.
Well, it's sort of like choose your own narrative. That's sort of what's happening. There's a real big problem here. It's driving everyone crazy trying to figure out the right way to look at the markets. It's not usually this hard, folks. Here's the central problem. The two biggest issues are inflation and interest rates. And on both, there's an enormous range of potential outcomes this year. On inflation, some believe it will moderate because high prices for cars and gasoline, housing will result in some demand destruction. Others believe it will take several years to untangle. Now, on interest rates, half the traders love the Fed talking tough to get inflation under control. The other half are afraid hiking rates too fast will lead to a growth slowdown and demand destruction. All right, so what does all this mean for stocks? So there's a narrative developing out there that it's going to be very hard for stocks to rally back to old highs in this environment. Why? Well, because the Fed wants to slow inflation, but big stock rallies create a wealth effect that fuels inflation. So big rallies make the Fed more comfortable hiking rates. So instead of the old Fed put on stocks that the Fed will help the markets if they fall apart, some say there's now a sort of a Fed ceiling, that the chances the Fed will keep raising rates is higher when stocks are higher. Kelly, no wonder everybody is frustrated. I mean, think about this. Everyone used to believe in the Fed put. The Fed will protect the markets if it drops too much. Now people are saying, my heavens, if the market goes up too much, the Fed's going to keep hiking rates. So there's kind of like a Fed ceiling right now. It's kind of like a Fed collar almost, to use an options term. No wonder everybody's pulling their hair out trying to figure out what's the right way to look at things. The range of outcomes is enormous on inflation, oil, and interest rates. That's the central problem.
All right. Thank you very much, Bob. Our next guest says the recent bear market rally is a head fake and that the market is littered with too many unprofitable stocks. But he has a list of names he says that are worth buying right now. David Traynor is CEO of New Constructs, an investment research fund. Mr. Traynor, welcome. Good to have you with us. When you say a head fake, I assume you mean that this is a sucker's rally. Don't get pulled in because there's more volatility and possibly more steep air pockets ahead.
Yeah, that's right, Tyler. I mean, look, we've seen 20 years of ultra loose monetary policy pushing prices across multiple assets, even new asset classes like NFTs and crypto higher and higher. That liquidity is drying up. We've seen that already manifest in the SPAC market drying up and a lot of these hyper growth, unprofitable stocks coming way down. It's a regime change, and it's a world where fundamentals matter, valuations are going to matter. And that means that this rebound we saw in some of these meme stocks, super high valued, other unprofitable tech stocks that we've seen recently, it's a head fake. And investors should use this as an opportunity to get out with a little bit of profit in their pocket.
Yeah, so when you say hyper growth, but no profit stocks, you mean growth in revenues, but they're not making money. The same kinds of stocks that ran into trouble in the year 2000, 1999, 2001.
You know, that's right. Look, I mean, gravity is real. And in the stock market, gravity is about profits. And a stock ultimately has zero value if the business never makes any money. And as much as the top line can be alluring, and people like to believe that this company is the next Amazon and they're going to all of a sudden become profitable if they just grow enough, that doesn't happen very often. Amazon is an anomaly. It is not the rule. And too many people like to believe that some of these unprofitable tech stocks are going to become the next Amazon. And hope is not a good strategy in that situation.
David, what would your sort of overall advice be to investors? Is it specifically the Fed tightening that you think they have to focus on here?
I think the Fed tightening marks a regime change in how you invest. For the last 10 years or so, there's been no risk. Right? I mean, look, you get great upside with almost no risk. Buy the dip has worked and worked and worked because there was a Fed put. And like the last guest, Bob Pisani, was talking, right? The Fed put has now changed. It's gone. It's more like a Fed ceiling or Fed call. And so that just means that you have to invest in the old-fashioned way, which is focus on fundamentals. Make sure that you're buying stocks in businesses that actually make money and are priced appropriately or cheaply. And that's all it means. And there's no free money or easy money in piling into momentum-based names like there was in the past. So it's not that you shouldn't invest. You just invest in a different way. The old way isn't going to work. The new way is the old way now. Right? Meet the new boss, same as the old boss.
Let's look at a couple of stocks that you say are potentially profitable ideas, beginning with O'Reilly Automotive and one that is in a very different kind of business, Royal Bank of Canada. What do they have in common that makes them appealing to you now?
Cash flow and cheap valuations. Both are generating a ton of cash flow. That cash flow is growing, and they're trading at stock prices that imply that their cash flows will permanently decline. So it's in a completely different paradigm of risk reward to like a Robinhood, which isn't making any money and whose stock price implies his profits are going to be bigger than Schwab. Right? That's really bad risk reward. We'd say avoid that no matter what, but especially in this environment. And then if you have an opportunity, on the other hand, to invest in a company like O'Reilly Auto Parts, whose cash flows are tremendous and whose stock price implies profits are going to permanently decline by 10%, I mean, it's obvious, right? Like a completely different paradigm of risk reward, and really one where investors can find enduring value, not just in this kind of market, but I think in any kind of market.
And two more, Universal Health Services and Domino's.
Domino's delivers. Most people don't realize that Domino's doesn't actually own most of its franchises. It specializes in supply chain expertise and technology to help their franchisees be more efficient, and they've done that. Domino's has is a top 5 company in the entire S&P 500, including all tech companies. Top 5 return on invested capital over the last 5 years. Super profitable business, generating tons of cash flow. Stock price implies profits are going to decline something like 30% permanently. It's almost like it's priced to go out of business, right? And that's what investors, I think, so much have forgotten. You want to buy stocks that are cheap, right? And have great cash flow. It's a strategy that works in any kind of environment, but one that's especially important now.
All right. We have to leave it there. Thank you very much, David Traynor. See you again soon.
Thank you.
Appreciate it.
Well, despite his warning, shares of GameStop are higher again today, and they're up more than 50% so far this week. Is meme mania back? Frank Holland joins us now. Frank?
Hey, Kelly, possibly a reversion to the meme? Probably too soon to tell. Either way, GameStop up double digits as Chairman Ryan Cohen bought 100,000 shares Tuesday, raising his stake to 12%, but still no details on the plan to transform GameStop into an NFT marketplace. Still, this tweet about putting his money where his mouth is really racking up the likes. But GameStop and those other OG meme stocks like Tesla and AMC, they were really on a tear even before that buy. S3 Partners out with a note today saying retail traders have really seized on shorting of the meme stocks. They also said this specifically about Tuesday's rally. The short squeezes we saw in each of these stocks today helped their stock prices trend higher. If the stocks continue to climb or at least hold these levels, we should see the squeezes continue and more short covering. There's also been a rise in technical analysis on Wall Street bets, believe it or not, and traders really digging into fundamentals of all stocks, including those meme names, according to research from Thinkum co-founder Justin Zen. The high volume trading for GameStop and AMC also continuing today. GameStop already at 600% of its 30-day average volume. Back over to you, Tyler.
All right, Frank, thanks very much. It's really amazing that these stocks come back into focus the way they have here.
And because we were talking to Kate Rooney yesterday about how Robinhood has kind of, we don't want to say given up on the trading.
They're selling retirement
model,
plans.
But yeah, they're hawking 401ks and savings accounts and debit cards.
All right, coming up, folks, an energy Marshall Plan? Well, it's a bold idea reportedly being pushed by J.P. Morgan's Jamie Dimon. Is it a realistic long-term solution to achieve energy security, not just here in the U.S., but in Europe? Plus, home builder stocks under pressure this afternoon as new home sales unexpectedly fall and mortgage rates rise. The two are not unconnected. Should you invest in the sector as it changes? Those stories and more when Power Lunch continues.
Welcome back. Jamie Dimon reportedly telling the Biden administration there needs to be a Marshall Plan for energy, a plan to get Europe off of Russian oil with help from the U.S. And we should say a big chunk of this is about natural gas. Let's bring in Brian Sullivan now. Brian, could something like this actually work? Is something like this actually in the works already, maybe?
Okay, two different questions there, Kelly. So let's go ahead and know what we know and what we don't know, the known knowns and the known unknowns, if you will. All right, so what we know is that a bunch of CEOs, including Jamie Dimon, met at the White House yesterday, included ExxonMobil, ConocoPhillips, Visa, Bank of America, I think. Anyway, in that meeting, according to reports, Axios broke the story, Jamie Dimon said that we need that Marshall Plan you talked about, maybe rebuilding energy security through Europe, using U.S. know-how and U.S. funding for things like more LNG in Europe, as well as carbon capture technology, although not necessarily apparently more fossil fuel production. Leslie Picker, our colleague, doing some great work getting that nugget. Leslie, thank you very much. Trying to knock the reliance, Kelly and Tyler, on Russia, Iran, and Venezuela. So is this possible? All right, not tomorrow, probably not even next year. I mean, here's the reality of any of this. An LNG terminal, liquefied natural gas terminal, if you want to build one, literally permit the land, start construction, you're probably looking at 3 to 5 years minimum. However, there's these things called floating regasification units. It's basically a giant ship that is an LNG terminal. You can rent these or even buy these ships, probably get one installed up near Hamburg, Germany, within a year, maybe. Then you've got to get the contracts for the LNG. So how fast could this plan get up and running? Well, it would probably, I would say the shortest term, Kelly, would be maybe a year if you were able to secure one of these floating regasification type ships as well. This would rely on the German government to want to go along with it. We know they've been pulling away from fossil fuels. In fact, they've got super high solar, super high wind as well, which are great, by the way, when they work, but they need to be, thank you, by the way, I asked for that chart about 10 minutes ago. You guys rock for getting it done. You can see they've got a wide mix. Natural gas is in that, replacing that, of which 30 to 50%, guys, is from Russia, is going to be a tall order in the short term. I think Jamie Dimon referring probably more to the longer term than tomorrow.
Yes, and again, to say that a lot of this focuses on Europe having the capabilities to receive LNG that we could send them and so forth. So 4 areas: increasing natural gas production in an environmentally responsible way, building LNG facilities in Europe, investing in new technology for hydrogen and carbon capture, and streamlining permitting for renewable alternatives like wind and solar. So he thinks those latter two on renewables, Brian, I guess, should be part of this as well.
Renewables are a part of this. I mean, listen, that's the reality. Germany, this is the good and the bad of Germany. Germany, and I'm not picking on Germany, they're the biggest economy, so I'm bringing them up. The most reliant on Russian natural gas of the major countries. Many other countries in Europe, by the way, are also reliant on natural gas. But I will say this, Kelly, not Poland. Poland, a decade ago, made the decision to build LNG terminals hard up next to the German border in the northeast corner of the country. They get U.S. LNG from Venture Global and others. By the way, it's paying off. You know, Poland is pretty much energy free from Russia for the most part. Renewables are a big part of this, both here and in Germany. But again, with renewables, and what we've learned is with the UK, Kelly, renewables are great, but there's almost no storage capacity for renewables. When the wind blows, you have to use the power. When the sun shines, you have to use the power. There are large-scale battery technologies, companies like ESS, the United States, and others, where they're going to provide you with that, but it's 8 to 12 hours of storage. So I think everybody, what they've realized now is this energy mix needs to occur. The UK, as we reported on from London back in November, learning it the hard way. If the wind doesn't blow and you don't have any storage, they're paying the equivalent, guys, of $30 to $40 for natural gas. That's compared to the $5 that we show all of our viewers here on our screens. The energy poverty that is coming in Europe is also a national security threat. I can't highlight that enough. It is not just about Vladimir Putin and his stranglehold over energy, guys. It's also the fact that millions of families in continental Europe and the UK are going to really, really struggle if it gets cold in the next month or so to pay their electric bills, because if they're on a floating rate plan, they are subject to the whim of the global markets where everybody is trying to buy the same thing at the same time. This was bad strategy. How about hell? This was no strategy for for the last 10 years.
Couldn't agree with you more. I think energy security is national security, and it was that way back in the 70s. It remains that way today. Brian Sullivan, thank you very much. Proud of your Hokies, man. All right, let's talk a little bit about President Biden traveling overseas to Brussels for that emergency summit, now 4 weeks into the war in Ukraine. How's it going? What could be next? Admiral Michael Mullen served as chairman of the Joint Chiefs of Staff under Presidents Bush and Obama. He's currently president of MGM Consulting, which provides counsel on geopolitical and national security issues. Admiral Mullen, welcome. Good to have you with us.
Good to be with you, Tyler.
I want to take you into what I hope is your wheelhouse, and that is this. As the chairman of the Joint Chiefs of Staff, I know you must know or know of the Russian counterparts who are at the same levels as you were some years ago. What do you think those generals and admirals think about Putin's war? And second, is there any chance, high, low, zero, that the admirals and the FSB might move against Putin?
Well, to get to your second question first, I certainly, in the near future, don't see that as much of a possibility. I mean, Putin survives because he controls the people, he controls the security agencies, and he controls the military. So maybe over time, when it gets so bad, I have been struck at how poorly they've done, actually, in execution. I was chairman when they invaded Georgia in 2008. They were terrible in terms of their military execution. They've reorganized. I thought they'd be better, and they've been awful. And I think that's something that will continue to be that way. I just think some of us in the West look at the possibility that someone might turn Putin out, and someone like Putin has a way of staying in. He's going to be there a lot longer than we'd like and a lot longer than we'd anticipate. I think this war is going to go on for quite some time.
I think it seems that way, and I think you're right. I think a lot of American and Western intelligence was right on in the run-up to the war, but one thing we didn't get right was how slowly the Russians were going to make progress. Let's talk about chemical weapons. The president has responded. It sounds like today he said, we have to take it into consideration. The Russians seem to be talking about the possibility of there being Western biochem or chemical labs in Ukraine. This sounds like they're setting up a reason to strike or use those weapons or setting up a false flag. What do you see as the risk of the use of chemical weapons, and how would the West respond?
Well, while we may be somewhat critical of the intelligence community in terms of how Russia has executed, I want to give the intelligence community a lot of credit for releasing intelligence in a very timely way.
Absolutely
in terms of affecting and really pushing back on the disinformation campaign specifically. If past is prologue, I think Putin will, lean forward with respect to chemical weapons. I don't know what the Biden agenda is as he visits Europe, but I think those heads of state will certainly be talking about how to deter that if possible, or respond, if he in fact uses those kinds of weapons.
When you say lean in, that I read that as you're saying, I think he will use them. Am I right? Am I understanding you correctly?
I think his threatening right now is something we need to take very seriously. I have no information that he will whatsoever, but he has been supportive of the use of those before.
In Syria
would be a good example. So my expectation is when push comes to shove, and Putin to me seems to be more and more cornered, trapped. And as he is, the concern I have is that he will lash out with other weapons.
Well, that leads me to my next question, which is there was a chilling story in the New York Times yesterday about the possible use of low-yield or so-called tactical nuclear weapons, of which Russia apparently has a great number. How do you handicap the possibility that he might go there, that this cornered, frustrated Putin might use those kinds of weapons in this battle theater? And if he does, what would the Western response be? We couldn't sit still for that, could we?
It's very difficult to handicap it, Tyler, from the standpoint of knowing, but I put it in the same category of chemical. These are arrows that he has in his quiver. He's threatened to use them, whether he will or not, I think, is part of the game. If he uses nuclear weapons, I think there has to be a hugely impactful response. And I wouldn't go into the specifics of that. What I also worry about, quite frankly, is once you get into that level of warfare, the unintended consequences, the ability to have it spill out of control and actually even go to a higher level of nuclear weapons is very frightening. And we should remember it's been since World War II that a nuclear weapon was used, and they are devastating, massively destructive weapons that certainly, if he uses them, deserves a response. But I just hope whatever we do, we can avoid that particular outcome.
And finally, and unfortunately quickly, do you think he's done? Do you think Ukraine is the last stop for Putin here, or are other countries, NATO countries, Baltics, Poland, in his sights?
I don't think Putin will stop. I think he needs to be stopped. And if he isn't stopped, then Moldova, Transnistria, the Baltics are next. He's certainly shown an appetite to do that. That's why he needs to be stopped now.
Frightening thought. Admiral Mullen, thank you for your time today.
Thank you.
Yeah, frightening is right. Coming up, we're counting climate calories. New SEC rules require public and private firms to estimate their emissions, but could there already be loopholes? We'll dig into it right after this. Welcome back, everybody. The SEC this week pushing for rules to make public companies report more information on how their operations affect the climate and their carbon emissions. The problem is that even companies who want to do that right now might have a hard time getting the data right. Christina Partsenevelis joins us now with more. Christina?
It's measuring emissions is, sometimes like counting your calories for a day. It takes some guesstimations and honesty. With public companies accounting for roughly 40% of the world's emissions, it's no wonder investors and regulators are pressing for disclosure rules. Under the new SEC climate disclosure, public firms would have to report about direct emissions from their own operations in their 10K filings. So that would be scope 1 you're seeing on the left-hand side of your screen. Then you have emissions from the energy they consume, scope 2, in the middle of your screen, all with independent certification of their estimates despite a lack of standard reporting systems. Sound familiar? ESG rating scores as a hint. And only 43% of the country's largest public companies actually release their scope 1 and scope 2 emissions data, showcasing just how many firms will need to play catch up to meet the new SEC climate rules. And in some cases, companies would also need to report on their greenhouse gas emission outputs of both their supply chains and consumers. And that's the big one, and that falls into scope 3. In other words, rely on companies in other countries with different sets of standards.
What if companies don't have the adequate mechanisms in place at the board level to ensure that their compliance and that the reporting is accurate? That's a whole range of potential lawsuits just waiting to happen.
And the SEC will review comments from the public for the next 60 days or so. And so they may revise its proposal before holding a final vote to finalize this rule, Tyler.
All right, Christina, thank you very much. Christina Partsenevelis. Now to Rahel Solomon for a news update. Hey, Rahel.
Tyler, hi, Kelly. Here's your news update at this hour. Members of the Russian military have committed war crimes in Ukraine. Secretary of State Blinken says that is the assessment of the U.S. government. In a statement, Blinken says that Russian attacks have destroyed schools, hospitals, and homes that were clearly in use by civilians. The Supreme Court has thrown out Wisconsin legislative maps prepared by the state's Democratic governor and selected by Wisconsin's highest court. However, the Supreme Court did leave in place state congressional maps. A group planning to kidnap Michigan Governor Whitmer wanted the attack to prevent Biden from becoming president. That's the testimony of a critical prosecution witness who pleaded guilty to planning the kidnapping. The witness did not say why they thought the kidnapping would actually stop Biden from defeating Trump and the 2020 election. And the tornado that touched down in New Orleans spent nearly 10 minutes on the ground. Local NBC affiliate WDSU made this time-lapse video that we're going to show you showing the storm. It cut a 2-mile-long path through the city, and with just one person dead, local officials say that the death toll could have been much worse. Tyler,
Golly, look how fast that thing moves across the ground.
It is
That's
shocking
amazing. I recognize that's time-lapse, but my goodness. Rahel, thanks. Already ahead on Power Lunch, the technical take on 2 key trades. First, Meta's IRL problem. Users spending less and less time on the platform, so is now the time to sell. Plus, rates on the rise and home builders going the other way. Is this a good time to get these names on sale? Power Lunch will be right back.
I'm Shepard Smith in the CNBC newsroom. Madeleine Albright's family just confirmed the former Secretary of State has died. She served as the first woman Secretary of State in American history under President Clinton from 1997 to 2001. 10 years ago, President Obama awarded her the Presidential Medal of Freedom. Secretary Albright was born in 1937, Marie Jana Korbalova, in Czechoslovakia. She immigrated with her family to the United States at age 11. A month ago today, a guest essay that she authored, published in the New York Times, the headline read, "Putin is making a historic mistake." Her family says she died of cancer. She was 84 years old. Secretary of State Madeleine Albright, may she rest in peace. Back to you.
Shep, thank you so much, everybody. We'll be right back after this quick break. Welcome back, everybody. With 90 minutes left in the trading day and stocks near session lows, let's get caught up across the markets with stocks, bonds, commodities, and a potential trouble spot for Meta or Facebook. But first, let's begin with Dom Chu and the latest on these markets. Dom?
All right, Kel, the losses have started to accelerate, as you referenced, a bit more as we hit the afternoon part of trading. We are just about not far off the worst levels of the day. The Dow, the S&P, the NASDAQ, all in negative territory, as you can see there in the screen. But the narrative over the kind of underperformance has been, and where it has been, is somewhat different than a couple of hours ago. Earlier on today, it was technology, that heavier NASDAQ trade that was outperforming actually on the day, continuing a theme that we've been seeing over the course of the market bounce from last week. We are now seeing that NASDAQ trade As you can see, they're more in line with the losses for the Dow and the S&P. The small cap Russell 2000, by the way, slightly underperforming as stock market volatility is measured by the VIX kind of ticks higher in this whole process. An interesting split in terms of sector performance. The biggest gainers are in economically sensitive ones, like in energy, in those particular stocks. Not so in the so-called non-cyclicals, the utilities there. Financials and healthcare are among the biggest laggards. Now, from a stock point of view, maybe no surprise that creative software maker Adobe, the biggest drop in the S&P, more disappointing quarterly earnings outlook during its report yesterday. The leaders are a lot of commodity names like Marathon Oil, Nucor Steel, Newmont Mining, and CF Industries. You've also got cereal and packaged foods giant General Mills, a big gainer on a relative basis in a down market after a stronger quarterly report, and in a full-year forecast. So, again, an interesting move here in terms of where the outperformance has been. General Mills certainly one to watch, Kel. Back over to you.
All right, Dom, thank you. And everybody's watching the bond market as well. The 10-year yield was above 2.4% earlier today, but it is way pulled back. Rick, is it below 230 yet?
It is hovering at 231, and it held yesterday's low. It's really an amazing session. And before we even get to that quickly, I'll give you a hint why. Why are stocks down so much? Why are Treasury prices up, yields down? At the end of the month, there's going to be a big rebalancing. Why big? Because it's a quarter end as well as a month end. And what goes up, well, you have to sell, and what goes down, you have to buy. Let's see, what went up? Stocks, so you need to sell for rebalancing. What went down in price? Treasuries, so you have to buy them. So many are doing this a bit early. That's very normal. May 2019, as Kelly referenced, you see in this 10-year chart, that's the last time yields were here. But as you see on the intraday, we did get up to 241. Then we did a big U-turn. And if you look at a two-day chart, yesterday's low was 2.28%. That's exactly where we held. The cash market's open for several hours yet. Should we trade below there? Look for some fireworks. And finally, here's a February 1st chart of the 20-year bond. Had an auction today. I gave it an A+, and it was really aggressive. And considering how that chart looks with yields going so high, it speaks volumes as to maybe a temporary halt to see such bullish confrontation with the auction on investors to buy that 20-year. And by the way, that was the first inversion of the curve. 30s to 20s inverted about 5 months ago. On October 27th, 20-year bond yields turned higher than 30-year bond yields. Kelly, back to you.
Wow, I didn't realize it was that long ago. Rick, thank you very much. Oil is popping again today, closing up more than 5%. That's putting pressure on the market as well. Energy names enjoying it, though. Pippa Stevens with the latest. Pippa?
Hey, Kelly, that gain comes as a major pipeline that runs from Kazakhstan to Russia has been damaged in a storm, and some operations have been halted, the CPC said in a statement. The pipeline carries more than 1 million barrels per day, and so this is adding to supply fears. Let's get a check on prices. WTI up 5.5% at 115.21. Brent crude also up 5.5% at 121.89. Energy stocks are leading again today, as you mentioned, up about 2%. Now, one area that's been relatively weak is the refiners. Higher oil means higher input costs for them. But Bank of America is saying that a new golden age for the U.S. players is upon us. Their top pick is Valero, and they also like Marathon Petroleum and Phillips 66. Also wanted to quickly note that the wild activity in nickel continues, jumping 15% today and hitting limit up. Kelly,
wow,
back to you.
32,000 and change. Pippa, thanks. Let's look at shares of Meta, which are lowered today, continuing a downtrend that has seen the stock lose nearly 30% of its value in just the past 2 months. Now, there's a new trouble spot for the company. Julia Borston has those details. Julia?
Well, Kelly, there are a number of red flags about Meta right now. BuzzFeed says it sees audiences spending less time on the social platform. Sensor Tower telling us today that Facebook's mobile app usage is down sequentially in the first quarter. That's a deceleration from past quarters. And with user declines come advertising under pressure as well. Insider Intelligence tells us exclusively that it's slashing its revenue forecast for Meta by about $2.5 billion, both for this year and for next year, projecting that Meta's share of digital ad spending will fall under 22% by 2023. That's down from 25% share in 2020. And today, Meta releasing a State of Small Business report showing that its small and medium-sized business advertisers are coming under growing pressure. 1 in 5 small businesses are closed. That's a higher number than it reported back in July. Also today, Lightshed's Rich Greenfield writing that Meta is vulnerable to competition and that there is lack of visibility around its metaverse pivot. But Atlantic Equities is more bullish, saying, quote, Meta continues to make progress restoring ad targeting and measurement capabilities, and saying that that the company is well positioned because of its scale. Now, Meta shares are down nearly 1% today, but it's worth noting, Kelly, that they are off about 35% year to date. Back over to you.
Absolutely. Julia, thank you. So some might ask if this represents a buying opportunity or if it's why the stock's been under pressure. Let's ask Todd Gordon. He's founder of New Age Wealth Advisors and a CNBC contributor. Todd, you hear all this, digest it. Do you think this is a stock you want to pick up or bail on?
Kelly, it's actually going to be neither. We hold kind of a token piece, about 1% allocation in our growth portfolio. It's kind of on my watch list to cut. We've lost any kind of semblance of uptrend support that goes all the way back to IPO days. Basically, if we break through 185, Kelly, that's going to be a technical level. I'm going to cut it. I'm not giving up on this story. I still think there's a strong fundamental position in the company, a lot of cash in the balance sheet, good growth metrics, but they have a long way to go until they can prove to us that they deserve to be back in a growth portfolio. It's acting more like a sort of a boring value stock trading, 15 times forward earnings.
Have you been in the stock in any kind of substantial way over the past couple of years? And if so, what was your average price, your average cost?
Oh, well, interesting. Yes, absolutely, Tyler. I have owned the stock. I've owned the stock for 5 years. I'd have to look back. We just recently launched our wealth management RIA just 6 months ago, and we launched with about a 2% position in there. This was October. We've since cut it down to 1%. So again, on watch below 185. The company, as he said, it's incredibly, it's got a strong balance sheet. Their margins are extremely strong. They're continuing to grow revenue. Their margins are about 80% compared to the industry at about 57%. They've got a 5-year earnings growth of 30%, free cash flow at 60%, increasing the cash in the balance sheet. But just unfortunately, this stock and even communications in general, guys, I think you really have to look at in terms of holding your position. XLC is way underperforming the rest, and that's with Google in that ETF.
I want to take a quick break here, but ask you to stick around, Todd, and you're going to give us your trades on home builders. After some big numbers in housing today, mortgage applications have been plunging. I guess no surprise there. New home sales dropping while prices continue to rise. Is that sustainable? What does it mean for home builders? We'll be right back to talk about that and more with Todd. All right, folks, new data out today on the housing market, not painting a rosy picture. Let's get to Diana Olick for the details. Hi, Di.
Hey, Ty. Yeah, rising mortgage rates are really taking their toll on all aspects of the housing market. Take a look. After sitting around a record low last fall, the average on the 30-year fixed started January at 3.25% and took off, hitting the gas this week. It's now around 4.7%. That caused mortgage refinance demand to drop an outsized 14% last week compared with the previous week, down 54% from a year ago. That, according to the Mortgage Bankers Association. Mortgage applications to buy a home fell slightly, but the drop was bigger for FHA and VA loans, which are a favorite among first-time buyers. Now, economists are starting to revise their home sales forecast lower for the year, and they probably should, given the read on this morning on February sales of newly built homes. They dropped more than expected, down 6% from a year ago. These numbers are based on signed contracts, so people out shopping in February as rates were moving higher. And the median price of a new home jumped over 10% from a year ago. So affordability is really taking a serious hit. Back to you guys.
All right, Diana, thanks very much. So let's go back to Todd Gordon and talk about which names, if any, look most attractive among the home builders right now. You know, Diana points out regularly how much lack of supply there is. And that there's an inventory issue. But then you see that new home sales, the ones built by builders, fresh new homes never before used, are down. Are any of the home builders a buy here?
Tyler, I'm going to go 0 for 2 here and be a Debbie Downer. I'm not involved. I haven't been involved in a while. You know, they were very strong in coming out of right in the middle of the pandemic, first half of 2020, very strong. But home builders, guys, have been underperforming the S&P really since the back half of 21 and into this year. So, you know, it's all we talk about with our clients is either they want to buy a home for rental or they're trying to get a new home. The supply issue is unbelievable. And I think we're starting to see those interest rates move up. So you look at the valuations at some of these builders like Lennar, Pulte, Toll. They're like 5 times next year's earnings. So the big question, right, is this rally in real estate cyclical or is it secular? And I really believe that housing is counter-cyclical to the stock market. I think this is a cyclical rally. I think it's a short-term supply issue. You have lumber moving up to new highs. I know builders have a hard time getting workers to show up. I really believe, and I want to believe it's going to be temporary. And it seems to be in the housing market, there's a big cross-current of institutions selling houses. And I've read a lot that they're dumping. I don't think they're dumping. I think they're keeping their prices high as new buyers are coming in and willing to pay anything. And what they're giving up in terms of, I've heard stories. My partner Ryan's trying to buy in Boston. People are giving up inspections, the right for inspections. They're giving up the right to come back if the appraisal doesn't come in. It's unbelievable what's happening here. As you said, I think new family single homes dropped 6%. Existing homes dropped. You know, and as you just look at the effect on purchasers' buying power. Go ahead, Tyler. Sorry.
I thought I heard you say that as a group, the builders are trading at 5 times next year's earnings. That sounds like a very attractive multiple. That's low, right?
That or the market's it's unbelievably low. That or the market's pricing in a significant housing correction. Yeah. You know, and I thought Kelly wrote a really interesting article 2 days ago. I tweeted at her. She cited that looking at the actual yield curve, talking about the 3 and 2 year yield, but looking at the 10s and 30s, do we have a significant inflation problem? Are we going to rotate back into stocks which are counter-cyclical to housing? Let's say they're cyclical stocks pushing up the long end of the yield curve. And I have to think that's going to further pressure housing. You know, you look at my partner Ryan wrote a great article on the website. We're going to pull a couple. You know, you look at the average FICO scores. It's like 757 right now for buyers. 100 points lower. You would barely qualify for the best rates back in 05-06. And I'm worried too many people extended themselves in this kind of crazy market that we've seen. I'm afraid FICO scores come down. Maybe not as many qualified buyers.
Got to leave it there. Todd Gordon, thank you very much. And Kelly appreciates the shout out for her writing.
Shout outs are always welcome. Yeah. More Power Lunch next. Welcome back. Add this to the controversy brewing over stock trades by members of Congress and their families. Paul Pelosi, husband of House Speaker Nancy Pelosi, exercised options to buy 2,500 shares of Tesla, according to a filing. The shares were worth about $2.2 million when he exercised last week, right before they were about to expire. It appears Mr. Pelosi spent between $500,000 and $1 million on the options back in December of 2020. And last week on Power Lunch, by the way, Tesla shares, you can see today, crossing back above $1,000. So the timing has worked out. We spoke with Senator Elizabeth Warren about this last week, who has a bill to ban trades just like these.
Because it is right, and because people around this country have lost faith in much of what Congress does. And this is one small way we can begin to say, we get it. We are going to get rid of these conflicts. We're going to make sure that when we're making decisions, the American public can know that we are putting the interests of the public first and not the interests of our own finances.
There's obviously nothing suggesting that Mr. Pelosi was acting on any kind of inside information, which is what Senator Warren's bill, not that we would know. Doesn't take a genius to think that electric vehicles are going to move ahead here.
Exactly.
But at any rate, it's an interesting bill.
In fact, I know someone who just bought a Tesla.
Yeah. All right, let's move on. High school students in Florida will soon be required to learn the basics of money management. You're right there, aren't you? Dom Chu, he's over there.
Right here, next to you.
There he is.
Just next to you. So anyway, to your point, you're going to need to graduate in Florida, and you're going to need at least a class or so. Florida becomes the biggest state in America to require that all high schools take a course on financial literacy before they can get their diploma. Now, the legislation was passed by both houses of the Florida legislature and signed into law by Governor Ron DeSantis just yesterday. And you can't get much more bipartisan than this. Unanimous across all houses, across everybody there. Here's what's going to happen. Starting the 2023-24 academic year, students in Florida will have to take one semester in a course that teaches them how to do everything, like manage a bank account, establish a budget, grow wealth through saving and investing, and even, yes, lessons on how to file and pay your taxes. With the Florida law, there are now 11 states in the union that require some sort of personal finance education required before graduation. They are Alabama, Missouri, Tennessee, Utah, Virginia, Mississippi, Nebraska, North Carolina, Ohio, and Rhode Island, and now Florida, guys. So an interesting move here, but still, requiring it is pretty much a good idea given what we have with youngsters and money these days.
I speak from experience.
I speak from experience.
Yes, it is. Yes, it is.
The fact that they could agree to that.
Unanimous. Yeah, exactly. All members of their houses.
Dom,
all right, Dom,
you got it.
Thanks for watching Power Lunch, everybody.
Closing bell right now.
Stocks are down, yields are slumping, and oil is jumping. The most important hour of trading starts now. Welcome to Closing Bell, everyone. I'm Sarah Eisen. Here's where things stand in the market right now. Down 350 on the Dow, S&P 500 pulling back a full percent. Only sectors higher right now are energy and utilities. The NASDAQ down a full percent as well, and small caps getting beaten up hard, down 1.5%, a reversal from yesterday, down for the week. Here are my top takeaways on today's big stories. General Mills finally seeing some pricing power. Great for investors, not so much for consumers. The company behind Cheerios and Betty Crocker says profit was a beat. The outlook is strong after struggling last quarter. Why? More people are eating at home, and more importantly, they are paying more for groceries. Expect more price hikes on your pantry items. On inflation, with gas prices spiking, there's a lot of worry about whether U.S. consumers can handle it. Will it sink us into recession? Wells Fargo's economic team took a look today and says no. Importantly, wages have outpaced gas prices over time, especially with this latest wage bump. So even with record high gas, the outlays, which is how much we spend based on what we earn, aren't as high as in other cycles. And meme trades are back. GameStop up another 15% on top of yesterday's 30% spike. Some say great. It's healthy that retail traders are still engaged. Or is it really? Does it actually show that as painful as the past few months have been in the market, it's not been painful enough to strike fear in investors that keep them away for a while? Matt Maley of Miller Tabak, a technical analyst, says it shows there's still a high level of complacency out there. Let's get to our top story. The market, stocks pulling back after a rapid rally that we saw over the past week. Canaccord Genuity's Tony Dwyer out with a new note saying bouts of weakness are opportunities to add exposure. Tony joins us now along with Richard Bernstein from Richard Bernstein
advisors. And Tony, let's start there. You have a new note. Are you buying today's pullback?
Well, Sarah, back in January, I remember you saying, wow, I'm surprised that you're more cautious. I'm not used to you being that way. And really, since last summertime, we've been talking about a tumultuous market outside of a year-end rally last year. And if you look at what has happened over the course of the last year at the low, when the S&P was down 14%, the NASDAQ and Russell were down 20%, you have to almost go back to the end of 2020 to see those levels. So you gave back all those gains and the markets had gone nowhere. But when you put all that into the background, we're still in a tumultuous market. I do think we're still going to pull back, but that thrust last week had a historic precedent that I just can't ignore. It's a hard call when you're in the middle of a war. You've got the Fed raising rates maybe 50 basis points at a time. Inflation's crushing the cost of everybody and companies. But a lot of times when you get the thrust like you got, so just to make it very specific, the S&P 500, we found that when it was up more than 6.95% like it was in the 4 days that ended last week, so you had a 4-day rate of change of 6.95%. It was up 23% median gain a year later. 14 of the 16 occurrences were actually up double digits.
So that argues for more strength ahead. Richard, I remember you've been warning for months now about a bubble, even when things were looking good. And now that we have seen this sharp deterioration in the markets, do you think there's more room to go, or you agree with Tony? It looks like the damage is done.
Well, Sarah, I think, what you said, sharp deterioration in the market. I still view the market as being more of a seesaw right now, where the market itself really hasn't done as much as people think. But because people have been on one side of the seesaw, their pain has been extreme. If they've been on the other side of the seesaw, I think they're actually pretty happy right now. If you're in things like energy, utilities, things like that, I think you're probably pretty happy. So I think the dispersion among sectors and sector performance is actually the bigger story than the market, so to speak. And I think that's going to continue.
But would you add to exposure in those sectors that are doing well? Energy, materials today, utilities as well?
I think that there's a longer-term story here. I think that one of the big surprises could be that energy is actually a growth sector. The energy sector right now has the highest dividend yield of any sector, so that would classify it as a value investment. But what most people don't understand is that on a bottom-up projected 5-year growth basis, energy also ranks #1 for earnings growth. So it's the #1 for dividend yield. It's the #1 for secular earnings growth. That, to me, sounds like a long-term investment story.
What about you, Tony? When you look at the sector divergence and performance, what looks best to you? Would you go to the most beaten down parts of the market, namely technology?
So, Sarah, the only way that the market really rallies over the course of the next year, like all the data supports, is if you actually have the short end of the yield curve come down. In other words, it's already discounted what the Fed's going to do. Already the rate move has significantly impacted the lower end of the housing market from all accounts that I can hear when I talk to various analysts in the space, and it'll eventually move up the food chain. I think one of the problems that the Fed has when they talk about the neutral rate, when they're raising rates, is that they don't take into account the price increases. Remember, after every recession, they throw an infinite amount of money at the market, which goes into investment that lifts the prices of assets. So when you raise rates, you're not raising rates against the same price. In other words, I can afford a house at make up a number, $100,000 at 3%. I may even be able to afford it at 4%, but can I afford a $150,000 house at 4%? So that affordability index deteriorates much more quickly because when they threw all the money at us and made it so cheap, it lifted the asset prices to the only way to turn it over is to have a lower interest rates to be able to afford that monthly number.
232 is the yield, by the way, on the 10-year. Everything's reversed from yesterday. The sell-off in bonds and the rally in stocks. Tony, Richard, thank you both for joining us with some of your takes. While stocks are falling, take a look at commodities jumping again. Oil's up more than 5% today, 50% now for the year. Nickel prices are popping, the first gain since March 7th when nickel hit an all-time high, leading the London Metal Exchange to halt trading. Joining us now on all of it is CME Group CEO Terry Duffy. In the center of all of the action, Terry, what have the volumes been like for all these products that you have there, commodities, rates?
oil prices in particular. What does it look like from your vantage point?
Well, Sarah, I think you have been talking about this as many of your guests have over the last several weeks. I mean, the prices are all over the place. The volumes are associated with it. You get ebbs and flows in the spike of volumes going up and down depending on which way the market's going at any given moment in time. We're all interdependent on all these geopolitical factors that are playing into it. You talked a moment ago just about, you know, the commodity markets. Let's talk about a second about wheat. I mean, you look at a third of the wheat production, the world's production is coming out of two countries that are at war with each other right now. So if that comes off the market for this year, next year, and maybe even the year after, I'm not suggesting it will, but if it does, where is the market going to go? I mean, we're not just talking about people shooting each other, which is catastrophic in itself. We're not talking about a financial collapse. We're talking about hunger here. And this is a big issue for us. So risk management associated with these products is critically important.
What about liquidity? Has that been an issue?
You know, people have talked a lot about the liquidity. The liquidity can be an issue in times of stress no matter what market you're trading. If you're trading an IBM stock or if you're trading a wheat contract, it all depends on what's going on. Liquidity comes and goes, as you know. People don't stand in front of freight trains because it's fun. So there's a lot of stress in the market system. There's so much uncertainty. There's things that we've never seen before. There's so many people that are trading the markets that have never seen inflation. Where inflation's for the first time in 40+ years. People have never seen a downtick in the equity markets that are participating. So people have not seen an on-the-ground, boots-on-the-ground European war. So how do they participate in that? And in return, the reflection of liquidity is associated with it, Sarah. So it's not a surprise to me. I've been doing this for a long time, and people pull back during the unknown times that we've seen.
I don't know if you can hear. There's a birthday going on here on the floor for one of the traders.
I can hear the birthday. Is it yours? Is that yours?
It's not for me. No, mine's in August. Terry, what about margin? Are you requiring traders put up more for trading futures in these commodities, given all the action we're seeing?
We don't put it up just because of, you know, at will. I think that's really an important factor here. There are calculations that go into our risk protocols that we've been doing for years to protect the system. So yes, margins go up and down depending on the risk associated with it, and we have not deviated from that strategy. CME is a neutral party, a neutral facilitator of risk. We don't have a stake in the game as far as the market goes up or down. So margins are associated with the risk of the product, Sarah.
Because we've heard about this happening and some potential pain out there. Trafigura having to raise more funding. Do you expect any commodity shops to blow up as a result of some of these crazy one-way price moves?
Well, I mean, Sarah, that's speculation at best on my part, and I wouldn't go there. So I have no idea. All I know is that, you know, the system that I'm running here is highly capitalized. You know, I'm sitting on $150 billion of client cash, sitting on a massive default fund that we've had for years here at CME Group. We manage the risk appropriately, and that's our job, and that's what we're trying to do. Now, people come and go, as you've seen throughout the years. We saw it in 08. We never thought we'd see banks fail, but they did. So I'm not suggesting they will, and I'm not suggesting they won't. I don't know.
What's going on at the LME? I know it's a competitor of yours, but the nickel, it's crazy. They had to cancel trades, suspend. They can't seem to do anything right. And since they've started trading again, there's been all sorts of suspensions. Is this something that could happen at the CME?
So, Sarah, I'm always cautious about criticizing anybody else when you're in the same business, but I will say a couple things about it. I think that LME has had some issues, and they have not had procedures and protocols in place that we have had here in the United States for many, many years. I'll give you a perfect example. April 20th, 2020, we all saw the price of West Texas Intermediate go to minus 37.50. I had worked with our regulator to make sure that we had strike options put in place for those potentially if the market went negative. It did, so we could manage the risk and have a true reflection of it. We did not bust trades because we didn't understand the risk. Breaking trades lends to taking away from the credibility of any central market, whether it's on OTC or whether it's on a listed platform. I think that's a big concern for the participants, and they didn't have any hard position limits like we do on our agricultural products and some of our other products, and they didn't have any of the technology like we have with stop logic and other velocity logic functionality that associates with slowing down these markets, so you don't have to go through what they did at LME and the customers suffer for it.
So are you going to make a play? Could you launch a nickel contract? I know you've had, what, copper?
I can list a nickel
futures?
contract if I wanted to, Sarah, but the question is, do I want to? I already have copper. I have aluminum. I have other products that I compete with LME today. I'm in a very comfortable position from there. Listen, I'm in this business. We're in 180 years in this business. We do things in a methodical way to make sure that we create opportunities for our clients to manage risk. But we're not in here to take advantage of a nickel trade because they screwed up. So I'm going to be brutally honest with you. Will I list a nickel trade? I'm not sure. The question will be, I'm managing risk and a whole host of products right now, Sarah, that are critically important to the health and well-being of the world, such as food, such as energy prices, mortgages, everything that you talk about every single day. We're talking about nickel because of a mistake made by an exchange.
Sounds like it's at least something you're considering, Terry. Another product that you are going deeper into is crypto and Bitcoin. You're launching, I think, next week, the mini options for Bitcoin and Ether. Talk about what you're seeing as far as demand for all of these products and participation and volumes, given some of the sharp swings.
Here, I have probably a different version on this than most. And the question is, with crypto products, is it the use of the product or is it the value of the product? And I think there's a lot of people that are being disingenuous with themselves about this. So a lot of people made money on the value of the products. I actually believe if this thing is to be successful, it's around the use of it. That's why I listed it. I want to list contracts that I believe are going to be for the use of the product, which people need to manage the risk associated with it. The speculative nature of, going from $8 to $61,000 is exciting and fun, but that's not the use case of the product. So we are going to continue to offer some of these crypto products to our retail participants in the smaller contracts, some of the larger ones to our institutional contracts. And if they want to use those to have a diversified portfolio mix, that's what I'm going to offer them.
Well, you clearly see growing usefulness of it. Terry Duffy, thank you very much. Good to talk to you.
Thanks, Sarah.
Not enough time. Everything is moving in your world. After the break, stocks and bond yields moving in tandem once again today, and this time they're going lower. But which part of the market is the better value? Mike Santoli breaking down the charts in today's dashboard. You're watching Closing Bell. Dow's down about 360 off of the session lows. S&P down a full percent. We'll be right back. S&P down 1%. Treasury yields are pulling back today after the 10-year hit its highest level yesterday since May 2019. I think 241 was the high. Mike Santoli taking a look at the relationship between stocks and bonds at the dashboard and whether the whole valuation argument for stocks has changed.
It's probably eroded a little bit, at least if you believe this whole stock bond valuation method. This compares the earnings yield of the S&P 500. So that's basically just forward earnings divided by the price today against the 10-year Treasury yield. So what you see here is the post-global financial crisis level. When this is lower, it means stocks are more expensive and less cheap. So here you have it basically as expensive as they've been since the global financial crisis. Up here, it's the 09 low. There's the 2020 low. That's when you had real opportunities to get back into equities at lower prices. What you will see, though, is here's the 90s, and it was chronically expensive relative to bonds. So there's no one rule that says here's the right number for this regime. This is expensive. This is cheap. And what's interesting here is inflation was the enemy in the 90s. Deflation was the enemy here. Are we back in an inflation is the enemy regime where this isn't going to matter as much?
I feel like for so long the mantra on Wall Street was, Tina, there is no alternative. So just put your money in stocks because bond yields were so low and it made everything else look better. And that's totally gone. Right? Now we have higher yields. We have junk bond yields higher, credit bond yields higher. And so there is an alternative for stocks, and it makes them look less appealing and more expensive.
Absolutely true. And what's funny is when there is an easy or obvious alternative, people don't want that alternative because they will find reasons why bonds are dangerous right now because yields are going to keep going higher. So even though it feels like, well, it's intuitive, maybe bonds have some value to cushion a portfolio right now because you've rebuilt some yield, people generally don't want to see that.
Dividend yields also.
Yeah, they're well below
attractive.
Treasury
Right.
yields. Yep.
Mike, thank you. Still ahead, Petco's CEO saying at today's Investor Day that the pet category is, quote, resilient to inflation. He'll join us live at Post 9 to explain why. And then later, home builders selling off as mortgage rates rise and housing data weakens. We will ask an analyst whether he's buying the dips in this group. We'll be right back. Welcome back to Closing Bell. Check out some of today's top search tickers on CNBC.com. The 10-year yield drawing the most interest today, ticking lower after a huge rally yesterday, at least a sell-off in bonds, and saw yields jump up to 241. That was the high yesterday, coming back down to the low 230s today. Tesla comes in second. Number 2, holding gains after yesterday's big jump on the new Gigafactory in Europe opening. GameStop also popping today on news of a new share purchase from Chairman Ryan Cohen, who helps fuel a lot of the retail excitement. Crude oil and Apple rounding out the list. Everything on the top search tickers is higher. Are consumers still spending big bucks on their pets? Up next, the CEO of Petco, fresh off his investor day, on whether inflation is forcing shoppers to cut back on their purchases. Closing Bell back in a moment. Dow down 343. Should investors looking for inflation-proof stocks be turning to the pet sector? That's what Petco CEO Ron Coughlin said at the company's investor day today, held just over a year after returning to the public market. Petco chairman and CEO Ron Coughlin joins me now. resilient to inflation and the economy. Really, it's that basic for people spending on pets?
That's what history tells us. If you look at the Great Recession years ago, the pet industry was resilient through it. And once again, we're seeing that. There is a relatively timeless trend towards more premium products, especially with millennials and Gen Zers adopting the majority of pets. They are even more on the humanization trend and upgrading even more.
But as they have to spend more on their gas bills and their food bills, which we're all experiencing, if they're just spending on the basics, food and medicine for their pets, isn't that lower margin than some of the extras, the bells and whistles that they were spending on?
Yeah, you had some discretionary spend on things like tennis balls and toys and things like that. But the premiumization of the product, going to things like fresh frozen, that's going to be a $4 billion category by 2025, is a countervailing trend.
Is that really better for pets to buy them fresh or frozen?
I will tell you that my guy Yummy, who's on the Nicey with me today, he lost 10 pounds on just food for dogs, fish and sweet potatoes.
What about inflation within the pet category itself? Because I'm sure a lot of the inputs are rising like other food prices.
Yeah. So we have taken price, and we have been able to pass that through. We haven't seen a decline in unit volumes. But at the same time, we want to make sure that for those customers that are looking for value, we can provide value. So we have an own brand, Wholehearted, that's great for that. And we also announced a product called Vital Care, which is basically complete health, and consumers can save $200 to $300 a year from Vital Care.
What about the stock, Ron? Because so you went public after being private for a while, private equity backed with a lot of debt back in early 2021. We're all the way up and then all the way back down. Right around the offering price was what, around $18?
$18.
So what are investors missing about this story?
Yeah, well, we're focused on executing. So we've had 7 consecutive quarters of double-digit growth. Out of the top 50 retailers, there's only 3 who've had 7 consecutive quarters. I like what Warren Buffett says. Eventually, the market will see intrinsic value. But at the same time, 80% of the IPO stocks of 21 are down. We're actually up 5% from our IPO price. And we're up in our year-to-date fiscal 2%. And the market is down. So in a down market, I think we're performing pretty well.
How much of the business is e-commerce? Because some of the competitors, like a Chewy, for instance, gets grouped in with a lot of the e-commerce names, which did so well during COVID, and now giving so much of it back on that whole idea that it was pulled forward.
Yeah, we doubled our e-commerce business, more than doubled, 143% 2-year in Q4. But what I talked about at our analyst meeting was we are a leader in retail 3.0. And you see a bunch of the retailers like the Targets, like the Ultas, really leveraging their footprint for in-store fulfillment. And then when you bring services to bear, like our grooming, like our training, like our vet, we really have the next generation offer in our view. If you look at us versus a pure play e-com player, we fulfill 80% of our orders via our pet care centers, faster to the customer and lower cost versus pure e-com.
So it's more hybrid. Ron, thank you for coming by. It's good to see you in person off Investor Day. Ron Coughlin, the CEO of Petco. The deputy governor of the National Bank of Ukraine urging the West to slap more sanctions on Russia, the tough punishments he wants to see when Closing Bell comes right back. Ukraine is calling for the world to be even tougher on Russia. I just spoke to the deputy governor of the National Bank of Ukraine, the central bank, and he told me sanctions from the West are enormous, but not enough. He's now urging Western countries to freeze assets of all Russian banks and is asking SWIFT to cut off the Russian central bank. Well, it may be too soon to see the full damage on Ukraine's own economy. He said the war has been wreaking havoc. Listen.
This new reality so far, I don't know. We may just suggest that the economic activity shrank by approximately 1/3 compared with the pre-war levels.
A third of Ukraine's economy gone. And there's lots of concerns about commodities. Ukraine is often called the breadbasket of Europe. And according to S&P Global Market Intelligence, Ukrainian corn makes up almost 13% of total world exports. Wheat accounts for 10.5%. I asked him if there's any chance that the farmers in Ukraine could have a normal and safe planting season. Listen to what he said.
In the past, so the major channel of delivering the Ukrainian agricultural products were via Black Sea ports, which nowadays are blocked, and we have only one channel to deliver our agricultural products to the globe, and that is the railway via to Europe. But the capacity of this channel is much narrow compared with the ports. And nowadays we export something like 10-15% of the stuff which we used to export before the war.
So the big news is he actually said planting season could happen in Ukraine, but it's the transmission, the shipping methods that are blocked that make it hard to get the exports out of the country. He was speaking to me from an undisclosed location in Ukraine, says the central bank is up and running, even if it means they've been having to work out of bomb shelters or basements to keep the financial system open and, importantly, to keep money coming in to support their army and their people. When we come back, Apple making a move to disrupt the fintech space and homebuilder stocks taking a dive today on some new data. Those stories and more when we take you inside the market zone. 400 points now on the Dow, 20 minutes left of trading. We are now in the closing bell market zone. CNBC senior markets commentator Mike Santoli here to break down these crucial moments of the trading day. Plus, CNBC.com Steve Kovac on Apple's big splash in the fintech industry. And Evercore's Stephen Kim on homebuilder stocks, which are significantly underperforming the market today. First up, though, stocks are pulling back. We've just taken a leg lower here after a big rally yesterday. Now near session lows again. The Dow and the S&P on track for their worst days in more than 2 weeks. Inflation remains a key concern. Just this hour, St. Louis Fed President Jim Bullard said, quote, all indications are that inflation will go up in the spring. He also said the Fed must ensure it remains credible on inflation and repeats that he wants to see interest rates move up faster. I don't know, it's the fourth time that he's spoken since the Fed meeting, Mike. I think we know his position. He wants bigger rate hikes and he wants them faster. Does it do anything to the market to have these calls repeated?
Well, I mean, he's pounding the message home and significantly is also joined by some of his colleagues and not just Jay Powell. I think there's a general view out there that they are trying to get the market prepared for front-loading a lot of the hikes, not counting on inflation to ease back on its own. And I think we've mostly absorbed that. The bigger question is, you know, the S&P is up almost 10% coming into today in 6 trading days. So, you know, pulling back a percent, you know, kind of taking a breather, having bond yields also ease lower. It makes sense in this context. Just the question is, was it really just a big offsides positioning move where hedge funds had completely blown out of all their risk exposures and now they rebuilt them? Or is it more the market saying on a fundamental basis it believes it can handle what the Fed has for it?
Well, the NASDAQ is underperforming today, Mike, down more than 1%. Most of tech is not working today. And it does make you wonder, is it inflationary fears? Is it economic softness? Is it rate hikes? It's all gotten a little confused as we've seen stocks rise with bond yields lately.
Right. There's no tidy relationship there. There kind of never was, and now it's loosened up even more, especially when you consider how much the overall NASDAQ had pulled back and how much the average NASDAQ stock fell from its highs. It wasn't all about, you know, little moves in interest rates that was making that call. To me, it's much more about it was a massive short covering rally. Now, short covering is exactly how all sustainable rallies also start, so I'm not saying it's going to be fleeting, but I think it makes sense that the areas with the greatest volatility on the way down are going to be sort of twitchy as we get into this mode of figuring out if this is a lasting recovery.
Let's talk about the chips. Intel CEO Pat Gelsinger joined CNBC this morning ahead of his appearance on Capitol Hill, urging Congress to boost semiconductor chip manufacturing in the U.S. Listen.
We're either going to invest in this industry, you know, now to see it rebuild, or we're going to decline. And today, 12% in the U.S., half of that's Intel. You know, this is precarious. And that's part of the reason for my urgency and passion on this topic right now, because I fear if it starts dropping below 10% very far, we might never recover, and we will have a permanent dependence on Asia and other parts of the world that are just geopolitically unstable for the long term. Oil reserves have defined geopolitics for the last 5 decades. Where the fabs are for a digital future is more important.
Separately, Intel stock is still higher, but it lost some steam here into the close after initially spiking when NVIDIA's CEO said he would explore using Intel as a possible manufacturer of its products. Christina Partsinevelos joining us from the NASDAQ with that angle, which I guess, Christina, could be a big change for NVIDIA, right?
It could be a big change, but we got to take it with a grain of salt, right? A foundry like this would take years to come online. It's not something that's going to happen overnight. So you have NVIDIA's CEO saying that they're considering it. Yes, they're considering it. It could be good for competition later on, but they're not making any promises whatsoever. You even had the NVIDIA CEO compare Intel to Taiwan Semiconductor, saying that the caliber needs to be up there in order for this business partnership to go through. Let's not burn any bridges. This is a good compliment towards Intel and further adds to this CHIPS Act argument and the testimonies that are going on. But I think we need to think big picture that this is just, you know, I don't want to say fluff, but just a conversation that we all seem to be talking about right now. A headline.
Well, and yes, no, and it I guess takes time, to your point, Christina. So what is the underlying factor driving the stocks now? Is it on the shortages as well, or is it on sort of cyclical concerns about the economy?
Oh, that's a great question because there's two angles. You could say a lot of people or a lot of analysts and even an executive I just spoke to right now will say, oh, it has to do with all of these legacy nodes, these 28 nanometer nodes that are in a lot of EV products and data centers. That's where the shortage is. But come past 2023, we're going to have an oversupply. And the way the United States is going, we're failing on the leading edge. These are the much, much smaller chips that unfortunately have an over-reliance on Taiwan at the moment. And so that's something that we need to think about in the future, and Pat, the CEO of Intel, just spoke about right before talking to me.
Christina, thank you. Christina Partsenevelos. Mike, a lot of people want Intel to be, a good value play within semiconductors, has not made the move that we've seen in AMD or NVIDIA. Is it there yet?
It's there in terms of the statistical value, but it also has been there for quite a long time. It really seems as if the market treats it as mostly not a market share gainer. There's going to be heavy investment no matter what happens. Intel's always a massive R&D spender. So I do think you can say that the kind of recovery effort, the restructuring of Intel is definitely going according to plan, but it's very difficult to see exactly when those fruits are going to be realized. And overall, the group is really just digesting a huge, huge move. It's trading very technically, if you ask me. Semiconductor index raced right up to its 200-day average, stopped exactly there and pulled back. And it's still up, even after being down from the peak, 16%. It's up 150% off the March low exactly 2 years ago today. So it doesn't necessarily seem as if it's a neglected group even yet.
No, but has had a rough start to the year,
yes,
for sure. Apple making an acquisition in the payments space, buying British fintech startup Credit Kudos. The company develops software that uses consumers' banking data to make more informed credit checks on loan applications. It competes with companies like Experian and Equifax. Apple's made significant moves now in the payment space over the past few years with Apple Pay, the Apple Card, plans to launch a tap-to-pay feature on the iPhone. For more on how this deal could disrupt the fintech space, let's bring in Steve Kovac. Steve, who is going to be most worried about this move by Apple?
Oh, man, it's got to be Square, right? Because that's where they're directly going after, especially with that tap-to-pay feature that you were just mentioning. This is going to let businesses kind of just load up the software on their iPhone. They don't have to buy any special hardware, and then you can just boop your little phones together and make your payments. That's a Square killer right there. With this fintech acquisition, though, Sarah, it's really interesting. So what this can do is you link it to your bank account, and Credit Kudos can kind of get a better picture of your credit score. And this can be used by Apple on the back end to do things like, figure out how much Apple credit to give you on the Apple Card, or it can do stuff like if you're going to buy an expensive Apple, one of those new Macs that cost upwards of $3,000 and you want to get on a payment plan, they can kind of figure out what your monthly payments could be for something like that. So I can see this more as a back end type thing for all these Apple Pay features. And then who knows what kind of financial products they want to use it for in the future.
Where and when should we look to this business, the fintech part of Apple, as a revenue driver for the company? Is it in services?
Yeah, it's part of the services. Yeah, it's all lumped together. That's in like the same line item as App Store sales and so on and so forth. So it's all lumped together in that. And right now, today, Apple Pay, they're only making fractions of a cent off of every Apple Pay transaction. And then with the Apple Card, which is probably more lucrative, they're getting a slice of every transaction you make on the Apple Card and plus interest payments.
Steve Kovac, very interesting. Thank you very much.
Thanks,
Just group them together there. The Nasdaq's down, Mike, 11% for the year. Apple's only down 3.5%. It's been a pretty solid outperformer.
Yeah, it's closer to its high than almost any of the other big NASDAQ stocks. And I think it's mostly about quality predictability, the balance sheet, port in a storm type of effects. Plus, there's not been a lot of real fundamental erosion in the story. Not that there has been for a Microsoft either, but the valuation adjustment has just been very modest so far for Apple, thus far anyway.
I'm also noticing Tesla with some follow through to the big gains. It looks like Apple and Tesla really what's holding things up. Adobe, not great today, Mike. NVIDIA, Microsoft, Cisco, Google, Facebook. I mean, some of these stocks have more to prove after they had a nice run up over the last, 6 trading days or so?
It's been a massive one of the strongest actually on record if you look at the momentum of the NASDAQ 100 move. So again, today's little spillback is pretty much not that surprising or severe or worrisome if you actually were thinking that we had a recovery, but it doesn't want to build. But the S&P is actually now sitting just a little bit below last week's high. So you don't necessarily want to re-experience last week's trading range. Put it that way.
Yeah, Adobe negative reaction to earnings there. They're going to raise prices for the first time since 2017. Also watching the e-commerce names, Wells Fargo out with a new note on e-com trends, estimating that the pandemic pulled forward 4 to 5 years of online shopping penetration. The firm says that despite the slowdown in e-commerce after an initial surge in 2020, the shift to online shopping overall is likely to stick, Mike, and says it's still a pretty small fraction of overall retail sales at 13%. I noted this one because Etsy, some of these names have been either the top performers in the market lately or more regularly this year, the bottom performers of the market. And it's hard to figure out after, you had this big pull forward. Now Wells Fargo says 4 to 5 years, where these stocks settle out, given it is still a secular growth area of the economy.
Yeah, and I think it makes sense that during the pandemic period, it was the players that didn't already have the massive scale that had the most dramatic effect. If you were a Shopify enabling everybody to immediately go, e-commerce or omnichannel, that was a huge ramp, whereas Amazon was kind of already there, therefore didn't get its full share of the incremental growth. Now, somewhat more normal times, Amazon kind of consolidating its advantage to some degree, having had this capital investment cycle in logistics through last year, it does make sense. I do question what it ultimately means for the stock in the foreseeable, because Amazon shares have still been kind of a laggard over the last year and a half. They've traded right between where the cloud software sector has traded and where the retail sector has traded. So it's not as if it's necessarily out of whack with its components. And the market seems to prefer to pay up on a higher valuation basis for the cloud and then eventually the advertising line items for Amazon, as opposed to just the kind of raw scale in retail.
As we march into the close, I also want to note the move in financials. They're the worst part of the market today. They were the strongest part of the market yesterday. And interestingly, Mike, with this catch-up move, they're pretty much flat for the year.
Yeah.
Energy is the best performing sector, and then utilities and financials are sort of tied for second place, flat performance. Does that make sense, given how far yields have risen just over the last few weeks for financials to not be doing even better?
They have some catch up to do with yields, basically, because there was a pretty tight relationship and has been for a long time, and yields did race ahead a little bit. But it does make sense that they're actually performing right now exactly in tune with what Treasury yields are doing. Remember the big pile on into bank stocks at the start of this year. Remember, this whole correction started with a violent rotation. It wasn't really all out declines, and banks were the beneficiaries of that. So I think they have to kind of rebuild a little bit of their constituency at this point, because people got whipsawed in that move in January.
Down 52 points or so on the S&P. That is a session low. Take a look at the home builder stocks. They're falling today hard after data showed sales of new homes fell in February, second straight month of declines. This comes, of course, as mortgage rates and house prices both continue to rise. But our next guest says there are
And the CEO, Josh Brown, is with us. It's good to see you here in overtime. That really is the question. I mean, we had an ugly close. Are we already on thin ice for a rally that started to feel pretty good?
I think so. I wouldn't close my mind off completely to new highs at some point this year. I think it's going to be really tough this spring. The headwinds seem to be multiplying, not dissipating. That being said, we are going into today. We really had 5 of 6 days up more than 1% each for the S&P 500, which is extremely rare. That is, like, if you're going to talk about a textbook snapback rally, that's pretty much as good as you're ever going to see in terms of being orderly, having a lot of participation, being relentless. That's what it was. Today reverses that. It's too soon to say permanently. However, I think it's really important that we understand that that's happening in the context of oil prices pulling back, which I think is what we used to say stocks wanted. So there's a lot of mixed signals out there. I want to revisit the home builders. I think this is the #1 signal, stock market-based signal, that there is right now. And I heard Sarah's last guest, Mr. Kim, respectfully, I disagree. I think the stock market is screaming and not taking the data points that he was sharing as being the important part of the story. You look at a ratio chart.
Why do you think the home builders are so important? And I should note, as you bring that up, Josh, the XHB is pacing for its 11th negative week in the past 12. It's only had 1 positive week this year. We know that a lot of the stocks have been under pressure. And by the way, we're waiting for KBH, that's KB Homes, with their earnings, which we'll bring to you. And maybe that tells the story of what Josh is saying now. But go ahead, Josh. Why so important?
Very succinctly, whether you want to use the XHB, which is very broad and includes things like paint companies and home renovation, or you want to straight up look at ITB, which is actually home builders themselves. You look at those stocks on an absolute basis, they look terrible. You look at them on a relative basis to the S&P, they look even worse. You do not want to see home builders fading relative to the S&P and underperforming in both good markets and bad, if in fact you think that this recovery has a lot more to it. So I think that's a very troubling signal historically. You don't want to see home builders at 52-week lows if you're still thinking that we're relatively early in the economic expansion. That's very late cycle.
Do you think that these have been real buyers, so to speak, in this market leading it back? Or is this all, or the majority, just short covering?
The people that I know you're gonna have Adam Parker on at some point. Like, the people I talk to in strategist land would tell you almost everything you see intraday is related to positioning. I think you had a lot of people in late February take risk off or actively put on hedges because of the radical different sets of potential outcomes anytime there's a conflict. And a lot of those people have egg on their face right now, and you see them start to, all right, what could I chase here that doesn't look like a chase? And I think that benefited the FANG stocks, et cetera. But if positioning is that important, then understand something. That cuts both ways. And if March ends up another down month, nobody's going to want to be seen as somebody who chased this 6-day rally. So it cuts both ways. It's treacherous. Very difficult for a regular investor from one day to the next to play that game. I'm bearish. I'm bullish. I don't recommend it. This is not for you. This is algorithms doing battle with other algorithms.
Okay.
Sit back. Don't focus on day-to-day activity.
So you made the point at the outset here that you wouldn't be surprised, given everything you said, if some point this year we did make it back to new highs. What's it going to take to get there?
You can't say never, because the truth is earnings are going to be good this year. They won't be as powerful as they were off the lows. They'll be good. And by the way, you look at the history of bull markets. My friend Ryan Dietrich at LPL likes to take a look at this. We've had 11 in the post-World War II period. And on average, the third year of the bull market, which we're just starting, right? By the way, today is the 2-year anniversary of the bottom from COVID, March 23rd, right? So it was the most powerful, fastest bull market ever, up 114% off the low at its peak. 18 months was all it took for the S&P to double. It's extraordinary, but that's 2 years ago that started. We start year 3 today. What does history tell us about year 3 of a bull market? It's not great. It's an average return of about 5%. That's not the end of the world either. So if this is the year that we have to digest a double in the S&P for most investors who have been around, that's okay. I don't think you could rule out new highs later this year. If I have to bet, I think we revisit those lows from late February, and quite frankly, very good chance that we take them out. And I think that that's a reasonable point of view to take purely on technicals.
It matches with what you've been saying, whether it's here or in halftime. Your big advice to people was take advantage of the pop in stocks to get out of positions that you've been in. And I'm thinking of things like the ARC stocks, which, yes, have rallied a long way back. I think your argument would be, yes, nice rally. You use it to your advantage because those stocks are never getting all the way back to where you may have gotten in the first place.
I think, right. Think about what it would take. Keep in mind, how did we get the massive rally in the market? The Fed had to print $5 trillion in addition to dropping rates to zero, in addition to flooding everybody's bank account with capital, in addition to there being no sports to bet on, and nothing really to do other than trade stocks. Show me how we get back to that environment, and I'll tell you, okay, you can go back to buying the no earnings club. No worries. How do we get back there? In fact, one of the worst places to be, I don't talk about ARC anymore, the IPO index. The ETF is IPO, pretty easy to remember. Look at that as an indicator for risk appetite. Tell me the story that makes people all of a sudden say, oh, you know what? I liked what I was doing 2 years ago, betting on $50 billion companies that weren't going to earn money for 9 years. That made sense. Let me go back to doing that. It's not going to happen. So if you can't make up the story for why that will happen again, then yes, Scott, use big rallies in the market, whether it's short squeezes in these stocks, I don't know what's going on, but ask yourself, am I being unreasonable waiting to get back to even? The market doesn't care where you bought. Yes, you're being unreasonable. Fix your life.
We'll make that the last word for Josh Brown. We'll see you on the half. Good having you here. That's Josh Brown joining us. Do you agree or disagree with him? Let's bring in our panel. Requisite Capital's Bryn Talkington, who's also a member of the Halftime Investment Committee. Trivariate's Adam Parker joining as well, as Josh said he would. Let's discuss this. Adam, he said, wouldn't be surprised to revisit the lows, perhaps even breach them. Are you looking for the same thing?
Yeah, I'm not sure about that, but I definitely agree with Josh on the whole profitless club. Some of these businesses probably won't revisit where they were. All our work at Trivariate shows after a growth stock sell-off, you have to buy margin expansion and positive free cash flow. So these things that have popped back up, I agree with them. I think you should sell them. The part of the market that I always want to buy the dip in here is going to be energy and metals. And as you know, for the last year, Scott, we've been massively bullish on those two parts of the market. I continue to think that demand growth will exceed supply growth for the next 12, 24 months. And those stocks can still go a lot higher. So I'm probably buying dips on those, but I'm selling the tops on the profitless companies. I agree with Josh.
Well, let me ask you where you started, though. I'm not sure about that, you said. Is that like you literally don't know, or you disagree with what he's saying?
I literally don't know. I kind of wrote a few weeks ago, I thought we were kind of 80% of the way through the correction, so maybe we could get back to lows. But I tend to agree with the overall summary that we're going to have earnings growth this year. And I think we're probably going to have earnings growth in 23 versus 22. And if that's the case, I think assuming we have mid-single digit S&P return this year is reasonable. So we could get back in the second half of the year to a plus market. That's actually my base case. But it will take the Fed sort of threading the needle. It will take a U.S. consumer remaining fairly robust, and it will take corporate earnings growing. And I think that's still the base case. So whether or not we test lows on technicals or not, which I think was the main reason Josh gave, I'm just not a strong technicals guy. If I look out 6, 12 months and earnings grow, the market will recover.
Is, Bryn, the mountain simply too high to climb? All of those things that Adam says have to fall into place, are they just too many?
And we keep getting extra ones by the day. And so if you look at the U.S., first of all, we're 70% consumer driven. And so if you look at the trifecta of headwinds for the U.S. consumer, you have high housing and rental prices, you have high energy, and you have high food. and high food prices going higher. And so I think as a consumption-based economy, as the year goes on and those three things continue to be high, I think the consumer will pull back. I think GDP will come down. I think that we would be very happy to end the year flat, meaning where we started the year and where we ended the year. And so, yeah, I think this mountain is high. I mean, you can pick 7 different reasons. And I do think technically, just going back to that, we didn't see that 90% down day washout, which historically has been a good predictor of when you've actually seen a bottom. So I wouldn't be surprised, but there are definitely pockets of places to make money in, Scott.
Hey, I mean, Kramer makes the argument, Bryn, that when historically you have this kind of retracement, 50%, the signal has been all clear. Who knows if it is now, because we have existential threats to worry about and we have geopolitical concerns that are extremely serious. But what do you make of that?
Sure. I mean, I'm sure he's looked at that data, and that data could be sound. I think, though, as an investor, I'm an asset allocator. I have to think, where can I make money for our clients today? And I think that, I've been talking about energy for 2 years now. Buy the dips on energy. The cash flows of those companies are going to continue to be so strong, even at $70 to $80 oil, and they're so underlevered. Doing covered calls. If you have positions that you like in tech stocks that are down and you're not going to get a lot of capital appreciation, sell calls on those, right? We like something like a uranium where you can sell calls, and we are bullish that long term. So I think as an investor, if you're just sitting there just waiting for capital appreciation to happen all the time, I think this year can be a disappointing year for you.
Yeah, Adam, you've made the case that you don't think the Fed's going to be as hawkish as people think. I got Bullard on the tape just before I started this conversation with you saying, and it's not a surprise, but nonetheless, he continues to say it, we got to go faster. Powell seemed to lay the groundwork for 50 at maybe more than one meeting. And by the way, with the rally back, doesn't that embolden the Fed to say, you know what, our message is getting across. The market gets it and the market can absorb it because the economy is as good as Adam Parker says it is, so we can do it.
It's possible. I think if I agree with Bryn, the economy will probably slow later in the year. You'll have some areas where inflation will slow. You've seen it with used cars. You'll see it elsewhere. So the question will be, do they continue to want to do that and raise rates as the economy's slowing? I still think it'll be less than 7, but I think more importantly, what's in the price. A part of the kind of profitless market I think is the most attractive, Scott, is biotech. And if you want to be speculative, why don't you buy that innovation at all-time lows on price to sales with the pipeline that still looks the same and cash flows that don't really appear? So I still think, I agree with Bryn, you can buy stuff here independent of what the Fed does. And that's really what, we're more focused on a trivariate. So in the go-go growth stuff, I'd buy some biotech. In energy materials, you're buying every dip because demand, growth is going to exceed supply growth. And in other parts of the market, it's got to be margin expansion and pricing power. Don't buy companies where the margin expectations are too high.
Bryn, quickly and lastly to you, for somebody who owns some high growth stocks through the ARC funds, the innovation fund specifically, what do you make of this comeback in tech? Is it sustainable or not?
I think it's going to be a journey. I don't think it's going to be a race. This is going to be a marathon. There's been a lot of damage done, but I do think long term, there's some wonderful names, Tesla, Coinbase, Square. They've really come back nicely, and I think that's a good sign to see those companies come back so strong when you do have those rallies. But once again, it's going to be a journey, not a sprint.
All right. Appreciate having you both in overtime. Adam Parker, Bryn Talkington. I'll talk to you both again soon. We are getting those earnings now from KB Home, and not pretty. We're talking about a miss across the board from an earnings standpoint, top and bottom line miss. A stock that has already been under pressure, a sector that has already certainly taken some pain. And there is the stock now in overtime, down about 2 1/3%. Josh Brown was just talking about the housing space as a real worry point. You did have some housing data today that frankly was not great. It was already weighing on the builders. Sales had missed. You know about the fact that interest rates are up. Mortgage rates, by the way, the 30-year fixed is up 44% year to date. All of that a weight on home builders like KB Home, and it's showing it you on the screen here in the OT. That stock is decelerating by about 3%, and we'll keep our eye on it. Let's get into instant reaction now to the quarter. Joining us on the news line is Pete Najarian. He's the co-founder of MarketRebellion.com. You're not specifically in this name, Pete, but you are in others, and you do have thoughts on housing. What do you see?
I do, and I think they're all just enough different that you can actually look at it that way, Scott. We're talking about one of the smaller home builders in KBH. You got about a $3 billion market cap. They are levered. You look at something like a DHI, you're looking at a company that's about $30 billion and not levered. Matter of fact, great free cash flow. I think a lot of this has to do with the velocity of the move that we have seen in rates, obviously. I think that's a big part of this. It's not the entire story, but that's definitely part of it. There's been some squeeze, obviously, with inventory. Supply chain is going to be starting to loosen up a little bit, it seems, and that's absolutely part of the goal. But I think that this is going to be a struggle for a while, Scott. As we look at rates, obviously, you start to see people maybe step back a little, and I think that's what we're seeing now. As a matter of fact, in the ITB, I heard Josh bring up that ETF. That's the construction ETF that literally does cover the home builders, and DHI being about 14% of that. But they were buying some May 60 puts in there today, Scott. So it gives you a little bit of a sense that there was a little bit of weakness potentially expected in this call. I will say this, we did have some option buying in multiple different names as we got closer to the end of the day. They're going to be wrong because KBH really did absolutely miss in a big way, and I think that's going to reflect very poorly on the smaller names. I don't know if the bigger names are going to see the same weakness that we're seeing in KBH right now.
KBH down 4.5% as we have this conversation. Just to button that up, the ITB, which you're specifically referencing, is down 9 weeks out of the last 10. Talk about an ugly picture and a troubling foundation, if you will. Pete, before I let you go, I understand you did make a late day move in a big name stock, AAPL. What'd you do?
Yeah, this is one of those names that we've been talking about. Yesterday was a final trade for me because we had a lot of activity in there, Scott. They were buying upside. Today they were buying even more upside later into the day. As a matter of fact, 28,000 of the April 1st 175 strike calls were being bought today. Stock was a little higher because very end of the day, the stock did take a bit of a dip off that 171.5 sort of area. But it just continues to make me feel more and more comfortable with the positions that I have. I rolled some of my deeper in the money calls, taking a little bit of the risk off of the trade, but I did buy these calls as well today. So I'm loaded up with calls to the upside. I'm, obviously looking forward to see what we see the next couple of days. Apple hung in there pretty daggone strong all day, Scott. I thought that was pretty important. We'll obviously be talking about this tomorrow because I'll see you on the half.
It's incredible, really, the move that this stock has had, maybe the most important in the entire market, Pete, if you factor what's really at stake, the most valuable company on planet Earth, getting down to 150 on March 14th, and here we are barely a week or so later, 9 days, and it's back at 170.
Yeah, it's pretty
amazing.
incredible, and we talk about velocity all the time. That's a very big velocity move for the biggest stock in the market. That's unbelievable.
I'll catch you on the half, Pete. Thanks for being an OT. That's Pete Najarian. Let's get now to our Twitter question of the day. We're asking, what are the odds, do you think, of a recession in the United States? 25%, 50, or 100? Does the Fed have no choice but to put us there? Cast your vote at CNBC Overtime. We'll have the results later in the show. Just after the break, the bull case for stocks. Fundstrat's Tom Lee is here at Post 9 on why he sees even more upside ahead. Look forward to that conversation. And later, our MVP, our most valuable pick, Roku, losing nearly half its value this quarter. One top analyst now says it's time to get in. We'll talk about that when Overtime returns. We're back in overtime. Few strategists have been more consistently positive on stocks than our next guest. And he continues to make that case. Tom Lee is FundStrat's co-founder and head of research. He is here, as I said, at Post 9, and it's great to see you in person.
Yeah, great to see you, Scott.
But what you said was your first in-person interview since 2019.
That's right. So, for the last 3 years, everything's been virtual.
Well, it's good to have you here.
Yeah.
And look, you told me the other day, you admitted that you've been a little too bullish at times on stocks, but yet you sit here today and you continue to make the case that they can go higher.
Yes, I think stocks are definitely going through a very difficult period because we know the bond market is quite hawkish and the Fed has to, sort of meet market expectations there. And we know that consumers going to be taking a pretty big hit from commodities and fuel. But if we avoid recession, which is our belief, then stocks have discounted more than a recession. Because when we look at investor positioning institutionally, they have more cash than they did in 2009. Consumer confidence is as low as it was in 2009. And then if you look at retail sentiment, it's as bad as 2009. So people are pricing in, I think, a calamitous scenario, and that's when stocks can start to rally.
I mean, isn't it just a matter of time, though, before earnings slow, before the consumer start spending less? I mean, how can all of this not transpire in the kind of backdrop that we have? Extremely high inflation, a hawkish Fed, et cetera, et cetera, et cetera.
Yeah, it's a great question, and we won't know for a few months. That's, I think, what stocks are going to sort of be worried about.
But isn't that the base case? Isn't that the base case, that earnings are going to slow, the consumer is going to slow, the economy is going to slow, by the very nature of what the Fed is going to do?
That's exactly right. But that's also why 40% of stocks are in a bear market. So I think the market has now said over half of the S&P should be derated by 20%. And we know that consumer balance sheets are in great shape. Goldman had a great report showing that even in the bottom 2 quintiles of income, they have 12% excess savings right now. And if consumer debt levels, which are really low, means you may not see a contraction even though prices are high. So we could see a positive surprise coming out of the consumer. And war times are generally good for economic growth. So I actually think we could have some positive surprise in the second half. So I think as much as people worry about things getting bad, things could actually get better.
Let's talk about this current rally that we've experienced, today notwithstanding. What's it about? Are these real buyers? Is it reliable? Is it simply short covering? Bear market bounce? What is it?
To me, if I guessed, it feels like position squaring. I think people got bearish, went to cash, and then they realized things are so bad that you have to be somewhat re-risked. I don't think there's a lot of conviction. I think today's an example of that. But we can see leadership, too. I mean, basic materials is a structural long. And then I think we're seeing, as you guys were talking about, some pretty good relative performance of things like FANG. So I think FANG is going to be one of the groups that people realize doesn't get hurt by higher prices, and the multiples have come in, and the second half they're going to be, I think, really strong stocks.
I mean, if you talk about, changing positioning, that has a connotation with it that it's a longer lasting potential move. This is not simply short covering. It's literally people changing positions because they got too bearish.
That's right. In fact, Ryan Detrick actually has some great stats. This looks a lot like the position squaring that took place on April 2020 and 2009. So in a way, people got into a deep recession position. They need to re-risk, but then there's better resilience, and then suddenly people want to buy stocks again. I don't know if we're at that point. It might take a couple months, but I think stocks are definitely surprising to the upside.
I think one of the principal parts of your narrative is that inflation, as bad as it has been and as bad as it remains, could be rolling over. And you look at a freight index. I want you to explain why that's important to you and why you flagged that as a principal thing you're looking at.
Yeah, and it's a little complicated, but the inflation that we saw last year was due to supply chain glitches. So let's say that was the event was movement of goods, and Cass Freight Index is a measure of that because it skyrocketed. Well, that's rolled over so sharply, it's now a negative year over year, and historically that leads CPI by 6 months. So I think the goods inflation that we had hitting us last year is now diminishing. This year what we're dealing with is now this spilling into services and now oil risk, but if those actually start to plateau, then we're sort of saying the inflation picture is probably a little better than the Fed was worried about, and that's kind of a dovish development.
What if I say, okay, but labor costs show no sign of slowing down, and we know where borrowing costs are going to? That's going to slow corporate activity.
Yes. ironically, borrowing costs haven't risen as much as inflation. So actually, the cost of money has gotten cheaper this year. So we're actually more negative real rates. Today, if you borrow money, you're borrowing it at negative 5%. So it's almost positive for corporates to borrow money today because they can earn more money. That's actually good for risk assets. Historically, that's when stocks can actually see PE expansion. So as bad as it sounds, it's actually marginally positive.
Look, you need to make calls at times when the world seems uneasy. You can't wait for the market to, be at all-time highs to say, yeah, I said we're going higher. So I totally get it. I just wonder if, in some respects, you ignore some of the risks that are on the table that may be insurmountable. As I was discussing with Adam Parker, the Fed is going to be aggressive.
Yes.
We know that. And by virtue of the move that we've seen in the market, and if it does continue, don't they get emboldened by that?
Yeah. I mean, the market's pricing in 7 hikes. That's consensus. That's what the Fed futures are saying. If there are fewer hikes, as Adam was referring to, that's a positive development because we're going to be reaching the end of that hawkish cycle sooner. And of course, rates could be capped a lot sooner. Our technician, Mark Newton, thinks the 10-year is going to sort of hit 250 and then actually start to descend. That will be good for PE as well.
Hey, look, Scott Minerd was on in the first couple of days of these new programs and suggested 2.25. I mean, maybe that becomes the top on the 10-year. So he's not the only one thinking that. If, in fact, that is the case, what does it mean for the tech trade?
It's great for the tech trade because now you're paying, 45, almost 50 times for a bond. Face Meta at 16 times looks like a bargain. I think the idea of TINA comes back strong in the second half. And especially owning U.S. stocks, I mean, it's probably the safest place to put money today. I wouldn't really, if I was an Asian wealthy person or a European wealthy person, I'd be putting capital in the U.S.
Quickly, how quickly are you focused on a stock like Apple, which we had made the point, and I just did with Pete Najarian, the move that it's had from 150, which was really a perilous point. And we noted that on the very first day of overtime, that you have to watch what's happening with Apple, the biggest stock in the market. You can't have that breakdown. Well,
that's right.
It's gone the opposite direction.
Yep, that's right. It's a bellwether. It's a great company. It's now acting very strong, and it's kind of benefiting from supply chain easing. So I think in a lot of ways, if Apple's strong, I don't think you can be that bearish on the S&P.
All right. It's great to see you in person.
Yeah, great to see you, Scott.
Yeah, thanks for coming down to Post 9. That's Fun Strats. Tom Lee. We have breaking news now. Shares of Spotify are popping in the OT. Our Julia Borson is going to tell us why right now. Julia?
That's right. Spotify shares are moving higher. They're up about 2% after hours on a new deal with Google. Now Spotify subscribers will be able to pay through Google's App Store billing system in what Google calls a pilot for in-app billing choice. Now, for years, Spotify has been unable to have its subscribers sign up and pay directly through Apple's App Store or through the Google Play Store, as Spotify has battled those app stores' demands for 30% of payments processed through their platforms. Now, Spotify will be paying Google less than 30%. It's unclear exactly how much. We don't have an official number on that, but this deal shows a settlement of that conflict with Google and highlights the ongoing conflict between Apple and other app developers over fees. Spotify did side with Fortnite parent Epic in its lawsuit against Apple. You see, Spotify shares now are up over 4%. Guys, back over to you.
All right, Spotify with a nice pop there, Julia. Thanks so much. Time for a CNBC News update now with Shepard Smith. Hi, Shep.
Hi, Scott. From the news on CNBC, here's what's happening. Air Force One just touched down in Brussels. President Biden there to attend a last-minute emergency meeting of NATO leaders. He'll also travel to Poland. It's become the epicenter for refugees escaping Ukraine. National Security Advisor Jake Sullivan says more sanctions against Russia will be announced after the president consults with his NATO allies. Judge Ketanji Brown Jackson, supported by Democrats and grilled by Republicans during the final day of questioning on her Supreme Court nomination hearings. The most heated exchange between the Republican Lindsey Graham and her. For the second day in a row, Senator Graham accused Judge Jackson of being lenient in her sentencing of child sex offenders.
We have a fundamental differences of how you deter crime. I think the best way you deter crime when it comes to child pornography is you lower the bloom on anybody who goes onto the internet and pulls out these images for their pleasure.
Senator, every person in all of these charts and documents, I sent to jail because I know how serious this crime is.
Judge Jackson's hearing continuing now, and the family of Madeleine Albright releasing a statement this afternoon after the death of America's first woman to serve as Secretary of State. The family saying they lost a loving mother, grandmother, sister, aunt, and friend who died surrounded by family and friends. Her family says Dr. Albright died of cancer. The immigrant from Czechoslovakia and champion of democracy was 84 years old. Tonight, we're live in New Orleans, where a powerful tornado tore through parts of the city. The victims and the cleanup on the news. Right after Jim Cramer, 7 Eastern, CNBC. Scott, back to you.
We'll be there. Shep, thank you. That's Shep Smith. On deck here, halftime overtime. Earlier today, Joe Terranova calling Amazon the most attractive FANG stock right now. Jim Lebenthal disagrees, which is why we'll debate it coming up. Plus, the staycation trade, the one stock that could benefit from changing travel trends. We'll tell you about it in our 2-minute drill. We're back in the OT after this. And don't forget, follow the Closing Bell podcast on your favorite podcast app. Overtime. We'll be right back.
Test. 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 If anybody can hear my tests, please mention it in chat. Test, test, test.
In today's halftime overtime, Joe Terranova's bold call that Amazon has the most upside potential within the mega cap tech space.
It's not a matter of if, it's a matter of when. I will get into this stock. This stock has the most potential for upside of the FANGs. Obviously, it's going to be splitting here at the end of the quarter, and it's about to retake the 200-day moving average, which it hasn't been above since the early days of January.
Now let's bring in Cerity Partners' Jim Lebenthal to see if he agrees with that call. And I'm told, Jim, that you, it's nice to see you, by the way, that you don't. That you think Apple will be the best performer of the FANGs. Is that right?
Yeah, I hate to give you a nuanced answer, but I heard what Joe just said, and I'm more in agreement than disagreement. Where I disagree, Judge, where I disagree is obviously I own Apple and Google, but I don't own Amazon right now. But Joe chose his words carefully, and I agree. He said he's going to be in it at some point, and I think I am too. Here are the facts. It has flatlined over the last 20 months. The last time I saw an underperformance like that was Google in 18 and 19 versus its FANG brethren, and then it rapidly and massively outperformed. The big thing that I look about with Amazon is the forward multiple. On next year's earnings, it's 45 times. And I have to ask myself, is that something I'm going to wait to get cheaper? Not likely. The problem for me, Scott, is I have to sell something. You know I'm all in. I have to sell something to fund this. And at this moment, on March 23rd, there's nothing I want to sell, but stay tuned because pretty soon there will be something I want to sell, and Amazon is at the top of the list to buy.
Right here, this price looks reasonable to you. If you did have some money to put to work, you'd feel comfortable doing it at this level?
Yes, but here's what you do. Let me be clear. You start a position. This isn't a level at which you go in whole hog. This stock has had so many false breakouts. You know it as well as I do. How many times does it come up on halftime report? And it'll come up on overtime report too, as it is right now. So I don't think you need to rush in and load the boat. But yes, if you don't own it, this is an okay time to start building the position. Very similar to what I did with Salesforce. Now, the stock has come down, Salesforce, but that's one I will be adding to. That's the sort of cadence that I want to do with an Amazon when I start building it.
I got you. Jim Lebenthal, thank you for being in overtime. I'll see you soon. I know on the half. Coming up, our most valuable pick. Needham's Laura Martin has 7 reasons to buy Roku. She makes her case for you right here. We are tracking the trades with a late move. Ooh, I'm not even going to tell you the stock. Oh, we just showed it. Now I have to tell you. A late move by one of our committee members in Tesla. We'll tell you about it when the OT comes back.
Test. Test, test, test. Test, test, test. Test, test. Test. Test, test. 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 Hello. Hello.
It's time now for our most valuable pick. Take a look at Roku. Needham out with a positive note today. They have 7 reasons why you should buy that stock. And Laura Martin is the analyst behind the call. She joins us now. You could only find 7?
Yeah, exactly. I thought about starting at 5, but I thought 7 sounded like a luckier
Why
number.
not? Yeah. So of the 7, which are the 2, 3 that are most important for me?
The 2 that is the most important are the Roku channel, which is their captive advertising AVOD channel, where they sell 100% of the ad revenues, now at 80 million viewers and 60 million U.S. homes, and is their top 4 app, and is by far their most valuable property. So that's going to drive upside. And then the second key point is when you pay for the multiple here, they're basically their unit economics in the U.S., which is their most mature market, is growing 50% at the revenue line and with a 20% EBITDA margin, and they're spending all that cash rolling out Mexico and Brazil and Germany and France and the UK, which increases your total addressable market and elongates your growth trajectory, which adds value to the ultimate entity. But meanwhile, it blows, it hurts your reported earnings and your profitability.
You know, it's stunning when I look at this stock and I see that it was at $490. Now it's at $125. Yeah. What's the likelihood it gets anywhere near close to that ever again?
Well, ever again is a long time. Never is a long time. But I would say all these stocks are down 50 to 70%. The streaming world, the advertising-based world. In a face of rising interest rates, these stocks without current cash flow trade like long-duration bonds. So, when rates stabilize, all these stocks should be able to have multiple expansion from here.
You think it's literally that tied to the movement in interest rates? Because there's some of that's been debunked, that rates are so closely tied to these long duration assets like some of these higher growth technology stocks, and they just got so fundamentally or the stocks just got so crazy ahead of the fundamentals that here we are.
Yeah, I think part of it was COVID because we all got locked up. Things like Netflix and Roku were the beneficiary of those lockdowns. And now we're unwinding from that. So the growth is slowing compared to the COVID period. But I do think starting in 2022 and 2023, we're back to normal fundamental growth. And we have to wait for the multiples to re-expand for these ad-driven names.
Laura, I appreciate your time. That's Laura Martin joining us today from Needham. Coming up, halftime committee member Steve Weiss making a late day trade. He'll join us next to give you those details. Plus, Apple, a rare bright spot. As we said in today's session, it's the topic of Mike Santoli's last word as well.
Test. Test.
We have an alert on Tesla in the OT. Steve Weiss hitting the sell button on some calls. He joins us now on the news line. What's this about?
Well, Scott, I bought the calls yesterday when they were revealing, or Musk was introducing the plant in Germany, opening it up. Thought it was a good opportunity, particularly with the production numbers are just going to be incredible, up to 1.4 million cars per year with all their facilities. But given my market view, which is cautious to say the least, when oil started spiking today, it was a good time to hit the exit. It was a great gain, up about 150% overnight. I'll take that every day. So if you trade, you got to trade quickly in these markets, otherwise profits just evaporate.
So this is a larger market call along with a tactical one in the Tesla options as well, just selling the rips, essentially.
Exactly. You're buying the dips, you're selling the rips. This one didn't really dip, but it didn't absorb the good news. It traded up in line with the other stocks that recovered. So nothing was in it for the plant opening, which I thought was going to be a big event. It turned out to be. So, look, I think the stock can recover. It doesn't matter about valuation on this one. But, again, with my market backdrop, I just can't stay in trades too long. And this was long enough. You just don't want to be – it's not a market to be greedy. It's a market to be tactical and to take profits when they arise or cut your losses. I also bought the SMH yesterday and, sold the remainder of it today at a loss. So they don't all work out. Just have to control risk.
Wow, that's quick. In and out of the SMH.
Well, yes, it was just to get market exposure. Was the reason I bought it. Not any real view on semis here. I've got enough semi exposure with on. So quickly, just quick trades here and there. I would have loved to have stayed in longer, but oil just didn't cooperate.
Yep, I got it. All right, Steve, thank you. That's Steve Weiss joining us. Up next, is Apple the ultimate safety trade? Santoli's last word is coming your way next. 2-minute drill. The OT is back after this.
Test. Hello. Test.
bring in Mike Santoli for Santoli's last word. Today, it's Apple.
It is Apple, and kind of asking the question maybe why it's held up so well. If you looked at the NASDAQ stocks, NASDAQ 100 stocks that are closest to their all-time high, Apple's really the first mega cap growth stock in there. There's a lot of staples in there. It's Constellation Brands. Why is that? Obviously, there's kind of a bulletproof balance sheet, safety, quality trade going on there. Not a lot of change in the fundamental outlook, even though maybe they could have been tripped up by some of the supply chain stuff in China. What is interesting is it's now trading valuation-wise at a premium to Alphabet by a few PE points, and that's not been usual over the course of the last 15 years. That's the iPhone era, really. And you see it happens in times of market stress. 2009, again a couple of times in 2020. It has always been the case that Alphabet gets back to a more premium multiple. So it's worth asking the question if there's some convergence here that might go on, or if something different is happening with Apple. We'll point out year-to-date, buyback and dividend stocks are outperforming the S&P. Of course, Apple, one of the biggest of those.
Are you surprised that it's worked its way back towards a new high the way that it has? I mean, it was at 150.
Yeah.
On the 14th, the day we started this.
Surprising maybe the speed of it, but what was really interesting is if you went back and looked at how it traded relative to its own 200-day average, it just cracked right below it real quick, kind of trap for people who thought it was going to be breaking down. And that coincided exactly when the overall market was getting stretched to the downside, and we got this bounce in the last 6 days.
That's why it's so interesting. It may have saved the market from having a deeper upset, and
it contributed.
So interesting.
No, it's fascinating. It definitely is also one of those, the market's going to do the thing that kind of keeps the maximum number of people off balance. So before Apple goes back toward its highs, it's going to look like it's breaking down. And that's exactly what happened last week.
Yeah. So let's see how much staying power this now has for direction on whether the rally itself
because sometimes Apple, if the overall market is in kind of melt-up mode, Apple sometimes sits it out. It kind of goes on its own clock, so we'll see if the rest of the FANGs maybe have a little catch-up.
Right, good last word, Mike Santoli. Thank you very much. Our 2-minute drill is coming up next. 3 top picks for your portfolio and another quick check on KB Home. Reporting earnings during the show, a miss on the top and the bottom line. You see what the stock is doing. It's down close to 4%. We're back right after this.
Guest. Guest.
All right, welcome back to Overtime. Let's get the results now of our Twitter question of the day. We asked, what are the odds you think the U.S. economy is going into a recession or not? 25%, 50%, or 100%? Most of you putting the odds at 100%. Which is kind of surprising. Where's the optimism? Guess we're going to have to wait and see what happens. It's time now for the 2-minute drill. 3 picks for your portfolio. Joining us now is Joanne Feeney, Advisors Capital Managing Partner and Portfolio Manager. It's good to see you. Welcome to Overtime.
Hey, Scott. Good to see you as well.
Let's talk about some of these picks you have. You do have 3. Broadcom is at the top of your list. Why?
Broadcom is something we've owned since I joined the firm back in 2015. It has deep moats around it, provides connectivity chips for the data center, for the iPhone, and it offers a very nice dividend. We have a lot of clients who want to see both growth in their portfolios and income. The income helps them sleep at night, and Broadcom has delivered very well, raising their dividend every year since they started offering it in December. So really a core position at the firm in a lot of our different strategies.
How closely tied is it to how Apple moves?
You know, the Apple side of their business is, 15, 20% of their revenue. So it is tied to them, but they've diversified away from that exposure every year as that's grown as part of the business. Now they're in data centers more broadly. They're now in software. They're in security software. So they've become more diversified, which is one of the reasons why the multiple has expanded over the years. And we expect the multiple to continue to expand. So pretty well diversified at this point.
KTOS, Kratos, a defense play?
Yeah, Kratos makes drones, targeting drones, surveillance, swarming drones, wingman drones. And what we expect there, obviously, it's a nice defensive position to have in a portfolio given all these geopolitical risks. But we also see it as an appreciation opportunity because we see defense spending rising around the world. And we also see an increasing share of defense spending going towards drone technology, which is a reason why we bought it several years ago. We think it's going to be a good position to keep holding for the long term here.
Tell me about your last pick, which is Six Flags.
As you hinted earlier, Scott, it's a staycation play in some ways. Six Flags Entertainment really suffered during COVID. And now, as things reopen, people have to remember that the reopening trade is still worth looking at. Six Flags offers rising earnings. Their free cash flow has turned positive. It's going to be growing. And we see it with their subscription business as really generating a lot of loyalty among their visitors. And even though the consumer budget is being constrained now because of high inflation, this is an opportunity because when consumers find that their budgets are constrained and they don't want to take long, expensive vacations, they do the staycation and they tend to go to theme parks. They're also, with that cash flow, reducing their debt, which is a bit high at this point, but they're really good managers of that. And, it looks like a good opportunity going forward.
Gotta go. Joanne Feeney, thank you so much. That does it for us in Overtime. We'll see you tomorrow. Fast is now.
Live from the NASDAQ market site overlooking New York City's Times Square, this is Fast Money. I'm Melissa Lee. Tonight's trader lineup: Tim Seymour, Guy Adami, Bono and Ison, and Steve Grasso. Ahead on Fast, stocks finish at the lows of the day. The major averages all down over 1%. Oil surging again with WTI back to nearly $115 a barrel. The 10-year yield, the highest level since 2019. How should you trade today's moves? Plus, today marks 2 years since the market hit its pandemic bottom. The S&P has basically doubled since then, and some stocks have done even better, a little traded or faded on the names with some of the biggest gains. And later, cannabis combos, 2 multi-billion-dollar deals in the cannabis market. The CEO of Cresco Labs will join us to talk about his move to buy Columbia Care. Weed Wednesday here on Fast Money.
Oh, man.
But we start off with troubling signs in the housing market. Demand for refinancing plunged 14% in the latest week, and new home sales unexpectedly dropped last month. The disappointing data comes on the back of spiking mortgage rates. The average on a 30-year fixed now at 4.72%, and median home prices are up almost 11% from a year ago. So does the pressure on affordability mean the end of the housing trade? Tim, what do you say?
Well, the Fed will not tell you this to your face, but one of the things that they target is the wealth effect and household, certainly asset base. And so the asset bubble that we have here is certainly very much about housing as much as it is the stock market, and it makes the consumer feel better, makes them go out and spend. Look at Home Depot down, over 3% today and trading essentially near the lows after a little bit of a bounce. All of the housing stocks, the XHB, and we've started to see this, and we started to see this really almost 6 months ago, but has kicked into overdrive as mortgage rates have moved higher.
one thing to say here, and this is a day also, though, where we saw the 10-year spike up to levels we hadn't seen in almost 3 years, then to fall, finish on the lows down at 229. And really, there is some sense here that the 10-year is going to fluctuate. And if we start to think that the Fed is going to move too quickly, it certainly could price in more recessionary dynamics, and that will help mortgages. Bottom line is houses are not affordable in this country now. They're not going to be more affordable when you have a mortgage rate over 5%, and that's going to be painful.
Yeah, or Guy, do consumers feel okay because the stock market is still all right for now, at least?
Yeah, they absolutely do, no question about it. But to Tim's point, I mean, the higher rates go, the more difficult this trade is going to be. I'll say this, he mentioned Home Depot. Stock's down 25% since that high. I think it was in November, north of $400. 305 to me is a really interesting level of support where we broke out from in June. But in terms of these KBH numbers, listen, they missed on the top and bottom line, not good. People will point to valuation. I don't think you can really look at these names in terms of valuation. I think KBH has a little more room to downside. Stock's already sold off about 35% since its recent high. We're in some dangerous waters here. I will say this quickly. What you saw today, again, I mean, a 10 basis point move in the bond market over the course of a day. I mean, think about how crazy that is when you talk about volatility in the bond market. And if the market, in my opinion, which is on, I think, next leg lower, you'll see a flight to quality in the form of bond yields will knock yields lower, which will further, again, in my opinion, this yield curve, which continues to flatten out.
You can't buy home builders in a rising rate environment with slowing growth. There's going to be less mortgages. There's going to be less home equity loans. So you can't buy Home Depot or Lowe's. The entire complex, I think, is for sale. And I agree with Guy. I think you're going to be looking at a recession. People don't buy homes in a recession. It's that simple. In a one-word answer, no, you can't be buyer.
But is that the assumption that we're going to be making here, that you stick a fork, as we said in the Chiron TV language, stick a fork in the housing trade because a recession is on the way? But if there's an economic slowdown, Bonwin, can you actually say that the whole space, the whole sector is a sale? I mean, there is a line of thinking that if people stay in place in their homes, they will fix up their homes. And so maybe a Lowe's and a Home Depot do okay because you're going to renovate your bathroom.
If they could take out a home equity. Sorry, Bonwin.
Okay, so is that the crux of it, Bonwin?
No, that's fine. I mean, I think Steve makes a good point, and I hear you on the home equity lines. I don't think Lowe's or Home Depot would be the way that I would play it. It would be more on the operator side. A name like Blackstone, you're still seeing rents continue to grow. Housing affordability is out of reach, but they're expert operators. So, no, the entire complex isn't gone, but I want to be at the upper echelon of said complex, and that is how I would play it. Totally on the same page in terms of Home Depot and Lowe's, access to credit. I mean, at what point does a consumer catch a break here? I mean, I know we're all going to point to savings rates and point to the strength of the consumer there, but if you're being squeezed on inflationary pressures from energy and commodities, and now in terms of housing and credit tightening, at some point the shoe has to drop, and I think all of the panelists are pointing to it and saying, keep an eye on this 2s, 10s, or even 5 10s, which is now inverted, and let's make an estimated guess in terms of where we're going in terms of strength of the economy. But the housing market, I do believe, is on the precipice of having some real pain. I do think names like KBH, et cetera, have sold off so much that maybe you play the contrarian view. But I do think that very upper echelon aspect of operating within the rental space, I still think there's room for cash flow there.
Speaking of KB, we see the stock down 4% in the after-hour session. We got an earnings alert here. It reported results after the bell here. CNBC's Diana Olick has got the numbers. Diana.
Well, Melissa, it was a miss on the top and bottom line. CEO Jeff Metzger said in the release, while we grew our revenues 23% as the quarter progressed, supply chain issues intensified and an already constrained construction labor force was further stressed, which extended our build times and delayed completions and planned deliveries. He added that they would continue to work on navigating through these challenges. Now, the average selling price of a KB home rose 22% to over $486,000. And we got the national new home sales numbers figures out this morning. And for February, median prices were up 10% year over year. So builders still seem to think they have some pricing power despite the sharp jump in mortgage rates. KB also reported an 8% rise in inventories. Nationally, new home inventories are at a 6-month supply. That's considered a balanced market, while existing home supplies, they're at less than 2 months. And one analyst today on the national numbers suggested maybe the home builders are overbuilding. I mean, who would have thought that when we talk about the record low supply we've had over the last couple of years, Melissa?
Overbuilding. Wow. I would not think of that. Yeah. Diana, thank you. Diana Olek. Diana mentioned a whole litany of reasons why the housing trade is a difficult one. Labor, supply chain, rising mortgage rates. But this is just one way in which the consumer is getting pinched, right? I mean, Bonawyn had another, few examples. Food costs, drug costs, everything costs. Auto financing, by the way.
Yeah, very connected.
Right? Auto financing. Once upon a time, it was always 0%. Now it's more than 2%. So you're paying more for a car.
No question
in
about
every way.
You're paying more for everything in every way and I think that's a great point. We got to bring it up. And we've talked about the HYG. If you want to get sort of down the credit rabbit hole, you got to continue to watch what that does over the next couple of weeks. It's interesting. Bonawyn said contrarian trade. He's spot on with this one in terms of KBH. If you look at it, this time 2 years ago, the stock, I think, traded down to $15. Recent high, I think, in the spring of last year, 52. 33.5 for a lot of reasons. 50% retracement of that range makes sense, and we're probably going to see it tomorrow. So if you're looking just to trade and for trading opportunities, a lot's been taken out of this name already. You might want to get long KBH against that 33.5 level, Mel.
KBH, if you look at the gross margin and the outlook here, again, 26, 27%, I think they would be heroes to get there. I think you look at all the pressure. Lumber futures, remember we talked about lumber last year and the stratospheric moves. Well, they're back up about 25% off of where they had settled back down. And there's no sign to me that this is going to alleviate. So if you look at the home builders, order backlog up 29%. The average in the median price now 22%. The average in the median price now 25%. That's a lot. And you're talking about a basis point percentage rate on top of that. There's no reason to get
if you were to extend what you're saying about the consumer, if you were to extend what you're saying about consumers, I mean, how interest rates in retailers, I mean, how interest rates in are we going to see difficulties in those trades too in your view? Are we going to see difficulties in those trades too in your view?
Yeah, I think it's tough. I mean, that consumer discretionary space, will probably feel some pain as well. A name like Nike, Adidas, and some of those like top tier names, I prefer to rotate into like a TJX, something that's just a little bit lower cost price point. Dollar Tree or Dollar General, I mean, they have had some of their challenges, but things like that I think have a bit lower beta and hold up a little bit better in terms of elasticity of demand. I think Nike also has, some decent exposure to China and in Europe, and there's uncertainty there. I just don't really see a lot of catalysts that make me want to jump in. And to the other guy's points, I mean, KBH is a name that I own, I acquired recently, and it's really just about risk reward. I don't think that the backdrop sets up well. I've kind of stated my points about the consumer. But at some point, you will see one of these head fake rallies, which we've continued to see. I mean, I embarrass myself, but you've got to trade, and the market presents opportunities two ways. And if you want to kind of step in and establish a position, I think there are points and times to do that.
I think simply, again, I'd go back to that semi chart from housing to semiconductors because that was down 2.5% today. That's the ultimate cyclicality for this economy, and I think the market felt it today.
All right. Our next guest warns housing is creating a tougher situation for the Fed. Michael Schumacher is head of macro strategy at Wells Fargo Securities. Michael, great to have you with us. Is the Fed watching mortgage rates effectively spike? I mean, the rise in mortgage rates that we've seen has been astronomical. You also sent our producer Stephanie Landsman an ad, a Toyota ad, a financing, and that's one that I was referring to in our discussion earlier, where financing is now 2.49%, which is a lot more for the consumer that's used to 0% financing for so many years. Does the Fed look at this and think this is going to be strain on the economy?
Yes. Yeah, it's interesting, Melissa. The Fed is looking at so many indicators right now. It can probably have a very difficult time keeping track of them. You've got mortgage rates, Ukraine, commodity prices. Oh, by the way, just garden variety inflation and the reopening from the pandemic. It's extremely difficult to track all these things and interrelate them. So I think from the Fed's perspective, and Chairman Powell's acknowledged this, the big dose of humility for the Fed and for all of us in the market is what's needed. So very, very tough to plot a single path forward.
We were talking about the R word earlier, recession, and you say 50% chance of recession in late 2023. Why the lag in your call, and is 50% for you a high number?
I think the idea of having a soft landing was always going to be really challenging. And when you think about the additional, I hate to call it a wrinkle, but complication of the Russia invasion over the last month and the surge in commodity prices, it makes it super difficult for the Fed to calibrate. So thinking about it pretty simply today, inflation 8% round numbers over the last year, unemployment really low, interest rates going up a bunch. How can the Fed really figure out exactly where to land that ship? It's going to be really tough. And that's why we think that the chance of a recession is going up almost by the day.
Mixed metaphor notwithstanding on landing the ship. By the way, I dig that, Michael. You know, you mentioned your work is tremendous.
Spaceship.
You said back half of 2023. And it's interesting because I think the market is pricing in rate cuts right around that time. Can you speak to that?
Sure. Yeah, that's really interesting. And the market's pricing in rate cuts starting from right around the end of 23 through 24 and 25. And it's this whole idea the Fed tends to overshoot. And I think the chance of that probably is getting higher, too, by the day. You'd say, well, if calibrating the soft landing is tough, it could be the case the Fed hikes 1 or 2 times too many. And in fact, that's what happened in the last cycle. Recall the last hike was December of 2018. A few weeks later, Chairman Powell walked it back. About 6 months after that, the Fed was cutting again. So it's the same sort of idea here. Now, the market's not pricing a lot of easing, 25, 30, 40 basis points, something like that. But it's a really good point. The market is pricing easing starting toward the end of 23.
Now, Michael, in terms of your rate forecast for the 10-year yield, you're seeing as high as 2.75% of the 10-year by mid-year, but then you see rates actually going down. Can you give us sort of the backdrop for the going down part of it if the Fed is now talking about multiple 50 basis point hikes?
Well, if it's multiple 50 basis point hikes, then we're talking about rates going up. But the path for rates to go down would be exactly the scenario we just talked about a couple minutes ago or a minute ago with the Fed cutting, let's say, toward the end of 23. In that case, I think the path is yields go up a decent amount over the next few months. 10-year rate goes up to, call it high 2s, maybe low 3s toward the end of this year, and then starts to come down after that. But it's going to be a really tough path if the Fed throws in a couple 50 basis point moves. The market simply is not prepared for that.
Hey, Michael, it's Tim. So perversely, is less demand both in housing and in other parts of the economy, is this somewhat good news? Obviously for the Fed that has significant issues on where there have been bottlenecks and this reopening kind of hysteria. What do you think about that?
Yeah, it really is the point of tightening for the Fed. So when you consider why does the Fed tighten, it's not because it wants to be a bunch of bad people. The Fed really does want to cut demand. So far, it's only done the 125 basis point hike. It's talked up a lot of additional hikes and other fun things, but the Fed does want to take demand down. So as we see a reduction, whether it's in housing or other areas, that's the Fed's goal. Now, the speed and the magnitude, that's a different question. Can the Fed really pull that off? But as far as the direction, that's how the Fed does want it to go. So that is good news.
So, Michael, last question here. You say the chance of recession rises each and every day. If the Fed actually front loads the rate hikes, does that chance get lessened? I mean, does it rise by a smaller increment every single day? Is there a way for the Fed to actually avert that outcome?
There's not a really great path for the Fed to try and limit recession risk. As far as going big, going early, so going 50 basis points in May, another 50 basis points pretty soon, would that really help? It might potentially cut the upside risk in inflation, but I don't know that it really changes the ultimate question of how do you calibrate all these issues that are coming together. No one, including the Fed, has seen inflation like this in the U.S. in 30 or 40 years. Pandemic, that's a once-in-a-century thing. On top of that, a shooting war. That's a lot to pull together. So does throwing in a 50 or 2 really change the calculation? I think it doesn't.
Michael, thank you so much for joining us. We appreciate it.
Thank you.
All right, so it is different this time around, Steve.
Yeah, but why wouldn't so the way I looked at the way Michael just left off with all the litany of things that are going on now is my reasoning for the Fed to sort of take the foot off the gas but I could play both sides of it. The next downturn, they're going to need some ammo. They don't have any ammo right now. There's nothing to cut. So they're going to need to bolster that to create the cutting possibility.
Hence the box we always talk about, Bonawyn. The Fed has created a box for itself, and now it's trapped.
Yep, I mean, there's one path forward. That's higher rates, and that's a lighter balance sheet. And to Steve's point, they have to take those steps in order to give themselves some wiggle room. So if there is a risk, it is to them overshooting, but then being equipped with tools necessary to help abate risk.
So me being the eternal optimist will ask this question once again, and I say that, of course, sarcastically. Isn't it possible that rates go higher in the market's view, that is the Fed is really doing its darndest to fight inflation, and that is a good thing for the markets? Guy Adami, I'll go to you on that.
You can make that argument. I know you're being facetious, another word that I'm unable to spell, but yeah, I think the optimists will look at that and say, hey, for the first time since basically Paul Volcker, they're trying to get in front of something they should have been in front of 3.5 years ago. And that's a way to look at it through the optimistic lens. Again, you just heard Michael talk about it. There's no shot that they thread this needle zero. And quite frankly, if Jerome Powell were smart and if he wants to get on the good graces of people like me, not that that matters, he should show up on Saturday Night Live with Justin Timberlake and they could do like the Fed in a box thing. It would be brilliant. I'll produce that, by the way, Melms.
All right. So noted. We've got a news alert we got to get to on Nikola. Shares jumping after hours after the company said it started production on its commercial truck this week. The comments made at an analyst event. Nikola previously expected to start full production by the end of the second quarter. They're actually producing trucks, Tim.
Well, that's great, but I think there's been so many missteps or certainly misdirections, head fakes in terms of the headlines here. I know we've been disappointed by Rivian's production dynamics, and we could have dropped Ford and GM into that last conversation, but if I'm going to be playing the EV space, why wouldn't I go grab the companies that actually can survive in a difficult capital markets environment and are trading at 7 or 8 times? I think it's Ford and GM. It's not Nikola for me.
Coming up, high energy, crude prices jumping, and that is fueling gains in another area of the market. The details next. Plus, today marks 2 years since the pandemic lows in the market, so we are tackling some of the biggest movers since then. Trade it or fade it, fade it. America's favorite game is coming your way. Don't go anywhere. Much more fast in 2. Welcome back to Fast Money. Crude oil up more than 5% today. Prices moving back above $15 a barrel as pipeline disruptions hit Russia and Kazakhstan. The rise in energy prices over the past month helping fuel the transport and resource trade. Take a look at the 1-month gains in rail stocks. So can this trade keep chugging along? Choo-choo. Tim.
Yeah, I think so. Again, UNP is a name I'm long, a name that I think continues to see higher margins. Obviously, transport rates go higher. They have higher costs as well. But if you look at the rails and you look at CSX and you look, these are businesses that I think through the worst of the COVID dynamic and demand destruction became better businesses. Again, that's when companies get better. And I think if you look at the margin profile of these two companies, they continue to go higher. At some point, higher prices are certainly going to be a demand destruction dynamic. But for now, I think the rails have really a sweet spot. And energy prices, as we talked about here, aren't going down anytime soon. I just quickly want to highlight, Hess at an industry conference this week paid to take off the upside collars, or essentially they sold upside calls on their oil hedge. They think oil prices are going a lot higher. Saudi Aramco pointed out that they actually have expansion coming online, but not till 2026. This is an environment where I just think we're going to continue to see commodity prices move higher.
Bonawyn?
If I'm picking between the two or playing the would you rather game, I definitely agree with Tim in terms of rails as opposed to the outright energy exposure. It's just too volatile, and the geopolitical risk is too much of a driver in terms of price action there. I will disagree a little bit. I'd prefer CSX or NSC just because of the debt load. So if I'm going to play the rails, I'd rather be in those two names vis-a-vis UMP.
I thought Bonawyn always played by the rules, but apparently he doesn't. Guy, he hasn't
He's
learned.
playing by his rules. I think that's cool. Go for it, Bonawyn.
Hasn't learned. There's only one person on the show that calls for would you rather.
That's Guy.
Yeah.
No,
Guy, you like the rails.
I never listen. No, I do like the rails. Tim's spot on with this. They win in this environment. They become. Think about the efficiencies they've been able to master over the last 5 years. So the rails win. But in terms of the resource trade, we haven't really run that far from this one. Alcoa today. Alcoa made a 15-year high, traded north of $95. We haven't seen that since, I think, the spring of '07. And OIH, another one, listen, again, I say it all the time. I'm wrong often, but this one we've gotten right. OIH, we said it would pull back to 250. Actually got back to 253 on March 16th. Back on the horse. I think it easily trades north of 300. The energy trade is far from being over, in my opinion.
Now, I agree with that. I don't think it's over, but it does feel like it's a crescendo, if you will. I think that we're moving out. Well, I know that we're moving out of the winter, at the very least, and so the weather is going to warm up. So that might take the edge off. Granted, the news headlines that are coming out aren't getting any better. I just feel like we're a little toppy there.
But isn't supply? I mean, the supply coming off the market far offsets.
Yeah, but there's other places to get supply.
We're going into peak demand season, though. I mean, the U.S. driver is 10% of the world's auto demand. They're half of the 20% of the
But I think Germany and I think the rest of the European countries getting their natural gas from Russia, I think that was a big catalyst to the upside. This is not about heating. It's not about driving. It's about heating.
Yeah, I just think that when you look at, first of all, oil is now 26% off of where it come back, and it fell 27%. It's now 26%, which means it's actually only halfway back up into that new price spike. I think we're going to spend a lot of time north of $125. There's no spare capacity out there. Mentioned Saudi Aramco, mentioned OPEC Plus. Russia was a big part of that OPEC Plus, and some of that flexibility, that's gone.
This is coming from a person who believes that WTI crude is going to be at $65 to $85 by year end. So, and I was on the low side because I think markets, as they do with everything else, they overshoot in both directions. So I think we're going to overshoot.
You think we're going to be at $65 a barrel by year end this year?
It's a long time. A lot of green, as they say in the Gulf.
Wow, that's aggressive.
That's a lot of wood. Yeah, it's very aggressive. All right.
You're on the clock.
We got it on tape. We are just getting started here on Fast Money. Here's what's coming up next.
2 years ago, stocks hit rock bottom, but a lot's changed since then. So, should your portfolio? A game of trade it or fade it is next. Plus, Buffett Berkshire Beat, the chart you've got to see. And our own Tim Seymour is breaking it down. You're watching Fast Money, live from the NASDAQ market site in Times Square. We're back right after this.
Welcome back to Fast Money Markets. Taking a big breather after a strong 7-day run, the three major indices all down more than 1%, with financials and healthcare leading the losses. The S&P posting its biggest drop in nearly 2 weeks. So this is the end of the mini rally we've seen over the last several days. Is this really a resumption of what we are going to be in for, Bonawyn?
Yeah, I think the risk is to the downside. We had essentially, with the whole Ukraine-Russia thing, there was so much positive catalyst or perceived positive catalyst. Was there going to be some resumption of peace talks? Were they going to kind of strike a deal in terms of them not being involved in NATO? China came out with news saying that they were going to be more accommodative to the market. So there was reason to kind of retrench and buy back in. I think the Fed overshoots or overshadows all of that, and I definitely think the risk is down to the right.
I mean, we had Loretta Mester joining the 50 basis point party guy, along with Mary Daly of the San Francisco Fed. So it seems like that party is getting, that camp, the 50 basis point camp, is getting fuller and fuller.
Thank goodness, because, again, they're 3.5 years late to the party. And I really believe they're going out there and they're saying these things to try to condition the market that, quite frankly, at least last week, for whatever reason, doesn't want to believe them. And again, I'm not thinking anything catastrophic is going to happen here, but we're in I believe, an earnings cycle. We're going to see decelerating earnings and against evaluations that now matter in an environment where the Fed's rightly hiking. So I think the market's going to feel pain in the short to medium term.
One could push back on this, but I'm going to say that the Fed has successfully told the market rallied last week as they hiked and also gave you a lot of ammunition. I think we all are probably in the tactical camp of markets are going to trade lower here, but they have told you what they're going to do, and I think they've been pretty successful. Right now, I don't like the long-term track record.
All right. Well, today, by the way, also marks 2 years since the pandemic bottom. By March 23rd, 2020, the S&P had dropped nearly 34% from its record close just a month earlier. Since then, it's climbed nearly 94%, and a lot of names have come along with it. The biggest winner, Tesla, up more than 1,000%. But it's not the only name that's beaten the market. So do you stick with these big winners? We'll find out with a game of trade it or fade it.
Thank goodness.
I know you're wondering what that was. All right. Let's start off with Moderna, up more than 530% since the pandemic bottom. Guy, trade it or fade it?
Yeah, I'm going to play the game correctly. I'm going to say trade it. And you mentioned how much it's up. I'll tell you it's down 75% since it traded 497 or something last fall. Now, look, this is a trading call specifically, but you can actually make, for the first time in a while, a pretty compelling case for Moderna on valuation, not only in price to earnings, but in terms of price to revenue as well, or where it's trading in terms of revenue. So I like Moderna here. I think it could bounce. It's bounced off of 117. I think it's got another 25 to 30% upside from here.
Steve, what say you?
I'm going to say the opposite, because that's the way we play this game.
That is not the way we play the game.
That makes it sound rigged.
I know. This game is not rigged.
Well, you're not going to have us both. The audience knows they're not dumb. They know that I'm not going to say trade it if Guy just said trade it.
You watch. We're going to get two people on the same side.
Go ahead, talk.
Fade it. So this stock has been in a declining trend line since August of 21. So for me, we're not breaking out of that declining trend line. And with the vaccines off the front page, Russia on the front page, this one is a faded, not a traded.
Next up, American Express, up more than 150% in 2 years. I don't know what Tim is going to say.
No, the first one you don't know.
Trade it. Trade it or fade it?
I'm going to trade it. I wish it was 2 weeks ago. I definitely was going to trade it because the stock has bounced nicely along with the entire market. But if you listen to the recent Investor Day, one of the things to be excited about with AXP is their focus on the small, medium-sized business, the SMBs, and actually having them integrate their payments and their banking. I think they will grow significantly higher than at least their two biggest peers. I think the high-end spend is still alive.
I bet you Bonawyn's going to say something, not trade it.
I was going to say zip it, but that's too aggressive.
I'm going to play the game correctly. I'm going to fade it. I'm playing by the rules. I'm playing by the rules. Fade it. Listen, I think Tim makes a lot of good points. The SMB, I will say that, that is correlated to the overall economy, and I think credit crunches make it a bit tough for that consumer. Outside of that, I think this is really a technical play for me. To Tim's point, this has made a beeline from 145, 150, back to around 180 or 190 where it closed today. I just don't think there's a lot of upside, with a lot of the analysts calling for about a 205 price target. So it's just a risk reward. I'm fading it in the short term.
All right. Then there's Amazon. Saw huge demand since the pandemic, up 77% in the last 2 years. Tim?
For trade. I'm going to trade it. I'm going to trade it. And just because I'm first doesn't mean it had to be a trade. I can't wait till we open with a fade. But Amazon, to me, one of the great winners of COVID, because they should be, because they were there for us. The stock actually certainly pulled forward a lot of demand. The e-commerce trends going forward, though, continue to be in Amazon's favor. In fact, the stock really has underperformed with the exception of the last 3 weeks. Believe it or not, this is a company that's not an awful valuation, certainly relative to itself. I'm trading this one.
Guy?
Yeah, I'm with Tim. No, I'm kidding. I just wanted to get Steve. Mad. No, fade it, Mel. I'm going to play the game correctly. Listen, a couple weeks ago they announced the stock split. We said the stock has room to 33.50. Look at where it traded today. This is a tactical call because in the back half of the year, I think Amazon can go significantly higher. But we've gone up $500 effectively since then. I think Amazon could back and fill, as they say, to a 29.50 level, Melms.
All right, next up, DocuSign, another big stay-at-home game.
Sorry. Did I jump
Can I
on you?
mute Grasso?
Did I jump
Can I
on
have the
you?
power to mute his mic?
I could talk in your mic.
The stock, though, has given up so much of its, not if I kick you off. Steve, what do you say? Trade
I'm going to say trade this one. So the way I look at this, yes, it's been hammered. Yes, the valuation was inconceivable the most. But if you go back pre-pandemic, we traded down to that level again. This stock is a better stock, better company than back then. Trade it.
Bonawyn.
I feel good about this, by the way.
Trade it or fade it.
Trade it, Mel. For a lot of the same reasons that Steve pointed out. But I will also say, aside from the technical backdrop, it's just cheaper across the board. And what's cheaper by about half is the PEG ratio, what you're actually paying for growth. That was the whole catalyst, momentum, and thesis behind owning this stock in the first place. Now you're paying 50 cents on the dollar for it. I'll buy it right here.
I will say it one more time. This game is not rigged or
This
choreographed.
is a much better game now. You're welcome.
Great game.
We're rolling into the pot stocks with Cresco Labs CEO Charlie Bachtell. He's laying out the big marijuana merger his company just inked. The details ahead, plus our chart of the day, the stock outperforming the broader market since November. We'll give you the name next when Fast Money returns.
Get your trades to go with the Fast Money Podcast. Catch us anytime, anywhere. Follow today on your favorite podcasting app. We're back right after this.
Test. 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 Testing. Test. Test. Testing. Test. Test.
Welcome back to Fast Money. That is right. We've got a chart of the day, and this one is brought to you by our very own Tim Seymour. So, Tim, what's your chart?
Love me some charts, doing some scrolling. Look, as the yield curve flattened, was looking at financials, was looking across the financial space, and guess what is the number one weighted stock in the XLF, the financials ETF? It's Berkshire Hathaway. So the man we love to love, Warren Buffett, and Mr. Middle America, who has been one of the best, if not the best, long-term investor, has been outperforming the S&P dramatically. So 25% on a one-year basis. But since the Fed really ratcheted up their inflation talk, if you look at that chart from November 15th, it's outperformed the S&P by 30%. And some of this is a function of, first of all, excellent exposure to an Occidental Petroleum and some of the resources trades, but also the insurers and folks that are actually passing on a lot of these higher prices, very well exposed to your Heinz and some of your, call them consumer staples that actually have some pricing power in here. And I know have been defensive, even though, that craft is not an easy valuation. So Berkshire Hathaway, again, it makes you wonder what the financials would be doing without it as an industry group.
Is this a conglomerate for our times, Guy?
I think Blackstone, it has been absolutely without question, but I think Blackstone's becoming that. And, it's interesting you mentioned Without You, great song by, I believe, Nielsen, Tim, if I'm not mistaken.
Without You.
And I'm going to go without Berkshire Hathaway, and I'm going to go to Blackstone. And Bono and Icebreaker got me thinking earlier, and I will tell you, major double bottom. We're about to break through a downtrend line from the recent all-time high. I think Blackstone over Berkshire.
Oh, there's a would you rather. Blackstone
on
over Berkshire.
On his own.
I didn't say that. I didn't say that. I didn't say that.
You didn't say it, but you implied it.
I think he said it.
But I'll ask you, Grosso.
I think he said it, and I think you should not be ashamed to say it. And I think the idea, if I think that energy is toppy, then I'm gonna go with Guy. So would I rather Guy?
Blackstone. All right. Oh. You forgot the whole game.
It's mayhem. It's chaos here on the desk, Mel. Get control, please.
Coming up, marijuana merger. We're rolling into the cannabis trade with Cresco Labs CEO Charlie Bachtell. More on his big deal next. Plus, we're plugging into the options pits. NEO results on deck, and one options trader is making a big bet on this one. The details when Fast Money returns.
Test. Test. Test.
Welcome back to Fast Money. A major merger in the marijuana industry today. Cresco Labs and Columbia Care announcing a $2 billion deal. The combined company will operate in 16 states plus Puerto Rico and D.C. within the next 5 years. Let's bring in Cresco Labs CEO Charlie Bachtell to discuss the deal. Charlie, great to have you with us.
Good to be with you, Melissa. Thank you.
This gives you an enormous retail presence to your wholesale presence that you already have. And talk to me about margins. Retail margins are better. How will the margins improve in an industry which is seeing margin compression across the board?
You know, it's a great question. And really, you know, the industry is experiencing price compression, and that can lead to margin compression, except there's ways to manage it, right? And we manage margin compression through a couple of different ways. On the wholesale side of our business, it's why we have the brand portfolio structure that we do. So we have a good, better, best structure where we can meet consumers where they want to be met. It allows us to sort of create the products with a margin profile that allows us to keep that durable. But then also that's where that vertically integrated nature of having retail and your own products really helps protect margins. Because of course, if you're growing your own product, producing your own product, and selling it on your own shelves, great defensible margins there.
Charlie, it's Tim. Congrats on the deal. Talk about the timing of this deal at a time when I think people have been expecting M&A to get bigger and certainly higher frequency, bigger transactions. This makes you the largest multi-state operator in the country. Talk about timing. Talk about being a leader at a time when the industry at some point will have strategics coming in.
Yeah, I think you hit it on the head. For us, this is the time where you need to make the move that allows you to become the leader in the cannabis space. As you mentioned, this puts us there from the perspective of revenue. But again, it also creates this footprint, right, that allows us access to all of the states that you want to have today and for tomorrow. So we've got growth in the footprint. And as we were talking about a little while ago, with us and our branded product portfolio and retail acumen, now we can really expand our access to our own brands on our own shelves, really continuing to drive growth, establish that leadership position with our number one set of brands, and also the largest retail footprint outside of the state of Florida. Protects margins, allows us to pursue that leadership position at a critical time prior to this inflection point where we get some federal reform here, which we all know is a matter of when, not if.
So, Charlie, I was actually going to ask you about the federal reform. If you look at all the stocks in the group, you've done a great job, and all the stocks look the same way. They got decimated. So congrats on this deal. But when do you think that federal lifeline comes, and what kind of a whiplash is it going to be when you could actually conduct banking like every other corporation in America?
Look, it's a great question. You know, I think it's reasonable to say it is more likely than not. I don't know how much. You know, more than a coin flip, that we're on the path to federal reform in the near future. Still optimistic that it can happen here in 22, potentially after primaries, around midterms. But the momentum is there, right? The conversations are happening in the offices that they need to happen in. And our goal and what we think our sort of objective and our obligation as leaders of this organization is to put the pieces in place for us to establish this leadership position now, keep our heads down and execute the business. So when that inflection point does come, you know, it's the most significant dynamic catalyst that this industry can have.
Are you experiencing a lot of inflation, Charlie, in your input costs, whether it be labor or other things? Are you passing on price increases to consumers?
No, you know, if anything, we're taking the obligation to manage the sort of the pricing and still manage our margin profile internally, because really what needs to happen is prices need to come down for consumers. That's going to be the biggest driver of that conversion from the illicit market consumer over to the regulated market. You know, we're seeing some inflation pressure in our inputs, but primarily where we're seeing it right now is in the consumer's wallet. So again, it's on us to make sure we're running efficient businesses so we can create and pass on savings to the consumer base.
So that sounds like further pressure on margins at this point.
Again, it's further pressure on operations and the strategy of the business to make sure we can protect margins while also being able to produce an affordable product for consumers.
Charlie, great to see you. Thank you.
Thanks for having me.
Charlie Bachtell, Cresco Labs. Tim, you like this deal?
I like the deal. I'm long the stock in my ETF. I'm long it personally, and I like the fact that they now have 8 states that they operate in that they've got more than 100 million in revenues. In other words, they have a footprint that I think is very well balanced. Their wholesale business does mean that this is a CPG business that we've all talked about. Everyone says they've got a brand. This is the kind of insulation around margins. You're right to focus on margins because the industry's been, I don't think it's been the federal argument and the lack of progress. I think it's been the margin argument that's pushed cannabis stocks in the last 3 or 4 months down. And I think that's the part that I think there's been a reset. I don't think investors should be investing for the day you get that big federal headline. I think it's a great tailwind, but I think you should be investing in companies that continue to grow their top line, and the addressable market for this industry will still be growing, and leave it with a margin profile that I think is going to be at least as good as booze and other consumer products.
I mean, Charlie, the interesting point that Charlie made, I think, was this notion of migrating the consumer from the illicit market to the legal market, and therefore you have to keep margins down in order to compete with, because consumers have to pay taxes.
The illicit market's running wild. They're not paying taxes. This is the duality of making the essentially the perception of cannabis in this country is it's not an issue for anybody. It should be federally legalized, but it means the illegal market and the illicit market can run rampant. It is, and that's also pushed down cannabis players everywhere.
All right, coming up, electric options, NEO on deck to report earnings, and that's got option traders kicking the tires on this trade. How they're playing the name next. Fast Money is back in 2. Welcome back to Fast Money. EV maker NEO on deck to report quarterly results tomorrow. One option traders betting the report could spark a huge move in the stock. Tony Zhang joins us now with the action. Tony.
Yeah, Melissa, with report of earnings tomorrow, currently NEO traded fairly actively today, 1.3 times the average daily volume, and the options are currently implying a fairly sizable 10.3% move versus the historical average we've seen over the last 8 quarters of only 6.3%. And one fairly unusual trade where 1,000 contracts of the April 18.5 26 strangle was purchased for a net debit of $1.51. So a long strangle is a bet on both direction and volatility, betting that direction can have a big move either to the upside or to the downside as much as 25% by the April expiration. So betting that we're going to see some big moves on NEO tomorrow.
Wow. Guy, if memory serves, NEO is the N in your Dawn trade.
Dawn. Delta Dawn.
Yeah, that is. I think another great song, by the way, Dawn Go Away, You're No Good For Me. And right now, it hasn't been any good for me, but I'll tell you this. They don't pay at halftime, Melms. And I got a funny feeling NEO's going to get off the mat like some of these other names have. So I'm in the 25% higher camp.